about the pivot that they're going to have to make.
Adamant that they are going to do a good job of communication, and communication is key in terms of the messaging that they're going to be sending out, and they have continued to sort of stay on message in terms of not raising rates for the foreseeable future and doing whatever it takes to keep the economy on track. So we believe that that is what will occur, that the inflation numbers that we'll likely see as we navigate through comps year over year versus some of the worst of last year's declines, that inflationary pressure will likely be transitory. And as we move through the rest of 2021, things
is going to be backed into a corner.
I think despite the what I think markets kind of conceived of initially as like a hawkish pivot from the Fed, they have, I think, signaled that they're now again thinking about tapering. But I think the markets overly kind of read too much in the dots. I think the testimony from Chair Powell sort of reinforced that they really haven't changed their underlying strategy, which is that they're not going to be doing preemptive strikes anymore. They are going to wait for the data, especially on inflation, to bear out. And while they are perhaps more optimistic that inflation will be sustainable, they're more optimistic that they will get to maximum.
Condition tightening, Fed can't really pivot towards addressing that financial condition tightening.
From the ECB on inflation, which could take us back to the sort of low 120s.
Do you feel like if the ECB has to make that pivot as the Fed and the BOE are they as aggressive as, or there's still going to be some kind of differential?
I think they're not going to be as aggressive. I think the Fed is slightly more pragmatic in terms of the economic factors. I think the ECB also has to play more of a political role inadvertently because of the huge levels of debt, because of the very clear divergence within the council and the fact that it's managing a number of different underlying countries.
Allow for the Fed to pivot, to acknowledge the upside risks from inflation, and begin to talk about how they will respond. In many ways, Fed leadership was somewhat constrained in making this pivot while waiting for the White House decision. But now that that's out of the way, that should certainly allow for the Fed. Evens in the path of real rates are somewhat inconsistent. It implies essentially a very, very modest reaction from the Fed and a market that seems to believe that the Fed will keep policy extraordinarily accommodative for as long as is necessary. We do see risks that real rates start to rise as you see a bit more of a hawkish pivot from the Fed, and today's leadership announcement should allow for that. And today we're seeing real rates and break-evens reprice accordingly. Break-evens are narrowing, real rates are rising. They're still very, very low, but we do think that this is likely the start of a shift that we're going to see.
Raised cash 5, 6 consecutive weeks at the highest cash balance all of 2021. And so it looks like people panicked because of the Fed pivot and Omicron. And the VIX is another way people bought protection. So, Carl, I mean, the reality is like the VIX could easily make a move back into the mid-teens in a matter of weeks. That, I think, would be coincident with the rally starting. And I think, for instance, again, what looks like a hawkish pivot, and that's been...
And before we commit to that, but investors certainly have been. To me, it seems like the Powell pivot was a much bigger deal for this market, and it's interesting to see them set that aside today, as well as the geopolitical issues that we've been talking about between the U.S. and Russia as Putin amasses troops on the Ukrainian border. It doesn't seem like the West has much to do in order to respond. Clearly, we're reliant here in Berlin, in Germany, on Putin's gas. It's not like Germany can do anything about it. And the U.S. doesn't want to get involved in such a serious conflict. So, we'll watch as they maybe clamp down on banking regulations and stop currency conversions. But what really can they do?
And apply some sanctions there, perhaps, if this were to come to pass. And, of course, we'll focus on that meeting taking place a little bit later. Kayleigh, it isn't just...
It's very similar to what we saw end of 2018, it was actually the other way. The Fed was tightening, and then they pivoted by having a lot more smoother and easy policy. So here, clearly, the Fed is uncomfortable with the level of inflation. But
he had the pivot, and now he's Mr. Hawk. And what if he comes out today and he's like, you know what? I see what's happening with the Omicron variant, and it's a downside risk. It's a significant potential. I'm just trying to think of the Fed speak that they have. It's a significant potential downside risk to growth.
Pivot ever by the Fed. And, there's no surprise. Basically Powell came out a couple weeks ago and said, listen,
those stocks leading if it weren't for that. So in my opinion, I agree with Cheryl.
Earlier in the year have kind of come down to earth with this change and this pivot in Fed policy. Do you think that that's already happened and perhaps may have deflated
this Fed pivot? There's a lot of uncertainty around Omicron, the reopening, the supply chain issues. Of all of those, I would argue that most of those are neutral to positive, including Omicron for this.
To the real focus on inflation. In some senses, the market led that. The market kind of saw that coming, knew the Fed was going to pivot in that direction, it seemed, when we got there. So you do have to wonder how much new there will be in these Fed minutes, how backward-looking they'll be. But there is this conversation around balance sheet runoff, and that could be a focus.
Yeah. Yeah, obviously, we know what the Fed decided at the December meeting. It dropped the word transitory. That dot plot moved up to 3 hikes for the Fed this year. And we also know that they doubled the pace of the taper. The question is, what conversation were they having around that tapering?
For 6 months, as the Fed has pivoted in a hawkish direction. The Fed has been...
The market reacted in excessive way to this minutes. Then I think we shouldn't get too excited about
selling in December, these being sold down here in January. Multiple compression is going on with the Fed adjusting and pivoting, which was certainly more hawkish. But where we're dusting off, our work and doing our diligence is in areas that are, cash flows, good balance sheets, good management teams. So I would look at areas like semi-cap equipment.
And it got to the point that they were tightening enough that it cracked the credit markets. And then we had the famous Powell pivot. I think it's going to be very difficult for the Fed to raise 4 times.
Much from the fiscal stimulus and less from the monetary.
I get one of our colleagues talking about this being a pivot from the Fed around becoming more benevolent or trying to bring out its benevolent side. Tom, good morning to you. When you look at the drivers of US CPI, you were there talking about goods and services. I was looking at Chinese inflation overnight, and the PPI number there, the factory floor inflation, actually dropped a little. Some people reference that and say that's a good indicator. Others say that is really overblown. Your thoughts?
I'm really glad you bring that up. This is a global phenomenon, and there is a bouncing off of inflations, whether Europe or China and such. What I would suggest is yesterday and the day before, we saw a real bout of worry of 7% inflation. And let's remember,
given the reality of the strength of the U.S. economy and inflation and the Fed policy pivot, I do think even that lift in the 10-year could give a boost to the banks and to financials. I don't see rates getting tremendously higher from there because I think you start attracting foreign buyers well above that point. So I think it's a slow, steady rise in rates from here, even though we've seen a sharp move so far year to date.
All right, Marcy, always wonderful to catch up with you. Going to have to leave it there. Marcy McGregor helping us kick off the show. Maryland Bank of America, private bank.
Fed really needs to pivot more to dovishness at some point, but if they do it now before the first rate
clear, the transmission mechanism is open. So what do I mean by that? So ever since the Fed made their pivot in December, what we've seen this year has been a reduction in the most growthy names, an increase in rates, and an increase in real rates. And Will, I think, one of the things in my career that I've seen is when interest rates go up.
And I remember, Barry, when you came on and the market was at a highs and you said, and I was like, why wouldn't we be pricing this in a rate? You were like, nope, wait until this is actually starting to happen and the market will correct. You've been 100% right on that. So what happens next? Have we reached the end of this correction?
We've made an appropriate size adjustment. So you were talking to my old colleague, Steve Kim, the other day, and he was telling you what had happened to home builders. Mortgage spreads
that do cause kind of 10 to 15%. A framework with which to be unemotional is pretty good. And that's going to be the offset. It's a push-pull year. Yes, the Fed is pivoting, and that is what happens typically in the third year coming out of a recession. But you have strong corporate earnings, and we're just getting going in that process. So I think you're right to the extent that I wouldn't expect a major pivot from the Fed just because the market's down 10%.
Andrew, I think we've gone 10 minutes here without once mentioning big tech in an equity conversation. That must be a Bloomberg TV record. Let me ask you, though, how do you actually look at tech right now as kind of an inflation hedge, as the heaviest weight of the stock market? Is this still an environment where you can actively look at the earnings of those big tech companies? IBM, for example, reporting some pretty stellar numbers overnight. Can you look at some of those tech companies and say this is still a good bid, not necessarily on reasons for a haven, but perhaps on their fundamentals?
Yeah, I mean, look, you've had a very substantial sell-off.
Then everyone scrambled to figure out what that exactly meant, and imaginations ran wild.
Coming up, Bloomberg senior executive editor for economics, Stephanie Flanders. She'll be here on the Fed's hawkish pivot. That's next on Wall.
That, especially bonds.
Let's go CFA factor.
Have expected the 2-year to get here quite this quickly. But with the Fed pivot, you know, what we're seeing is that these higher yields on the 10-year is the Fed did pivot in December, and we could see them raise rates.
Bloomberg Dollar Index and arguably equities as well. You have seen some of that hawkish kind of pivot from the Fed get priced in, especially as we consider 50 basis points on the curve. But on the other hand of it, to Matt's point, you do start to see the yield curve flatten a little bit, which once again brings up the fact that if the Fed is going to be this hawkish and this aggressive in their tightening policy, they're essentially slamming the brakes on the economy, and that's not good news for the dollar.
Well, you mentioned it all being priced in. Is it all priced in? Have we reached peak hawkishness, not just in the dollar, but in terms of what we're seeing in the Treasury market, for example?
I don't think we've reached peak hawkishness. And once again, it really comes down to that 50 basis point hike, right? We know there's going to be several rate hikes. We know there's calls for as many as we're saying, well, this first quarter was going to be pretty volatile anyway. They were attributing it to simply a hawkish Fed, that very strong pivot. No one really saw these kind of geopolitical tensions creeping up. How much of the price action is actually those Russian tensions as opposed to perhaps volatility that investors on the street were anticipating for months yet?
Yeah, I think it's like really a combination of all of that, because on one hand, you have like this big, policy shift from the Fed, and obviously this geopolitical risk kind of came unexpected. And at the same time, there have also been some signs of decelerating, earnings revisions. And so I think, people are also worried about kind of slower profit growth at the same time. And of course, it's kind of hard to disentangle everything because the Russian news also at the same
to pivot and do more, and it's probably not with just rate hikes.
Jonathan, asset managers typically have a tough time sort of figuring
tensions between Russia and Ukraine, as well as concerns about record inflation and the Federal Reserve's monetary policy pivot, and that could mean rate hikes starting as soon as next month. Someone also mentioned to me earlier today, markets need to kind of move past President Biden's
to get meaningfully better. It may get meaningfully worse if oil continues to spike. I would say the thing that's going to get the Fed to pivot probably is not going to be inflation.
Curve. Even with the flattening we've seen and the reshaping of the money market curve around the hawkish Fed pivot, the 2-10 curve is still not inverted yet. That usually happens well ahead of a market top like.
Started this back, at least in November. I think I was on this show, right, when we had that argument on November 29th or 30th when Powell made that pivot, and that was a hard pivot, and the market has reacted. And so we are well down the road. You're not going to be going into the cold water for the first time tomorrow. You guys are already, I don't know, maybe ankle to knee deep in where you're going. And then the question is, do we go straight to 2%? Do we have to go to 2.5%? It's all going higher, and the question is the time period for the adjustment. I think Powell is cognizant of that. I think he's cognizant of the idea that he doesn't want to have a major hiccup. He wants to give the market time to adjust. And I think Guy was talking about, this market can take a quarter, it can take a half. It's already taken 1.5.
Like I've said 100 times, you guys are already living with that. Look at the change in the 2-year from when Powell pivoted in November. You are up. There is 200 basis points of tightening.
Really, this Ukrainian situation is threatening energy and commodity supply. Why has that happened?
Well, sentiment has shifted a little bit on the conflict. The idea that maybe all the sanctions we're likely to see, at least as they impact businesses in a major way, are maybe now behind.
Near term is to get back to something closer to neutral. Neutral funds rate being something like 2 to 2.5%. Once you get in that range, then it's easier to get policy tight or ease policy if you need be. But I think that's the rationale, is that if you can get there sooner, maybe next year you won't have to be playing even more. So right now the Fed's playing catch up, arguably. And I think the rationale for hurrying now is that you would be playing even more catch up next year if you don't go faster now. So that seems to be what's driving the latest pivot in Fed thinking is, let's get in a better position, not so far off sides as they are.
18 and continued into the fall of 18, and they didn't end that until the S&P corrected 20%, and that's when Powell pivoted in early January of 2019. So that's one example. The other example could be maybe it ends when they reach certain goals. Maybe they want to get to a certain Fed funds rate as long as it doesn't break the market. That's another possibility. And then the other thing I was thinking about is that midterm election years tend to bottom statistically around August, September. So this could go on for several months until the Fed reaches.
Expecting a dovish pivot from the Fed, the exact opposite of what Sonal says could be the case.
Yeah, listen, I mean, we are somewhere around now, presumably going to get the peak in inflation rates. And if it starts coming down over the course of the year, then they might have some room to sort of take their foot off.
Blinks because the market sells off or something happens. That's the catalyst for Bitcoin to probably take out the all-time highs.
It's interesting, and employment as its objectives. Its job is not to protect equity holders, but that's the way it has behaved. At the end of the year was 1.8% a year. Now it's running at 8.5%. Just a pivot by the Fed during the months to come.
Sri, the Fed can always say that if the market goes down,
Fed pivoting a negative, and the positive, that continuation of good corporate fundamentals.
Quarters of growth. Q2 is going to be very weak globally.
This year is a battleground between Fed pivoting a negative and the positive, that continuation of good corporate fundamentals.
I don't think we've seen the end of price increases from us or other players.
The question you should ask yourself is, where can I find safety in the world?
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
I accept inflation rather than provoking recession, but that's an uncertainty. It's a guess on which way Powell's going to go. He's shown with his pivot in 2018 that that's how he thinks about things, but it's still uncertain.
I mean, we saw that with him taking off 75 basis points off the table. Was that a mistake?
I don't know if it was a mistake. He wanted to calm the markets and said we're going to go about things deliberately. He's showing he's not asleep at the wheel, that he said there's going to be 50 and 50 for the next two as well. An extra 25 basis points is symbolic more than having a real economic impact, I think. So everything he does can be viewed as a mistake because there's going to be no right answers, unfortunately. He's got to find the answer that's less wrong, and I expect that'll be...
The Fed was going to have to pivot and react on exactly what we've gotten, which is
continue to be the struggle until two things happen. Either inflation peaks and really declines convincingly, and or the Fed pivots because, to your point, they're trying to strike this perfect balance. For now, I just don't think that.
which is going to force it to pivot, especially if we get an inversion of the yield curve. For example, if the Fed gets to 2% and the 10-year is at 1.5%, that inverted yield curve is going to send a very strong signal to the Fed.
There are a lot of things that people haven't operated in. Listen, the last 13 years, for a lot of people, nobody's seen markets like we're seeing now based on a Fed pivot. So, I mean, a lot of people are dealing with situations that we haven't seen before. So I'm not looking to give anybody a free pass. I'll say this. PayPal traded down pretty much to those March 2020 lows and is subsequently bouncing here. I think for a trade, PayPal looks interesting. But that's coming from somebody that thought PayPal would stop going down probably 35-40% ago. But at these levels, it might be interesting, especially given that they reported at the end of April, guided lower. All the bad news seems
part of the Fed at least caught me by surprise. And, I think that given that they don't sense that there's a real level of panic in the market, and until we get something that is threatening to financial stability, they seem quite comfortable to watch the stock market go down, as long as in their mind.
Of saying that, hey, back in 2018, the Fed pivoted when the stock market was down. They didn't. That's actually not accurate. And I've been talking about this for months, is that in 2018, in December of 2018, the stock market was down 13%. And they went ahead and raised rates again. They didn't care about the stock market. It wasn't until just a few weeks later that the high yield market really started to implode. That's when they started to freeze up there. That's when they really started to change their stance. So, again, I guess my point is, yes, there's a put out there. It's lower, but they are market dependent, but they're fixed income or bond market dependent much more than they are stock market dependent. The stock market can go down quite a bit without really.
What do you think? How bullish or bearish are you feeling this morning?
Well, I have the same base position I've had since November with the Fed pivot that we saw, and that is that we need to be defensive. We are nowhere close to a panic in the market. We're starting to see some hedge fund fail. We're starting to see momentum going out, and clearly the market is impacted by this fact that a lot of the constituents of the high-flying stock has been basically a zero coupon 35-year bond. So the convexity is now biting them. And as Mr. Wilson says, basically we haven't even started the quantitative tightening. That will happen in June. So for me, it's more of the same. The script has been the same for the last 7 weeks. But in essence, this is all about the major central banks is now kind of indicating that we will see no liquidity.
We're in an environment where things getting worse are actually going to have a great setup for when the Fed's able to tell you.
Why do you think they're going to pivot? Why do you think they're going to pivot? What gives you any reason to believe that they're going to pivot? I'm just curious because I keep hearing that from people.
Continued with emergency policy long after the emergency passed. So look, I think the Fed has gotten the joke and has made a big pivot. I think they're committed to see this through. And what we've got to do is stop the wild spending that's been going on.
I am most certain that in the Senate of this United States, you are the most supple, dynamic mind on economic dynamics, financial dynamics, currency swaps, and derivatives. How do you explain to Republicans who have a static vision back to the 1950s that they need to be more subtle, more dynamic to build and grow this country?
I think you need to give my Republican colleagues a little more credit than that. Most of them actually weren't yet adults in the 1950s.
But they're pressured by a president President Trump, who desperately wants to go back to another time and place.
I think he wants to invent
China to abandon or tweak its COVID-0 policy. I guess the point here is, do I start positioning now in this cheap equity market?
So I think, David, you pick up the critical point, which is there's a trade-off, right? So this kind of
to be supportive, which means that we're stuck in this sideways chop, and we really haven't seen the kind of positioning flush or big cuts to estimates, big cuts to valuations that broadly would really justify backing up the truck, closing your eyes and buying. Gunjan, we're more than a year past when there was a peak in the enthusiasm for stocks that. I think we're going to need to see a string of good data as it relates to more consistent disinflation. And we're going to need to see a more meaningful Fed pivot before I think we can see a durable rise in markets. Nonetheless, I think
side, they can't directly go after the supply side. So I think it's still down the road before the Fed can truly pivot off the pretty aggressive stance.
Essentially short-term flows associated with that interest rate differential. When the economy does crack in the U.S. and the Fed pivots, maybe 18 months from now or so, when the Fed will be able to pivot, we think you're going to be in for a long bear market in bonds. But as long as there's a debt crunch to a certain degree and a liquidity story, the U.S. will attract a lot of capital. Now, given the degree of the current account balance in the U.S., the dollar needs a tremendous amount of capital. So even a slight change in the amount of capital the U.S. is able to attract will lead to a decline in the dollar. So right now, there's still short-term pressures bullish on the dollar, but the longer-term pressures are quite bearish. And we think you're in for a secular bear market in the dollar once you get past.
Pivoted. Now when you see the Swiss National Bank out of nowhere seemingly raise rates, and now global central banks raising rates, that speaks to them trying to be responsible. Not coincidental. Now Bitcoin is seeing levels we haven't seen in 3 years. these central banks will pivot at some point. I think BK agrees with that. And when they do, that to me will be the green light to get into Bitcoin.
So Dan earlier, BK, revealed that he bought some Ethereum. And so I'm wondering
in Asia and how that ripple effects around the world. Let's pivot here, though, and look at what's coming up ahead today. Fed Chair Jerome Powell makes welcoming remarks at an inaugural conference on the international role of the dollar hosted by the Fed. It's also Triple Witching Day, which is likely to exacerbate the frenzied nature of this week's price action. Of course, the eco data, it does not stop. We'll get U.S. industrial production data at 9:15 a.m. New York time, Matt.
All that is important, but the Bank of Japan has really been an obsession this week. The governor, Haruhiko Kuroda, held firm with rock-bottom interest rates, defying an intensifying global wave of central bank tightening. Let's get more with Paul Jackson, our economy editor for Japan and Korea. And Paul, tell us exactly what the Bank of Japan did. It was really just a tweak.
Because I don't think we're going to see a lot more downside. And I think eventually when there's a Fed pivot or we start to see some improvements here, this market is going to work its way higher nicely.
That I just went through. But I think to have a really meaningful turnaround in tech, you're going to need a pretty strong pivot from the Fed or some signal that inflation is abating and that there is some type of pause. So we like parts of the market where, for example, healthcare, investing in longevity in terms of some of the quality positions.
11 of those times, the stock market didn't bottom until the Fed signaled a pivot to neutral or dovish policy. Going forward, traders will be.
But that's it, right? We've got to, history says, along with the charts, we have got to have the Fed pivot. We've got to have the Fed change their tune, maybe at the Jackson Hole conference in August, some are suggesting, right?
Absolutely. It could be that. And then don't forget about midterm elections.
It is good news right now as everyone tries to second guess the Fed once again.
Yeah, at what point is the Fed actually going to have to pivot back toward easier policy if they're too aggressive on the tightening and we see a slowdown in growth as a result? You're trying to see the bond market price that in, which is why we've seen yields coming in really across the world. And that has given a lift to equities. At least that was the case in Asia overnight, where the MSCI Asia Pacific Index was up about 1 percentage point. But really the move was led by Chinese technology stocks, again, sensitive to the rate story. The Hang Seng Tech Index was up about 4%. As for that rate story, we see yields coming in again around the world, but it has been really dramatic in Australia this week. I'm talking double-digit basis points.
But, when we hit 3%, I thought we were close to done. So when we hit close to 350, I just didn't think we'd be able to sustain that for as long as we.
Yeah, we are all guessing here, right? So it's just my guess versus someone else's guess versus your guess. So it's
only for it to get reversed by the end of the Cuban Missile Crisis. So I wonder how much of that pivot point is really the recession talk or the Fed, as opposed to perhaps an end to the war in Ukraine.
All right, guys, thanks a lot. Really appreciate it. Thanks for jumping in there. Bloomberg's Michael McKee and Kriti Gupta. I don't think Guy was even live in 62. I'm just putting it out there. All right, coming up.
I was just waiting for that.
Coming up, what will future rate hikes mean for the credit market? We're going to get the inside look down with Jonathan Levine, Chief Investment Officer of Bain Capital Credit and co-managing partner of Bain.
Yeah, no, I think that's a great point. And you're right, it should actually be the headline. I think Chair Powell sort of made this pivot a couple of press conferences ago, actually, when he started his press conference by basically saying that he wanted to speak directly to the American people. He said that the Fed understood the hardships that inflation was causing. And you can't understand the hardships without knowing what gas and food are doing. And so the headline rate in terms of CPI is about 8.6%, which, by the way, I think next month is going to go up to about 8.8. And on the PC side, it's still well over 6%. So if you're looking at those measures and you're the Fed, it's great that the core PC is slowed down to 4, but the headline is still unacceptably high. And I think that's another reason, given the Fed's pivot, their focus on expectations.
I don't know.
What do you make of that, Lisa? Do we reach this tipping point where the Fed has to make a bit of a pivot, or ultimately is there enough money out there that have been waiting for spreads to widen for a long, long time, waiting for interest rates to get back up in line with what some people might argue is in line with fundamentals, and they want to start buying it?
Okay, so I'm smiling because I don't know the answer, and I've been struggling with this with myself. Because on one hand, if the economy slows sufficiently, that actually presents a credit risk to some of these companies over the longer term to refinance themselves, but it also allows the Fed to take its foot off the pedal in terms of how much it raises rates. But if you have the opposite, where basically the economy is strong, then the Fed keeps going, and then you have to reprice the entire structure.
Kill inflation. They're going to have to make that pivot. When do you think that all-important pivot to a dovish Fed will happen? August, the end of this year, early next year?
Yeah, I think we just need an indication that they're going to pause this current cycle. There's
from worrying about inflation to essentially worrying about the effects of the Federal Reserve trying to deal with inflation. So you're pivoting from inflation to recession or soft landing. And that's really the dividing line. The only real big issue sitting there, besides Russia, Ukraine, is are we going to have a recession or are we going to have a soft landing? And depending on how you feel about that, that will inform your view of the stock market and the economy. So I would say there's a reasonable chance of a recession because the Federal Reserve, historically, when it has aggressively raised rates, and I mean really fast, which is what they're doing now, historically, they've induced recessions. That's happened.
The U.S. economy slowing dangerously. Are we in recession? How soon is the Fed going to need to pivot to rate cuts, do you think?
Yeah, it's a pretty confusing picture, Kelly. So I do think we're slowing.
In our view, going to stay that way for a while.
Well, I don't know. The way that the market's trading today, it seems to think a Fed pivot is at hand.
It's possible. I wouldn't rule out, by the way, I wouldn't rule out a summer rally just because they often happen. And the market is.
Back then to pivot. Clearly different world, different inflation level.
Inflation should be well on the way down in a couple of months. That gives the Fed room to pivot. I don't think 50 basis points. They've got covered to do 70.
Maybe it was Liz. It will stop when the Fed pivots. That's probably a couple of months away.
Yeah, but see, I have a problem with that view. I just don't. And as Joe was saying, you've got this economic slowdown underway. I'm thinking to myself, how could we have so diametrically opposed views on where we are in the economy? Joe says we've got this slowdown underway. The data suggests, get it, as if the Fed's going to pivot, as you suggest, and all of a sudden the economy is just going to roar ahead.
The malaise will end when the Fed pivots. And for that, you're looking for inflation to come down. Look at where RBOB is. Look at where gasoline futures.
Expectations increase. When faced with this decision, the Fed chose number one, hands down, and that is the reason why it is a pivot point for this market as they look to a greater chance of recession.
The tail risk has become the base case, and the base case is now a mild recession. Now, we can have a discussion about how shallow or how long that recession will be for, but the ultimate base case is now that we get one potentially in the second half, and Bank of America are on board with that. And Tom, that's why you see a sea change from B of A this morning. At the epicenter of that research house at the moment is a call from Michael Gapin for a recession later this year. That means Savita Subramaniam of B of A comes out, slashes the outlook for equities. No recovery there, 4,500 down to 3,600. Then you've got Mark Cabana and the team over at the rate side of the business.
But it's probably due to the fact that growth is going to be much slower as well, that the Fed may have to pivot and reverse course.
What else are you looking at in terms of the bank earnings, M&A?
The Fed pivoting to become accommodative. And in the past, the Fed could become accommodative even when the market was freaking out, but the economy was still doing okay because inflation was benign. But based on yesterday's report, there's no end in sight to this very elevated inflation, which keeps the Fed backed into a corner and unable to support markets.
Well, Cameron, thanks. The stock looks like it's trying to bounce a little bit now. It's down 3.
Have an opportunity to pivot in some way. It doesn't have to be dramatic. So we still think this is a rally, a strength to sell into, and that we're still in a downtrend, and ultimately you'll get an opportunity at lower levels to kind of reload your gun.
What a couple of days, Jason Snipe, for this Fed talk and tea leaf reading.
Fighting credibility because that's what they lost in the 70s and 80s. I don't think they're anywhere near that yet. And if you think about it, the Fed can pivot pretty fast. This has been a more nimble Fed than I think most of us are used to. We used to have the Fed that televised and then did exactly what they said they were going to do. Now the Fed is reacting to the data. That is what is creating the volatility that you're seeing. And I think it could be just as fast on the opposite side if you do see concrete signs showing up in the data. I think that CPI data kind of distorted things, that it shows that inflation is in fact subsiding.
Does that mean that you believe, first of all, it's obvious this
wrong, and the Fed does not think it's going to cause a recession, which means tightening
isn't planned. And even though there'll be some signs of softening inflation on the energy side and on the goods side, we now have to deal with sticky service inflation in housing, rent, and wages. That will be more difficult. So we do think that you'll get to ultimately a 14 or 15 times multiple on whatever earnings you get. Right now, we're at 16 times on elevated earnings that are not going to hold as.
Okay, we did our 75 again, and because inflation has peaked, we're good. And we're just going to take it a wait and see. But as Steph said, we are so far above 2%, and it's going to take a long time to get back to that level that I don't know if that's a foolhardy sort of thing to place your bets on, like some built on the great pivot that the Fed is going to make. I hear you. A lot of people think the same way. Let's do your picks. Skyworks, interesting place to be right now.
Yes, we like the semis. A couple things I would say. You're getting Skyworks at 8 times earnings, over a 2% dividend yield, healthy dividend growth, and their biggest customers are Apple and Samsung, so they're tied to that smartphone market. A couple things I would say that is really interesting about Skyworks is that the majority of their profits and revenues actually come from the emerging markets. And we're actually bullish on the emerging markets. China actually is easing, not tightening, one of the few large economies that's doing that. And in addition to that, Scott, you're getting...
I mean, that's what I'm trying to work out here, Scott. Can you really get that in?
Work is done. Yeah, I think you could see a...
Not because of the Fed pivot talk, right? Because the economic data came in so soft. So, and then lastly, just on quickly on the just big picture on earnings, 35%.
And how difficult this recession will be.
How many times have you heard an equity bull turn around and say, Chairman Powell has proven that he can pivot and he'll pivot again? Chairman Powell's proven he's made the mistakes that are bad enough, which has led him to need to pivot eventually. But ultimately, there's some damage done along the way.
I just love that we're at the place where all equity strategists are rate strategists and rate strategists
Always the way.
are equity strategists. And right now, my head's spinning.
My head's spinning too. Futures,
Mine's
down 0.5% on the S&P. I know you're dialed in, Tom. You can tell.
Dialed in.
The Nasdaq down 5 or 6 tenths of 1%.
Can you make the tang stronger?
Yield's down 4 basis points, 276 on 10.
There's no sugar in it.
From New York.
There's no sugar in the tang.
This is Bloomberg.
Please. Northwestern, please.
Range of S&P 3,600 to 4,600 until something happens, and that is inflation breaks one way or another. The good news is we are seeing it cooling, or the Fed pivots. There's expectations the Fed could pivot in early 2023. That sounds optimistic to us. We're coming into a 75 basis point rate hike tomorrow. The interesting thing out of the FOMC will be what kind of guidance do they give in terms of how far past neutral they'll go and what do rate hikes look like for the rest of this year.
Sarah, how do you think we'd respond if the chairman acknowledged some of the weakness in the economic data? Do you think that could get problematic quickly?
I think that would be mostly an expectation. 75 basis points and the Fed admitting that economic data is weakening and they'll stay data dependent would be something I think the markets expect. What will be curious?
That's what the Fed is hyper-focused on right now. So we are not close to the Fed pivoting, and that's perhaps where markets might get caught out if they're starting to trade a pivot from the Fed, because it's just too soon.
It's too soon. So when does the Fed start to cut? Because there are a lot of people pricing in cuts from next year. And link for me how risk assets perform and our expectations for cuts, because obviously equity markets like to look forward, don't they, and discount what's going to happen in the future. But what is the link between those things happening? What do risk assets do now when we start to get a handle on when the Fed is going to cut?
Well, I'd say the support for risk assets is positioning is much cleaner. So we're not coming into this, concerns on growth with the market going to pivot until they're clear that they've seen inflation actually meaningfully start to decline. And a couple of meetings ago, Chair Powell said that meant they needed to see 2 or 3 prints that actually support the view that inflation has peaked and is coming down. We haven't even seen one print yet that's showing that. So we're still a while away from the Fed pivoting.
Do you think that certain parts of the US economy are really in danger at this point? We got those numbers from Walmart trading down substantially pre-market as a result of a warning. And this is customers having to cut back on their spending because of the cost of living. Is that something we're going to see a lot more of?
We are going to see more of that.
To Fed policy in terms of what kind of pivot it could bring. Is it a pause? Do you believe in the Alan Ruskin school of thought of Deutsche Bank that the Fed is going
can start talking more about
core inflation being important, that I would view as a dovish pivot. But look at the composition of inflation and how the Fed speaks about it. I think that's
actually softer eco data. Does it charge ahead to its 2% target, or does it pivot in the face of weaker data?
I think they're going to have to keep on raising because at the end of the day, the playbook.
You think the Fed's going to pivot in the fall and we're going to start to get rate cuts next year, sometime early next year. I just don't think that's a great way to invest right now. That being said, some of the things that rallied the most today, maybe they do feel like they're a little bit overdone to the downside. Maybe valuations are starting to make a little more sense, especially if you don't think that rates are going so much higher. I mean, listen, there's a lot of people who feel like rates have to go much higher, mid-single digits, to get to where inflation is. I just don't think that's going to happen because of all the debt that has been accumulated over the last few years or so. So to me, I don't know. I don't really think this is something you want to chase. We know the history of
a Fed that's potentially going to pivot is going to be a bad thing because the inflation that they're trying to combat is just going to get right back out there again. Again, listen to the Walmart call, and I think it tells you all you need to know. Inflation is first and foremost, Karen said it, and if the market goes down, that to me is just collateral damage at that point. I think they accept that. I think they're probably thrilled that the market's gone high over the last month. I just don't think it's going to last for very long.
You know, there was something interesting that Jay Powell said during this news conference that really struck me, and that is this notion that he said in the second half of the year, the economy should be okay, effectively, because there's so much.
They're starting to price is that the Fed will have some kind of a pivot. And I don't think that we're going to see that pivot from this Fed. Really, we have to hear more about the Fed's reaction function, exactly how they plan to address too high inflation. If I take Chair Powell seriously, the rhetoric at the June FOMC was that inflation is the number one issue this Fed is trying to address, and that Powell is willing to do the difficult things like a former Chair Volcker did to bring inflation down. And it really is that commitment to bringing inflation down that does bring it down. If the market starts pricing, and I think it's beginning to, that this is a Fed that's not committed to bringing down inflation, that this is a Fed that's going to pivot to more dovish policy before you've brought inflation down, that's a real issue for the Fed. So they do need to get ahead of that at some point. Do they do that at this meeting? Do they wait until Jackson Hole or September meeting? I think that's where the kind of tactics come in. But in terms of the longer term strategy, there has to be that commitment to fighting inflation.
Andrew, this is hinged on the belief that seems to be the consensus right now in markets, that the bigger risk is the Fed not raising rates quickly enough and allowing inflation expectations to become unhinged. Julian Emanuel yesterday of Evercore came out and said it's actually the opposite that is the bigger risk, that if the Fed raises too quickly now.
A number with a 9 handle.
I don't care. I'm in triple leveraged all cash. But,
pretty tough environment for the Fed to make a pause, a pivot, whatever your choice of words.
The Fed pivot. The bond market is pricing in the Fed pivot. The earnings estimates are still not reflecting an economic slowdown, so those definitely need to come down. And I think the thought that the Fed is going to pivot on the first sign of top line CPI or top line PCE going lower because of the commodity price decrease, I think that's a little too optimistic. And I think we're working with an understanding of a Fed from the post-global financial crisis and QE, and not the Fed of QT. And this is a different Fed. And I think that has been largely put to the side as a left tail risk, but not a central scenario risk.
Well said, Alicia. We still got a 9 handle on CPI going into this Fed meeting, and we're talking about a Fed set up for a pause. We need to think about what's been unleashed in this economy, where we're seeing weakness and how it spreads. Where we're seeing weakness right now is in housing and housing related.
On equities, we never went underweight on equities because it's too hard to time the market. We do think that the market is over expecting a Fed pivot in the near term. I can't see how that happens. Once they made the policy error of being too easy for too long, the chances of overcorrecting and staying tighter for longer go higher. And so the market's already rallied 10%. So what are you playing for at this point?
Alicia, I love you. That's just perfect. The kids going back to school, a celebration of life, getting back to normal. Lisa's face lit up as well. Alicia Levine of BNY Wealth Management. Go on, TK.
Afterthought the other day. She goes,
isn't it a celebration of life returning back to normal, Tom? Sending them back.
I have to have a Norris pencil. Folks, Norris pencils are British pencils. They're absolutely gorgeous. Stadler, John, did you use Norris
I've got no
pencils
idea.
in school?
I've
the
got
yellow
no
and
idea.
black ones?
future, there might actually be rate cuts priced into the market. The question here is how quickly is the Fed actually willing to pivot and actually willing to slam the brakes? That was one of the main mistakes of the 1970s, this idea that they're going to go tackle inflation head on. They slowed and then they had to tackle it head on again. Is Chairman Powell going to make the same mistake? Dana L. Battlegee, Bloomberg managing editor for credit, joins us now. We thank you as always. Let's put this into perspective. The market is pricing in a little bit of a dovish tilt from the Federal Reserve. The Nasdaq outperforming, the inversion becoming less inverted in the 2-10s curve. You even have a dollar that actually paired some of that weakness. I'm curious about what you make of the
Fed pivot around the weakness in this data, given the political pressure that will build if we are labeling this a recession.
Yeah, I think that's Powell really endorsed this message of data dependence. It's not just this blind march to a higher policy rate. Now they're just setting that.
Some of that, back to where we started the conversation, really, I suppose. Do you think some of that faith in a pivot from the Fed, if that's what's been driving this positivity?
Came out this morning over at Bank of America, Mohammed, and said it's too early to price the Fed pivot. He's saying sell the S&P at 4,200. Is it too early to price this Fed pivot, given everything that we don't know and that you just explained in the last 3 minutes?
So there's two reasons to price the Fed pivot, both of which are weak. The first are weak in terms of if you want to translate it into it's good for risk assets. So one
number saying, okay, one more rate hike in September, we're in a recession, they're going to be forced to pivot. The Fed doesn't care if we're in a recession or not. Okay, the Fed actually has two things that they try to control.
Steps potentially towards a Fed pivot. Do you agree?
Not particularly. Central to this is the view that there'll be this immaculate disinflation. Yes, the news might have been a touch.
And so I think that while the market is pricing in a Fed pivot, a more dovish pivot at this point, I think that we'll see the Fed change its tone in late August, which I think will change the market tone, particularly as we get evidence that the supply chains are still in quite a disrepaired shape, and as we get evidence that inflation is still a concern.
So if the markets are operating, as you say, on some wishful thinking, what is it that investors should be buying in early August while a few weeks is still operative before
some sort of pivot from the Fed? Why is this not the right way to look at it, since it has been the right way to look at it? Have underlying resilience, which seems to be the response, at least in markets, to some of these earnings, then why are people pricing in a Fed pivot? Why are they pricing that the Fed won't go as far, won't stay there for as long, and will start cutting rates as soon as the first quarter of next year?
And the 2-year is the best signal for when the Fed is going to pivot from hiking to cutting rates. We're seeing action in the 10-year as well. And so that is why we viewed this as a soft pivot, one that you have to pay attention to. It moves us from cautious to cautiously optimistic, but it does not change our positioning in that quality is still our focus. Because when we think there's storms out there, we want to make sure that we're continuing to protect the ball as we play the game.
All right, there we go. Rob Sechan, quite a few metaphors there, but basically, I want to toss things over to you, Jason Snipe. I know you are kind of agreeing with Jim and with Bryn that earnings, they just weren't as
kind of Fed pivot scenario, and yet you're still staying quite defensive. What would it mean for you to kind of get more into the cyclicals and that side of the market?
But I think there's something constructive to it.
Okay, so you really think it was a pivot? You had your
price for a crisis, but we also don't believe a crisis is going to happen.
And what about a potential Fed pivot? And that's kind of gotten more into the sentiment of investors these days as well. And obviously, lower rates would.
This whole regulatory pivot thing, I think, is really interesting. In my opinion, the definition of a Fed pivot is two things. It's number one is, and you have to get inside the mind of the Fed and predict the future, which is, has the
market overall, stocks, bonds, has gotten ahead of itself when it comes to a Fed pivot and potentially easing next year?
Look, I don't think the market has to have gotten ahead of itself here. I think that the market's acknowledging the fact that they do have risk priced in.
Going up in anticipation of a hard landing?
Yeah, we've been in this camp where the data has to get worse before it gets better to justify that Fed pivot. That in order to see the Fed have enough bad signs that they say, okay, ignore higher inflation above our 2% target, which will take time to get to, that we'd have to see really weak jobs data. We'd have to see really weak manufacturing data. Those things have started to slow, but they're nowhere near bad enough to say that the Fed
had pivoted. There is now a kind of pushback by the Fed or by some Fed officials that some kind of imminent or early 2023 rate cut is in the works here.
Although 50 in September being reasonable, he could have said, well, 75 seems more reasonable. He did not. He used the word reasonable around 50. Where does that jive with where Evans has generally
combating inflation? We don't want to pivot. You don't want to buy the market because you think there's going to be a pivot. You want the Federal Reserve to remain committed and disciplined in continuing to normalize rates higher.
Yeah, it is. But, Mel, I think you make a really good point about the Fed, right? And you had this perceived pivot, but then all of a sudden, basically right after the press conference, you saw long-term inflation expectations jump by a pretty significant amount. So basically what the market is saying, it's way too early for the Fed to pivot. We've talked about that, and I do think that that's generally problematic. And I think the reality is, and Courtney mentioned this, we have to look forward relative to the consumer. We always talk about monetary policy impacting the economy with long and variable lead time. So I think, we're only just seeing the effects of higher interest rates on the consumer. And you listen to companies, they're saying the consumer's okay, but I think if you read through some of the data,
focusing on inflation is still rising.
Have been rewarded. How much does that continue to be a trend? And today there's loads of Fed speak trying to perhaps push back against the dovish pivot that so many people are baking into the market. We get here from Chicago Fed President Charlie Evans, Cleveland.
Rate. So there are different ways you can play it. But I would say, in my view, the market has it wrong that the Fed is going to pivot. I don't think inflation is going to come in that quickly. Powell has said that he needs clear and convincing evidence that inflation is falling back down to the 2% target. I don't think that we're going to get that anytime soon.
Mandy, how much conviction, just to sort of zoom out here, how much conviction has this rally had behind it from a derivatives perspective? How much have people closed out their bearish bets on the U.S. economy, on the U.S. stock market in particular, as the market rallied the most since November 2020?
Well, first of all, what bearish bets, right? So I would say one of the defining characteristics of this sell-off in the first half of the year is that we've seen very, very little hedge.
Got to go into restrictive and more restrictive territory. So once again, that entire comment about this being the big policy pivot, a lot of these Federal Reserve officials throwing cold water on it.
Yeah, pushing back in a big way. And of course, the Fed and all of us are awaiting the jobs report on Friday because we know they're paying close attention to the labor market. And we're watching any and all developments on hiring freezes or outright layoffs. We got news on that from Robinhood overnight.
We did. 23% of their workforce is being laid off. A lot of these support functions, a lot of marketing, advertising. That's a theme we've seen in a lot of these tech companies. Think Snapchat, Pinterest, Twitter, all of which have mentioned some sort of slowing in hiring in their ad business. But remember, Robinhood has also been dealing with a lot of their own issues. It's not just the hiring stuff. It's also the fact that
Absolutely. I mean, I think clearly, the news today is talking about this pivot and the Fed pushing back against the idea that, that they're going to be finished raising rates anytime soon. Clearly, the emphasis is all about inflation. And I think the interesting thing continues to be that no matter what report you look at, inflation continues to surprise on the upside. And, that really emphasizes the picture that policymakers don't really have, and economists as well, don't have control over it.
Okay, so there's certainly the Fed narrative live and kicking through these markets. We certainly saw that yesterday, Lynn, and to some extent today. On the visit by House Speaker Nancy Pelosi to Taiwan, do we get a sense that we know the magnitude of the market response here, or does it take time?
Still remains very much in place. I don't think that we should be pricing a pivot by the Fed anytime soon.
Okay, so if that's the view, good morning to Vasilios. If that's the view, then the Fed's still hiking, no pivot. Does that mean more strong dollar to play for?
I think so. Look, I don't think that we are going to experience the speed or the magnitude of the strength of the dollar that we've actually seen up until May and early June. But nonetheless, I still think that the dollar is going to gravitate higher against the euro and against commodity and high beta effects.
Yeah, I was going to ask you against what? So against the euro,
Yeah.
against the Aussie dollar, I think you argued, and against the yen, maybe?
I think the jury is still out on the yen. I think, in my view, the yen has bottomed out against major peers. Whether it strengthens or not.
For a Fed to pivot, is it a definitive sign that inflation is coming down? Is it no hard landing? Is that the kinds of things you're looking for?
I mean, honestly, it's about price. I think what we need to do is come to a realization that earnings are going to come down. If you look at earnings are good, but if you read through the comments, you're seeing things like in financials where they're taking more reserves, expecting that the consumer is going to be in trouble. All of that has to push the price down where we've got a real margin of safety where we could feel comfortable putting money back.
You know what I'm writing down as you're saying it's about the price? It's your guy, Mike Wilson, right, at Morgan Stanley, says the price is wrong. I think that's exactly what he says, right? The price is wrong has been.
A lot more people argue the Jackson Hole will be an opportunity for the Fed to truly pivot. You think that's also too optimistic?
Yeah, we do. Now, the positive and
news for markets at the moment in that the rally that we've seen in the last 6 weeks has really been around the idea that the Fed could be pivoting from the aggressive rates and inflation narrative that we've seen governing markets for a lot of this year to a softer stance. And I think that's what's driven markets in the last 6 weeks in particular. And that's why these data points coming up are so crucial. Yeah. If, of course, they're weaker than expected, it could drive markets that much higher. And the same is true of the opposite.
So what does it mean for Europe? We're kind of like at the confluence of all this bad news.
Yeah, you're absolutely right. So when we think about Europe in the global context, we, Barclays, are that much more negative on Europe. And part of the reason for that is the proximity to the gas situation. That very, very differently than what investors thought. So there's the short term at the moment, the relief around the Fed policy pivot, also some of the disinflation trends that you're seeing ever so slightly coming through on that chart. And then there's the medium term outlook, which is very much more geared to the aggressive rates and inflation narrative. We, Barclays, believe that people are a little bit too bullish on the idea that the Fed will, of course, pivot their policy away from what we've seen much of this year.
So that means bargain hunting. Maybe. Where do you find do you have a conviction trade?
So the way we're viewing things at the moment is very much barbelled. So we're being very, very cognizant of the fact that in the short term, there's relief in markets. And so we do have some bullish cyclical exposures that we're recommending. But then we're also saying to have defensive exposures in mind as well, because the medium-term outlook is that much more tricky. So at this juncture, we completely appreciate that things are less clear. In the medium.
Well, let's talk about what that yield means for an equity market that, as Matt said, has definitely reflected some optimism about a Fed pivot, but also is trying to relate to what the earnings we have seen. It's been quite a rally, and you have Michael Hartnett over at Bank of America saying essentially that's when you want to fade and take profit on. I'm wondering where you fall into that. Do you think it's a time to buy or a time to sell?
I tend to think that this is a time where probably in this month, if there's an opportunity to take some profits, take them. This seems to me, in short, like a counter trend rally in a bear market. The losses on the S&P 500 have been roughly cut in half over the last 45 days. If you look at the Qs, they're up almost 20%. Rallies like this inside a bear market are pretty common. And if you care
about making based on that.
Right. I think that the message this sends is don't expect a Fed pivot back to a more balanced reaction function anytime soon. The Fed certainly keyed in on reducing inflation and restoring price stability. And in their mind, they have to at least take some of the edge off of the domestic economy and labor markets to do that. We'll see if that ends up being a soft landing or something worse. But yes, I think the stronger the data is, the more the Fed's going to be inclined to lean against it. And they said they need clear and compelling evidence that inflation is on its way back to 2%. So I think a switch from hikes to cuts is premature. I think the Fed will likely be in a restrictive policy stance.
Was that, may have been unfounded, and that we think that
much more difficult. And anybody that thinks this Fed is somehow pivoting, look at these numbers, and I would suggest they can't. And, I have no idea what CPI is going to be, but I also know that inflation doesn't come down on a dime. It takes a long time. So More Fed to me, Tim says it all the time, equals more volatility. I think we've seen the up move in the market. I think
not overly optimistic. They thought the Fed pivoted last week. We don't think that they did. The Fed, I think, continues to the economy down the road. But for now, things look pretty okay.
You know what? I'm wondering, Rob Sechin, if it's time for us to pivot. Forget the Fed. Maybe it's time for everybody to pivot from recession is almost inevitable.
Well, you know, last week on the show, Scott, we pivoted from cautious to cautiously optimistic and thought that this bear market rally, we still think we're in a bear market, had some legs because we saw great measures of momentum and breadth, specifically related to any of the other rallies that we've seen year to date. Investors clearly got too short, too bearish, and the pain trade was higher, and the rally in bonds boosted PE multiples. But interestingly, right now, despite what we've seen this week, all those measures have stalled out or have stopped improving, and now we're sitting at some pretty.
But it's a recipe for them to keep increasing interest rates, and it pushes out that pivot that people were hoping for, where the Fed may start to cut rates in 2023. Not with this job market. Now, the other issue here, of course.
Well, part of the animal spirits in this market, in this equity market, Tom, also have to do with the notion that the Fed is going to pivot eventually. But we saw a bit of a change forming in that idea on Friday when we got that blowout payrolls report. We're now pricing in about 80% odds of another 75 basis point hike come September, which, yes, is a long way away. But the data we get on CPI on Wednesday could be extremely formative in that decision.
Avalara? Oh, yeah. Kaylee, come on. You're the fun of wisdom here. You were on this deal last night at 2 p.m. Seattle, Washington, 4,400 people. Avalar, they provide sales tax management here on Merger Monday.
And Vista Equity buying that company for $93.50 a share in cash. So that makes it, what, Lisa, 4 deals that we have announced?
That we either have announced.
And it'll pull us a little bit more in line with other anecdotal evidence on jobs.
Does that mean you're more in line with the Fed pivot narrative?
Yes, I think the Fed is going to have to pivot. I think the Fed's already gone too far. I think you're seeing inflation roll over. I think you're seeing supply chains fix themselves. But it's the fact that the consumer looks like they're trying to buy things on discount, that you're seeing margin pressure. I think all those are actually going to be relatively, I don't know that we get to the point of being deflationary.
Right.
But I think by the end of this year, we're not talking about inflation anymore.
Peter, it's Inside Baseball Monday. That's what you do when the Padres are swept by the Dodgers. So we're going there. Peter, I think I just heard you say you want to do a collared transaction because we may go long or we may go short. You and I remember long ago when you do like a 6-option trade and Peter Scheer would do an iron collar.
All the way back to 22. So VIX is pretty low given the day-to-day volatility we're seeing. So I think you can trade your way out of it.
Pete, how much is a Fed pivot going to be positive for equities versus negative?
I think it's going to turn out to be more negative at first. I think the realization that the market hasn't hit is the Fed is going to be pivoting because they've pushed too far. So I'm definitely not in the soft landing camp. I think we pushed too far. I think we're seeing the consumer roll over. I think you're seeing inventories build. So when people realize that we're going to have to pivot, the first reaction, yes, maybe we rally, and I think that's the stage we've been in. But then the reality is going to hit like, whoa, we have to be very careful. What are future earnings going to look like? And it's very encouraging to see this kind of Merger Monday because you're seeing companies kind of accept new valuations. But I think we're a long way from being done, especially on the high flyers where they still want to get paid X, the buyers are at Y, and we've got to sort themselves out. And I think, unfortunately, it's going to be close.
Idea that you think that the numbers were too high for the jobs report and that they've got to come down, and you think that the Fed's going to pivot next year. What's going to make them pivot if we're seeing CPI potentially even at 8.7%, which is the consensus, which is still so far above that 2% level?
Yeah, so we think that, look, the labor market right now is very strong. Inflation is very high. But importantly, what's going to get the Fed to pivot is that both of those are going to come down. We do believe that the Fed will be successful at generating a slowdown in the labor market. We do believe that the tightening of financial conditions that we have already seen is likely causing certainly employers to rethink CapEx, employers to rethink hiring plans. And we do think that that's going to manifest itself over time. It's also going to weigh on the consumer, and that's going to help bring down both the elevated inflation that we see today, and it's going to allow for the labor market to ease to some extent. But look, those are two core tenets of our views. And if we're wrong, then the overall level of rates has to be higher in the economy. But we think we will indeed see that slowdown.
happy to buy the dip. That despite that very strong unemployment figure on Friday. That has to have people thinking, can the Fed really afford to pivot down the line?
Yeah, and the Fed keeps telling us that's not what we're going to do, but the market doesn't seem to believe them. In terms of what we're seeing here ahead of the trade, futures are up almost 0.25% right now. There could actually be some relief in this. That the tax bill didn't really, raise taxes. So that's good for markets, right? We see the 2s, 10s now inverted at 41 basis points, negative 41 basis points. It was negative 44 on Friday. This is the biggest inversion that we've seen since the year 2000. So that portends a recession coming. Nonetheless, financial conditions are loosening. And here's a good example of that. NYMEX crude is down another 48 cents a barrel. It's 88.53, now down.
Months or the last 15 months, the last year, talking about how U.S. yields need to go much higher. They're still underpriced. I think the idea of a Fed pivot in the first quarter next year is bonkers or delusional. I think it's crazy. And so even though I'm in that kind of very...
Yields go down. That is not risk on, right? It is a mix of risk on and risk off. And actually what it is, it's sort of all driven by this idea of the Fed pivot, by this idea that real rates, longer dated real rates go down for, much, much longer and much, much further. And therefore, you can sort of start buying anything again, right? You can use the dollar as your funding currency again, and you can buy anything you want, whether it's risk on and risk off. So it leaves you with this very unrealistic Goldilocks scenario where you say, well, growth is going to go down a tiny wee bit, right? But not too strong, so we don't have to be worried about growth. And at the same time, that is already going to be enough to bring inflation down. So that's great. But that also means that the Fed can ultimately save us. And that means higher valuation across the asset classes. And that is exactly where we have issues with.
By the way, if
down a little bit, but not too much. So we don't need to worry about earnings and about growth. But it allows the Fed to already cut rates. But if we go down in terms of rates, if we go down 4, 5, 6 cuts, that actually will be probably in response to much, much weaker growth. And that can't be good for risk assets.
I mean, could we really have Fed cuts realistically in the middle of next year? I mean, doesn't the recession need to be so bad for that to be the scenario, considering, inflation, sure, perhaps it's going to slow down, but I can't imagine it would be so slowed down that it makes sense to start cutting next year.
Yeah, I guess, in terms of the recession probabilities or what kind of trades you put on right now.
Ben, that awful, not as bad as feared. Is what you're saying essentially that too is too optimistic, not just betting on the Fed pivot, but betting that companies are going to be able to hang in there and preserve their margins in this kind of environment?
Well, you just said it, right? Hanging in there. I'm not sure hanging in there is a particularly bullish, thesis, let's put it that way, right? So I'm not particularly sure if I want to go max overweight equities to say, well, you know what, we might hang in there. Doesn't sound great to me, right? So what we have seen in the earnings season now is, yes, sort of average beat rates, average earnings surprise factor, that's fine. But excluding energy, it actually already looks below average, right? So it actually already looks a little bit, a little bit cloudier. And also,
that makes you a little cautious, generally speaking.
Yeah, hi, Kelly. Good to be with you. I think the market is trading on the volatility of when the Fed might pivot. But when we think about the CPI number, especially tomorrow, the question we ask ourselves is the number possibly too hot or too cold that would change the
operate at, and that means it's going to continue raising rates a bit more. The market was probably premature in seeing this so-called Fed pivot.
Is there a danger that the market preempts what the Fed does, so it prices it and then the Fed just has to do more?
Yeah, I think the market's very sensitive to these inflation prints, partly because it overreacted in the other way to sort of suggested pivoting by the Fed. What we see is the Fed raising rates a bit more to close to 4%, 3.75, 4%.
Yeah, they're serious about 75 basis points at the next meeting for sure.
Okay, so clearly the equity market has been betting on that Fed pivot narrative. When you look at the bond market and a yield curve that's inverted by nearly 50 basis points, Ed, how reliable a signal is that?
Well, so what we're focused on is that we want to see lots of the different parts of the yield curve inverting. And the 10-2s is very critical, of course, but we actually look at dozens of different yield curves, corporates, treasuries, different parts. New lows into next year.
Can I hang on to that second scenario of your three bears, Ed, this idea that the Fed will have to pivot? I wonder how likely that is, even if we go into a recession, because I think of Zoltan Pozsar, for example, who points out that the global commodities market, it is just so tight, and that is unlikely to change anytime soon, which again means stubborn inflation. So even if we are in a recession, can the Fed afford to pivot, to start to cut rates when it needs slowed down demand in order?
Yeah, so now we have to talk about the dual mandate, right? You're absolutely right. The Fed needs to focus on inflation, but the Fed also has a mandate of full employment. And so jobless claims have started to tick up, still very low. But if the labor market loosens quite a bit, that would give the Fed some room. And keep in mind that the biggest input for most companies, the vast majority of companies, are wages. And so if the labor market loosens, then that would give the Fed the ability to pivot. And also a pivot could mean, just 25 basis points a meeting, maybe taking a meeting off here or there.
And then more Fed speak and potentially more Fed pushback against the idea of a dovish pivot. San Francisco Fed President Mary Daly will be speaking exclusively to us in an interview at 7:30 p.m. New York time, Matt.
All right, we will definitely be paying very close attention to what she says, because softening inflation data in the U.S. isn't changing the mind of other Federal Reserve officials. Two of them said the central bank will stay on the path towards higher interest rates. Minneapolis Fed President Neil Kashkari, for example, spoke yesterday.
The idea that we are going to start cutting rates early next year when inflation is very likely going to be well in excess of our target, I just think it's not realistic. I think a much more likely scenario is we will raise rates to some point and then we will sit there.
That we've seen back down in yields. My question mark here is how sustainable is this sort of perception of the policy pivot from the Fed really going to be? Because you saw it wasn't just the hawks on the Fed coming out yesterday. It was the Kashkaris of the world, as you rightly highlight, typically one of the more dovish members of the FOMC, still coming out to say, no, we still have more work to do. So if you're buying growth stocks today, I think you're putting very high conviction in the rates market settling down and leading into a lower path of interest rates as we move into next year. That, for me, is just difficult to really put too much weight on at a time where those sort of sticky inflation pressures, particularly coming from shelter and the housing market, look to be quite persistent.
Yeah, if inflation is sticky, how sticky is this rally? Hugh Gimberg, global market.
That price sensitivity, it means, yes, harder trade-offs for firms in terms of margins, but it's also the key ingredient that could allow the Fed to pivot away from extremely tight policy, not soon, but somewhere down the road. So that price sensitivity, that when we look at it, the diffusion index, the number of prices rising versus falling, that was the best number in many months. So to me, that's the encouraging part of the report. We're starting to see normal behavior from consumers, and that's essential.
Of a pivot down the road, but still, finally, we mentioned pivot, Steve. Could we, with this number, actually
of the fundamental backbone of this rally? Is just this a melt up, people getting excited about the idea of a dovish pivot from the Federal Reserve because inflation is cooler, but that doesn't make inflation cool. And on the producer prices, if you're still dealing with those higher input costs and a lack of ability to pass that on, that doesn't leave corporate America in a brilliant place.
Yeah, certainly it's leaving the market in a better place. And right now, Tom, we're seeing the revenge of the 60-40 with bonds and stocks rally. You could argue which has been seeing a bigger rally, but nonetheless, it is broad and it is sticky.
No question about that. And I like how you bring up the 60-40 because it's been out of favor, to say the least.
Yeah, and what we're seeing today is yields coming down across the yield curve, although you're seeing a lesser inversion. 10-year yields 2.74%.
Going from the Fed pivot of just a year ago being that's one of the most aggressive pivots in Fed policy. So you're going to have asset prices disrupted, and we've had that, right? Well, so I think right now that is in. And so whether we get 50 basis points, 75 basis points, or 0 basis points in cuts in 23, I think as long as we can look at something that's resembling some sort of stability in the bond market, that's almost more important than what the average expectation for Eurodollars.
Michael, how much do you take a look at this idea that you had the biggest increase in food prices going back to 1979? Rents are surging. You see areas in non-discretionary spending that are crimping the average American household balance sheet, and that has yet to fully play out. How do you factor that?
Still be open-minded that they may have a little bit more work to do ultimately.
Yeah, I mean, we can define what a Fed pivot would be, but that might actually qualify relative to where we were thinking about, in the stagflation moment of a few months ago, that in fact it was going to be, unending, well beyond 4%. So you think that's priced in at this point? I mean, you mentioned it's hard to get from 5 to 3. We're not at 5 yet, really, in terms of inflation. Where would equities be at 5? I guess that's the question of whether we've already priced in the good scenario.
One interesting way to look at this is to think about it through the prism of financial conditions, which is how we think the Fed transmits their policy. The interesting thing
was, we're going to tighten less or slower. It was Fed pivots where you actually saw liquidity start to get more abundant in the market. So you saw measures like money supply growth start to reaccelerate. And what that did is that supported valuations moving higher. But the Fed has been very vocal, even with this rally since the July meeting, that they're not inclined to cut rates early in 2023. So we struggle to see how this is the pivot that actually adds liquidity and supports us moving to much higher valuations.
Right. Absolute distinction. We still have the Fed that's vigilant and is seeming like perhaps could be emboldened by what markets have done to do a little bit more, perhaps.
Well, certainly, because the Fed has said that they want to see financial conditions tighten. That's how they.
I think the critical data, in addition to what you just mentioned, Christina, is going to be the employee cost index, that ECI. Right? We know the labor market is very tight, and we're concerned, right, that wages are going to continue to rise, and that's going to put a floor really under price inflation as those bleed through into prices from firms. And we're seeing that a lot. We're seeing firms actually be pretty successful at raising prices in the face of those higher costs. So, if job openings drop and some of the heat comes out of the labor market and we don't get as large increases in wages and overall,
it's going to be a little bit easier for the Fed to execute a soft landing, but that would mean that the Fed needs to pivot to a less hawkish tightening stance sooner rather than later.
Do you agree with that, Joanne? What do you think about the chances of a recession?
Well, I think it's probably the case that things got a little bit brighter in terms of the outlook with the data we got this week, with those inflation numbers coming in below expectations. Clearly, short-term interest rates can go up, even significantly, without triggering an inflation. What we're watching is really the longer-term interest rates, right? So the yield curve being inverted doesn't surprise us. It seems actually kind of a natural outcome of the Fed trying to deal with what hopefully will be a short-term inflation problem. So you have, the shorter-term interest rates.
What's the next pivot point then for equity traders that are looking to the Fed?
Look, I think the next pivot point is obviously the next Fed meeting. That said, most people are largely anticipating somewhere between 50 and 75 basis points over the next meeting. The really big question marks come into play into the end of this year, because there are a lot of folks that think the Fed won't hike pre-midterm election. There are a lot of folks that are counting on economic data sort of deteriorating significantly following Labor Day, and that creates something of a pause at the Fed by early 2023. Will that actually happen is a huge question mark. The Fed themselves also appears to be getting a little bit frustrated with the degree to which the market has traded post the last Fed meeting, and is being very vocal in suggesting we are not going to drop the ball on this. We have
the fact that the terminal rate is probably not 5 or 6%. It's probably 3 or 4%.
But Lisa, the Fed has said we haven't pivoted. No pivots going on here. And basically we're expecting that to hear that in the minutes. Is that going to reverse some of the spread tightening that we've seen?
I think it will. I think that the market narrative shifted a bit, and that lower vol regime is positive for risk assets. And especially it's more positive when sentiment had gone so far off sides. I mean, we look at that Credit Suisse panic euphoria index. It was -5 panic for months almost. Now it's back actually in positive territory. So there was a massive swing in sentiment. I think that, coupled with that perception that the Fed became a bit more perhaps dovish, led to
from the Fed. So as equities were coming down, the dollar would strengthen further, the pivot would come, the dollar would reverse. But we haven't had that. Financial conditions are easing. Now, the Fed will never come out and say they don't want to see the equity markets moving higher, but ultimately it's complicating what they need to do.
They've come close
and I
to
think it's
saying
going to result in short-term rate expectations lurching higher. The data is actually picking up as well. Gasoline prices are down from $5 to $4. That's $4, That's a big impact for consumer confidence, and maybe the retail sales data this week is going to be stronger than expected.
If we were having this discussion at 36.50, completely different discussion, right? At that point, you're a contrarian. You're talking about a Fed pivot. You're talking about a softer landing. you're clearly, out in the kind of boonies by yourselves. Now, it's pretty much the consensus trade, right, is that, the Fed's got it figured out, inflation will come down, and, we're right back to all the memes, SPAC, crypto, trades working again. So at this point, I think the contrarian trade, much like the one from mid-June, was, is to fade this. And again, that's not to say that we don't see upside to our 2023 target. We've got a $4,400, target on the S&P for the end of 23. But from here, I would say that probably the next 10%, it's much more likely.
I think lower growth and just kind of checking those expectations at the door is going to be important for the next 6 to 12 months. And then once the Fed pivots, we can start to have a new conversation from there.
Sylvia, if you're taking a fresh look at what you own or might own at this point after all these moves we've seen, what looks relatively better or worse to you?
Yeah, so I still like the mega cap tech names, the Apple, Microsoft, Amazon, Google types of names. I think that they have strong balance sheets. They have, secular growth participation in the future. Just absolutely.
At least several factors that are really a problem right now.
I think it's too early to be discounting Fed cuts.
So markets expecting a pivot in the Fed cutting rates next year, to me, sounds delusional.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kaylee Lines.
Of the descent and how rapid it will be. Why is it not too early to be betting on a dovish pivot from central banks, including the Federal Reserve?
Well, because it's similar to what we had during COVID, where we're asking ourselves, are we going to have a U-shaped, V-shaped, L-shaped recovery? Today, we're asking ourselves, are we going to have an inverted V inflation peak, or is it an inverted L or a U? And I think this is why there's still uncertainty as to the path with which inflation would normalize. But I think it is interesting to notice that the earnings season was not as bad as what most people feared. We had overall decent numbers, and also unemployment or the latest non-farm payroll was pretty strong. So net, I think things are not as bad as they seem. And
embracing this imminent Fed pivot that is helping to support the risk rally in the short term.
Fed pivot. We see Morgan Stanley and JP Morgan disagreeing on the nature of this rally, or is it just a pause in the bear market?
We could see a bounce in that cyclicality as rates begin to increase. And the reason why rates could increase is the Fed it's not pivoting, but it's decelerating, right? And so people will believe that the economy is coming back in. You heard the comments from Walmart. Things are okay. They're not terrible. They're not great. They're okay. And that could let the door back open for some of these cyclicals. The problem with the broader equity market is it's a growth market. And if rates go higher, one of the reasons why we were positive on growth is lower rates. That could cut.
Climbing over.
Yeah, because this market is now betting on a dovish pivot from the Federal Reserve that Federal Reserve officials themselves have said is not coming. So I wonder when we get the minutes today, even though they are backward looking and so much has changed since that July meeting in terms of inflation cooling down and some of the other data points we've gotten, including that jobs report, is this a Fed that underneath the surface is really that much more hawkish despite some of the dovish messaging maybe that was accidentally conveyed by Jerome Powell at the press conference? Does that have the power to shift the tone in this equity market that just keeps running?
3-day winning streak on the S&P up by about 17.5%.
With an earnings season that by and large also has been a lot better than expected. You're seeing surprises on both the top and bottom line consistently. And I wonder how much of this actually is fundamental and not too much optimism being priced in now, but too much pessimism being priced in before.
Yeah, I'm in the camp that we had too much pessimism going into the second quarter reporting season. Almost by definition, when you have inflation that's too high, you've got companies that have pricing power. They're able to increase prices, which ultimately keeps that inflation number high and keeps that narrative going out there. It's really once we get to a much more significant slowing.
The idea is that sentiment has improved, basically all predicated on this hope that we're going to get a dovish pivot from the Federal Reserve, that we've seen both peak inflation and peak central bank hawkishness, which is going to make the data this morning very important and a lot more important for the Fed minutes coming at 2 p.m. Eastern time as well.
What was great, John, Dovish Pivot was a bar band down at UVA. They played Dave Matthews like nobody.
Is that the name of the bar?
Yeah.
Or
no,
the band?
The band was Dovish Pivot.
Okay.
They were really good.
Hawkish turn?
Sensitive.
Is that a good
they were
band?
Sensitive.
Were they opening for Dovish Pivot? Okay. All right, enough of that. Futures are down by 6 or 7/10% on the S&P. On the Nasdaq 100, we're down about 0.75%. Kaylee's going to guide you through the day ahead.
The biggest part of what we'll be looking into is the market behavior with any expectation of changes in the inflation dynamics. And I think the biggest thing is while inflation is coming down, still the high levels are pretty high. And as we can see,
the rise in the market recently, I mean, we have had a significant rise as there's been a pivot, at least among investors, maybe not economists, about what the Fed may do and what inflation is going to look like come this fall.
I think, the market seems to be pricing in a soft landing as being the default scenario, with very few data points to support it. Is not very uncommon as we go into the late.
Kaylee Lines pulling the short straw this morning and joining us. John, Andrew Sheets coming up. His note is absolutely brilliant and how the Fed pivot will stop this bull market.
He does not think we'll get that durable pause anytime soon. He's skeptical of the rally that we've seen, and that's been the team over at Morgan Stanley now, Tom, for quite a while. But this rally, it's long in the tooth now, isn't it, TK? It's a move of about 17% off the lows in June, and this Federal Reserve has at times pushed back and said we've got more work to do, and this market has carried on fading that story. Next big stop is Jackson Hole next week.
Well, Jackson Hole next week, and I wonder if when Powell speaks, obviously he's central banker to Wyoming and the United States of America, but how does the international scene color what he will talk about? We see that this morning, John, in the shock of Turkey, and far more importantly, the 3% shock.
Bloomberg economy reporter Michelle Jamrisco joins us now for more. So, Michelle, what did we learn? Were the Fed minutes dovish? Was there a pivot, or are they continuing to be hawkish on inflation?
Well, Matt, there was something for everyone in here, which makes it a little bit problematic. But we did get some insights in the minutes in that tricky balance the Fed needs to strike right now. On the one hand, as you mentioned, they do mention the slowness or the slowing in the pace of the rate hikes going forward. They do say at some point. They don't give us much detail on the timing, of course. And they also mention, and interestingly enough, that they're concerned about the possibility of overdoing it on the rate hikes. You must remember we only just started this rate hike cycle in March at a quarter.
Believe that the Fed can really pivot to dovishness?
No, I don't think so yet. I mean, the slowdown inflation was mostly in headline. Headline was flat. So we know that the impact of energy will diminish over time in those inflation numbers. And energy is a big driver, but not the main driver, especially in the US. In Europe, it's a bit more driven by energy and a bit less by core. But when you look at some of those more sticky components, rents, owner's equivalent rents, so the shelter components, some other sticky components, they're still pretty high. They're still 6% around year on year and 8% on a 3-month annualized.
Last week by the Fed, by the chairman, but these minutes did make clear there is some support on the committee for really looking over your back.
Here, and defensives would do better in that kind of environment.
Is that what you got from the July FOMC minutes as well, that we're not going to see the Fed pivot that a lot of market participants have been expecting?
The market seemed to like the minutes on balance because it started going up.
Offered a little bit of glimmer of hope to the crowd that is hoping that the Fed pivots, although we gave some of that back. Do you think the market is still in an uptrend, or are you preparing?
Make us change our mind at all. So we think a 75 basis point hike is likely.
Adding down this concept of a Fed pivot.
Yeah, I wouldn't be so sure about that. Nonetheless, we do see futures down this morning. The market does seem to me very determined that the Fed doesn't know what it's talking about. Right now, we see S&P futures down about 0.7%. That is the Fed speak coming through that we saw last night. Jim Bullard saying, no, we really do want to go 75 at the next meeting. And the 10-year yield is getting sold off. So we see that rate rising back towards 3%. Right now at 292.62. A little bit of conflicting market moves there, but that's nothing new. We've seen that pretty much every day. And I want to point out also that we've seen a lot of turnarounds, right? Yesterday,
But over the last week, obviously, we had some buybacks going on. We had the CPI report that people kind of thought was going to be a pivot for the Fed. I'm kind of the party pooper in that situation. I don't believe that at all. I don't think we're going to see a Fed pivot. But yet you've got rising interest rates. You've got fears of recession, especially in Europe. You've got earnings valuations starting to come down for this.
maybe overly pessimistic. And now as things start to turn in a more optimistic direction, whether it's about a dovish pivot from the Federal Reserve or earnings that weren't that bad, all of that positioning had to unwind to a certain extent. So if he thinks that he has further to go, he thinks that's going to drive us up to 4,800 year end. And we know that there are plenty out there who he may or may not be speaking to who are well below that, John.
Kelsey Barrow, I think, nailed it yesterday on this program. She said the big difference between the market and this Fed is 2023. The market's looking for cuts. The Fed's saying it's a hold strategy. President Daly, the San Francisco Fed, addressed this yesterday, Tom. I really think of the raise and hold strategy as one that has historically paid off for us. So we get the hold part of this. It's the race to what? Race to what on hold, Tom? And maybe we get some indication of that from Chairman Powell.
We'll see if he does it.
Yeah, so if there's a mispricing in the equity market that's too optimistic about the Fed pivot, what about the bond market? Because we have seen yields moving pretty substantially higher off the lows. I mean, we're back at 293 on the 10-year. What's appropriate given your expectations of Fed policy?
Yeah, look, I think when you look historically, you've never gotten high inflation under control without a federal funds rate that exceeds the inflation rate. Now, I don't think we're going to 10%. I think inflation will come down as the economy slows. But you've got to start, the market has only allowed itself to price in 375 in terms of the terminal rate here. I think that number's probably got to go closer to 4.5. And so as the market prices that in
his comments, there was a little bit of a back and forth once the market started pricing in kind of this early pivot. A lot of the Fed chairs came out and said, wait a second, we're going to stick to our guns, so to speak, as it relates to inflation. So I think crypto markets in particular have been very sensitive to that. And they're going to look for any signs that the Fed, might be more or less hawkish relative to kind of where the market is right now.
So you mentioned that pending regulation is also potentially moving crypto prices right now. What about the news out of the FDIC? They issued those 5 letters, including to FTX US, saying that these crypto companies were allegedly mischaracterizing their relationship with the FDIC, with the way that customer deposits were insured. How significant?
There's a lot of people out there saying that depending on how bad the outlook looks for a potential Fed pivot, what Powell's comments look like on Friday, what the rest of the world looks like, 15,000 Bitcoin isn't off the table. But I do think 18,000, looks pretty reasonable for now in terms of a support.
So what's the state of altcoins right now? Bitcoin is down something like 12% in the past week, but you have altcoins like Cardano down 20%, Solana 22%. Are they more at risk in this downturn?
Absolutely. I mean, anytime you have risk appetite like this dry up, the altcoins are the first to suffer. And it's, they're just the small cap of the crypto space. So it makes sense. You layer on top of that, a lot of these kind of headline hacks that we've been reading about, some of these network outs. Again, a lot of course hinges on the macro environment and kind of where the market's discounting, the Fed pivot or the timing of the Fed pivot, or if there even is a Fed pivot. But I'd be surprised if Bitcoin isn't at, closer to 30,000 by year end. One kind of thing we saw with the rally over the last couple of weeks was it was a different type of buying. It was generally kind of broader in conviction. It was the kind of buying that you like to see before the start of a long-term rally. Of course, macro concerns have pulled that down. And as a result, a lot of institutional investors, including ourselves, have ratcheted back the cash. But I'd be surprised if, as we start to chop through some of this wood going into the back half of the year, there's a little bit more clarity going into 2023. A risk rally could very easily push Bitcoin, up to or past 30,000 in my mind.
Back toward large cap growth and doing away with short-term credit as they attempt to navigate a possible Fed pivot. Joining us now to break down the trends is Tom Lydon, Vice Chairman at VettaFi, Matt Bartolini, Head of Spider America's Research at State Street, and Tim Johnson, Blue Horizon Capital Partner and co-founder of Cycle. Guys, thank you so much for being here. It's definitely the trifecta today. Matt, let's start with you.
Hear it from this man's mouth. Problem is, Wall Street's starting to have less confidence in the idea that the Fed will soon pivot to a more dovish posture. I think Jay Powell can afford to be a little less ruthless with the rate hikes here, but the market clearly disagrees. We'll find out who's right on Friday. We need to slog through the whole week, though, to get to the Fed's guillotine. But even if the guillotine blade falls, we can ride through the turbulence.
Well, I think it's important to look at where we started the year. We started the year with a 21.5 multiple. And with the Fed pivoting very hawkishly at the beginning of the year, interest rates rising, volatility picking up, that environment really removed a lot of the excesses that we were seeing in valuations to the point where we troughed somewhere under 16. Now, why is that important? Because we've really reset the base there on valuations. And I think what that does is it really puts in a floor on how much lower we can go. The question then becomes what happens with corporate profitability. And then we look out and we see profits still remain quite intact. We're still going to see growth for the back half of this year. 2Q came in much better than feared for investors. So I think the outlook here is for the ability for the markets to continue to move higher unless we see a recession risk really.
To be honest with you, three things happened at once, though. I think the view that we were in a Fed pivot, probably highly supported by what Jerome Powell said. And my belief is that he probably misspoke and probably got a call from James Bullard as soon as he got off the podium. But that was combined with what Adam said earlier, earnings coming in, revised down about 3%. And I think that was also combined, that green light, that pivot, with this talk of this strong labor market and a strong consumer balance sheet. Both conversations we can get into, whether those are as strong as we thought, and if there's going to be any.
Well, I think the market's just been looking at the Fed, and we had that CPI number and the market pricing a Fed dovish pivot, which kind of has come out the price a little bit. We've seen the rate cuts for next year. At one stage, there was 75 basis points priced in. That's now eased off quite a bit more. It's below 50 basis points, I think, this morning. Essentially, the markets are feeling pretty yellow about the Eurozone, but it's only credit that seems to be reflecting it. And eventually, it will feed through to the other markets. It happens all the time. Markets are not perfect. They're not always rational. And they just sometimes need to be given the alarm bells, such as the ECB, for example. Do we really think they're going to keep raising rates next year if there's blackouts in Germany? So that could be one of those trigger.
Stocks rallied to begin with on a false narrative. The narrative being that Fed's pivoting. They're going to pivot, or at least they're at the beginning of the end of the rate hike cycle. Stocks are up 8% since the Powell presser on July 27th. That's before today's move. Was it a false narrative? Should stocks have been up the way they were after Powell or not?
There's a lot to unpack in what you just said. Let me start with what you asked. Is it a false narrative regarding the Fed? My fundamental thesis, okay, Joe, you did a great job last week when I asked you to explain the technicals and the quants. I thank you for that. I respect technicals, but I am a fundamental analyst. And I look at this and I say, the rally is not based on the idea of a Fed cut. Pause for effect. It's not based on the perception.
Speakers have been consistent about there is no continue to get. Now, there is still debate or lack and how quickly, but I think everyone has been unanimous about the idea that if a pivot next year is just completely bonkers, and then therefore that has been slowly priced out. We still have this divergence between what the market is pricing. The Fed is very, very unlikely to pivot next year.
That kind of bear market and then that kind of momentum turn higher. All of them were associated with a Fed that not only might have thought about pivoting, but actually pivoting and was lowering interest rates. So that really is the solution here to the dilemma on a faster real pivot from the Fed.
Because that was, I don't know whether you heard our previous discussion. We're a long way from where the Fed could be forced to not pivot. I mean, if you go back and we worry about the 70s and the 80s and the stop-start that the Fed did back then, where it thought it had conquered inflation, and it hadn't, only to come back with a vengeance till Volcker came along and really drove a stake in it. So these guys, they know that, guys and gals, and they're probably ready to not blink.
Overnight rate that moves in line with the Fed's benchmark. That position will benefit if Fed Chair Jerome Powell effectively rules out a dovish pivot when he speaks at this week's symposium. So clearly, Creedy, all of us are waiting for that speech from Chairman Powell around 10 a.m. Eastern time on Friday. And yet we are seeing really decisive moves and repositioning in the market in anticipation of it. People aren't just waiting for what he has to say.
And you know what I think is so fascinating here is that this is a hedge fund trade, by the way, that is the exact opposite of the way the market interpreted the last comments that you really saw. This dovish pivot that it seemed like the stock market was rallying off. But at the end of the day, it's actually this interesting turnaround that, Anna, this seems like people are saying, well, actually, not only are they going to be not dovish, they're going to be even.
maybe there's a pause at some point. Maybe there could be a pause, but there's no pivot. I think the Federal Reserve has done a really good job in communicating that. But if he puts things on the table on Friday that suggest, look, 75 basis points. We told you in the press conference in July, 75 basis points. That's highly unusual for the Federal Reserve. Don't get comfortable with us doing that at every meeting. If he kind of hints that, well, maybe we are going to be consistently giving you 75-point hikes in the coming meetings, that's overwhelmingly hawkish. You're not going back up to the 200-day moving average at that point.
All right, so Jan Hatzius, Goldman Sachs, a little while ago, quote, we expect Powell to reiterate the case for slowing the pace of tightening laid out in his July press conference and the July.
Overly optimistic, but in a rising interest rate environment, don't you have to worry about multiple contraction on the earnings that you just said were going to be not stellar? So then you got to apply a lower multiple, too. So I don't even see how 3,500...
Never really did pivot. Let's put it that way. I think at the end of the day, what people are looking for here, Lisa, they're looking for a shift lower from a 75 down to a 50 to a 25 and hopefully a pause. And then the market's looking at cuts next year. And that's the big difference between the market and this Federal Reserve. A market that's looking for cuts next year and a Federal Reserve that's talking about raise and hold.
Okay, but here's my favorite part about markets. Everyone's anticipating a hawkish message.
The Fed is not going to pivot because the playbook they're following is the 1970s of pivoting too soon, and that led to a resurgence of inflation that caused Volcker to have to tank the economy into a double-dip recession, as everybody knows, in the late 70s, early 80s. So I think that's the playbook they're playing. I am totally not expecting anything dovish out of Jackson Hole on Friday, and I think the rally's just gotten a little bit ahead of itself, frankly.
Hey, Steve, awesome to catch up. Steve Orth there of Federated Hermes with a very, very different perspective relative to what we've heard from him, Tom, for the last decade or so.
Yeah, really, we want to emphasize to people, we talk to these guests time and time again, and that is a new Stephen Orth.
Brilliant lineup this morning. We'll catch up with Jan Hatzius at Goldman Sachs at 7 a.m.
Benchmark. That position will benefit if Fed Chair Jerome Powell effectively rules out a dovish pivot when he speaks at this week's symposium. And the price of U.S. natural gas rose above $10 per million BTUs for the first time since 2008. That extends a rally driven by concerns that global stockpiles aren't enough to meet winter demand. In the U.S., inventories are well below normal after summer heat boosted electricity demand. Meanwhile, production has grown only modestly. And life expectancy in New York plummeted by 3 years in 2020. The CDC says that was the biggest decline among all states in the first year of the COVID pandemic. Residents of New York are expected to live to just under 78, the 15th highest life expectancy in the country. Overall, U.S. life expectancy plunged by 1.8 years in 2020. That is the biggest drop.
And that's where you get into the 3-year regime.
You've raised it a few times, Tom, and I totally agree with you. We're talking about a Fed pivot just because we've seen year-over-year inflation peak potentially a little north of 9%. Lisa, it's a big change.
Well, and this is the reason why people say that there is no pivot. I want to go back, though, to what Jan Hatzius is saying. Basically, his implication is that this economy is a lot less interest rate sensitive than people thought, that it can withstand a 3.5% to 4% interest rate for a prolonged period of time without getting torpedoed. This goes against the conventional wisdom of the low rate whole decades, and I find that fascinating.
Does he call it petrol, though? Find that out.
He doesn't.
Find that out.
No.
That's the important piece of this.
John.
Yeah.
Is this what you're going to die on?
Of JP Morgan optimism from Marko Kolanovic. Here's the quote. Inflation will resolve on its own as distortions fade and likely drive a Fed pivot. A stronger second half recovery in China should provide support for the global cycle in combination with still very low investor positioning creates a positive environment.
There it is.
That's the latest from Kolanovic over at JP Morgan, Tom.
John, moments ago, Andrew Hollenhorst, of course, going decidedly the other way, says stop focusing on Powell's speech. It's a quote-unquote a hawkish month. They are adamant that a combination of what Powell will say and the mystery of the data to come should be aggregated together.
Still got payrolls to come before that next meeting.
Yeah.
Got August
inflation
payrolls.
Too.
You've got inflation, I think, on September 13th. Lisa,
so that's right.
The road to September in that September meeting is still a long one.
I have a question for you.
Sure.
Are you
rules out a dovish pivot when he speaks at this week's symposium? And the price of U.S. natural gas rose above $10 per million BTUs for the first time since 2008. That extends a rally driven by concerns that global stockpiles aren't enough to meet winter demand. In the U.S., inventories are well below normal after summer heat boosted electricity demand. Meanwhile, production has grown only modestly. And Macy's has cut its profit outlook for the full year. The guidance missed the average analyst estimate. Still, the department store operator also posted second quarter earnings that were better than expected. Like its peers, Macy's is contending with shifting consumer preferences and shrinking budgets at a time of decades high inflation. Global News 24.
Well, and honestly, though, we've shed a lot of sarcasm around the pivot that wasn't, right? That the Fed didn't really actually create a huge change in tone. However, they did recognize that perhaps they have to wait a little bit longer and be prudent and not over-tighten before they see the ramifications of their policy. And that in and of itself could be considered dovish, given an 8.5% inflation rate. So I think that that's the push-pull here. How do they not give nod to that, but still seem like they're aware of all sides of the debate?
Did you ever think you'd call Neil Kashkari, Tom, a hawk?
No, I did not.
The Fed?
No, this is important. He's been a good friend of the show and all that. But, John, I really never thought I'd see the shift we see. John, I have huge trouble with the word pivot, whether it was President Obama.
Consider a pivot, but let's talk about what's changed in the market in the last couple of weeks. Back in July, the Fed said that they would abandon forward guidance, which is a fancy way of saying they're going to tell you what they're going to do before they do it. They're going to be data dependent. And the market thought, good, you're going to see data that's going to give you reason to stop raising rates by the end of the year and start cutting rates by the middle of the next year. In the last couple of weeks, there's been some doubt cast on whether or not that.
Hey, Jim, it's Karen. Thanks for being on. I completely agree with you about the pivot. But what is it that you think that the Fed needs to see in terms of inflation or bad, I guess, recession economic data that would make them pivot?
I think the focus is going to turn to core inflation, because if you look at year over year core, there's a possibility in the next 60 days, the next 2 months, that could make a new high. The old high is 6.5% year over year set in March. If it doesn't make a new high, we're going to come very close to it. I think they have to see that data start to come down, because right now what we're seeing in headline inflation is just crude oil, and more specifically gasoline, as I've joked, start to consider a pivot. And it's way too early to say that.
Jim, when I was reading your notes, what stood out to me is a comment that you said, we're not going back to the pre-COVID economy. Explain what that means. And obviously, we have a Fed that's going to be in a very different place. We have a market that probably doesn't have that Fed put. But what about the economy?
You hear a lot of people talk about when the economy returns to normal. It is normal right now. This is the post-COVID normal. Post-COVID is a different economy. We're not going back to the way that things worked in 2019. And that specifically, I mean, work from home, our consumption basket has changed, and a lot of other things have changed.
It would cause the Fed to really pivot in the way the markets would appreciate is something really bad for risk assets. So be careful what you wish for. A pivot
can happen next year, but they're definitely not pivoting anytime soon. So I think what people are getting wrong is, the last 25 years, CPI inflation never went above 2.5%, even in expansions, even in bull markets, boom economies. So the Fed was able to just focus on the unemployment rate. And as soon as it went up, they eased. That's not going to happen this time, because the inflation rate is going to be sticky. And as the unemployment rate goes up, the Fed's still going to have to keep.
As you suggest, and the Fed too likely pivot, as you write. Why would I want to stay away from large cap tech, as you suggest? That doesn't make sense to me.
Yeah.
Why?
We like value. We like cyclicals. We like value. We like some.
We've yet to see the worst. And I think for our view here, I think the point would be that the markets have been reacting as if the Fed is on the verge of pivoting. We think ultimately they will pivot, but we don't think we've seen the signs yet to suggest that's coming right now.
My concern, I understand that the central bank, in general, actually, central banks are in a really tough place. But it does seem like, they're reacting to data point, which means that they don't really have control of the narrative. Is this us really coming to the limit of what central banks can do when it's a
Had a tremendous summer rally in both European and U.S. stocks, and that rally was mainly driven by expectations that the Fed will pivot and become more dovish considering the recession risks and some of the poor economic data. Well, now those expectations are being dimmed, and now the market is thinking that actually Powell's speech on Friday will be quite hawkish, and after Kashkari's statements, we are expecting now in the market that the Fed will continue with its hawkish stance.
All right. Well, we will have to continue to watch how these markets behave into Powell's speech on Friday. Bloomberg's Ksenia Galuzhko, thank you so much. And of course, beginning tomorrow, surveillance will be in Wyoming for the Fed's annual symposium in Jackson Hole. Our special coverage will kick off at 6 a.m. New York time, 11 a.m. in London. Tom, John, and Lisa will see you there.
Having about whether this Fed chair will speak to markets, what he will say about their enthusiasm about some sort of pivot or some sort of pause in Fed rate hikes.
Well, I think the message he could give, going back to the point I said about candor, about where we have to go, is what it would take to reduce inflation. I don't think he's literally going to lecture the markets and say the stock market's too high or something like that. But I think he could outline a path that says we have work to do. Getting that work done requires tighter financial conditions. Speaking in general terms, I think that would be wise to make that kind of communication to the public.
How this market has been priced over the last couple of months or so, and the communication they're offering. How many times have you heard pivot, Fed pivot, from market participants? I don't ever hear that from Fed officials.
What I want to hear, and Mohamed El-Erian, I'm sure, will weigh in on this, does this reflect the lack of credibility that this Federal Reserve has with the market? The market saying, you guys are not understanding the weakness. We don't buy it. We know you're just trying to signal to us. But just wait. Next year, we're going to see that weakness trickle through, and we still, on the margins, believe in a transitory story. How much is that what we're going to hear?
I talked to President George last night over a quiet dinner at the Pioneer Grill, and she's really considering getting a dog in Kansas City. And she's going to name it Pivot.
I actually heard you tell her that.
No.
The Fed solution, and I happen to agree with it, is slow the economy down.
I do think the Fed is going to push back on all this chatter about pivots.
I think Chair Powell needs to do a bit better in expressing more some candor about the past, not necessarily mea culpa, but for what happened, and about the future.
It's very important that we are clear in our communication about the destination we're headed.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Countdown to Powell. The Fed chair will be under pressure to hit all the right notes in today's Jackson Hole speech, as some of his colleagues stress the need to move onwards and upwards with rates. UK regulator Ofgem triples the price of winter for many households with a
early as the beginning of next year.
Fed futures potentially put pricing in a cut in February, but a lot of that has pulled back from some of the comments that have come from many of the Fed governors. And so I think the market is trying to time out an easing, but this isn't, I don't think that's the message that's going to be broadcast today, and that hasn't been the message that we've been hearing from the Fed governors.
So you both have different opinions about what comes next and how calm or not calm the markets are going to be about it. AJ, why don't you talk about your strategy? If you think that a pullback is to come, where
follow that spectrum?
Well, I do think that because of the forward guidance that the Fed gave when it pivoted, you saw the financial markets react probably sooner and more sharply than typically. But that doesn't necessarily mean that the real economy is going to, the effect of the policy changes on the real economy are going to happen faster. So I think I'm agnostic on that. And even when we say long and variable lags, it's the long and variable part. So 6 months to 18 months is still a long time. So that isn't really a frame that I'm using to sort of determine where I think appropriate policy is. Rather, I'm going to be looking at the data and what it's informing me about the outlook. So I know a lot of people say, well, why are you looking at data that's past, talking about the past and not looking forward?
It's going to prove more sticky than the Fed anticipates right now.
I do think the Fed is going to push back on all this chatter about pivots.
The Fed just can't wait to let inflation work itself out.
I think the Fed solution is slow the economy down. It's growing faster than can possibly be sustained long term.
We have to get interest rates higher to slow down demand and bring inflation back to our target.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from Jackson Hole, Wyoming this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Coming up later this morning, Chairman Powell, 10 a.m. Eastern Time. That's 8 a.m. local. TK, we've been waiting for this one for a number of weeks.
That it's going to have to pivot later. There's a certain hubris inside of that, which is to say that they know that this person or even the market knows better what the Fed is going to have to do than the Fed itself. But then I sort of talked about that with a Fed official today, and the person said, well, can you blame them? And this Fed official was referencing the sort of pivots that the Fed has made of recently. If you remember, it was we're not thinking about cutting rates, and so or hiking rates, and then they announced these series of rate hikes, and then they bumped it up, and then they had one idea about how fast to reduce the balance sheet, and they bumped that up too. So there has been some back and forth from the Fed, and I think, Dom, when you asked that question about credibility, and then Greg made the point about how short the speech was, I do think perhaps there's an effort here.
Can I just make a quick
okay. Greg, last word to you here.
Sure. So I think going to that comment, Steve, that you said the Fed doesn't know it has to pivot, there's a Hall of Mirrors factor here, which is the more the market rallies, the easier financial conditions get, the more the Fed has to tighten. So the stock market doesn't realize it, but the stock market selling off the way it did is a necessary but not sufficient condition for the Fed to evaluate.
Clear and really just to the point in terms of what the Fed's intentions are. The Fed is not about to pivot towards a lower interest rate environment. It's not about to pivot towards a loosening of monetary policy. It wants to keep tightening monetary policy. It is considering the possibility of doing so at a slower pace. That was mentioned in today's speech. But what was clear here is that there is really no desire to pivot towards looser monetary policy. And the fact that
a much more significant deterioration in the economy. And for now, we haven't seen that. So it wasn't a surprise to see him really forcefully push back against the idea.
It was Wednesday evening with President George about Pivot the dog, which is her new puppy at the Kansas City Fed. John, this was one giant anti-pivot, and it continues this morning.
And that's exactly what Evercore are calling it, Tom. One priority, get inflation down. And
then still have a misplaced faith in a Fed pivot?
Yeah, I think that's very kind of optimistic. I think if the Fed is going to pivot, it's probably not going to happen exactly as the market thinks, certainly when it thinks it's going to happen. So I think it is misplaced still, yeah.
OK, Simon, thanks so much for joining us. Good to get your perspective. Simon White of Bloomberg Markets Live. And for more market analysis, check out the Markets Live blog. You'll find postings by Simon and the rest of the team. MLIV Go, that is the function to use on your Bloomberg terminal. This is Bloomberg.
We're looking a little bit better about this Fed pivot or whatever. But is it going to be a complete unwind?
With this massive, suppression of interest rates, massive dovish pivot from the Fed, you looked at ARKK, a lot of speculative tech stocks going to very, very aggressive levels. Well, Bitcoin was also part of that as well. And so I think it is going to be very vulnerable to Fed hawkishness. And one issue is that because it's, again, I come back to this thing that it hasn't demonstrated its utility as an inflation hedge. So I question, if you really just need a levered play on the NASDAQ, well, there's a whole lot of ways to do that, right? And I think the question about how you really value Bitcoin at 15,000 or 10,000 is going to be really, really problematic. But
Trend now will settle in around 4% throughout all of next calendar year. And so that takes away the Fed put, and it takes away the Fed pivot. And the markets haven't priced that in yet, because if you keep rates higher for longer, it means the recession won't be V-shaped because the Fed will not be easing into a recession, as they always do when recessions hit.
The market has that wrong, you said.
But the market has that wrong. But the Fed will maintain the higher rates as you're in a recession in order to bring inflation down. And they're going to do that, and they said they're going to do that. And it's all about Powell's plan that he talked about at
He told
Jackson
us to expect
Hole.
pain.
Expect pain for consumer and businesses. So you take a survey of the consumer confidence, and you take a survey of CEO confidence, and the CEOs have a real good insight as to what's happening with their companies. 81% of these CEOs now think
the Fed is going to pivot. It's probably not going to happen exactly as the market thinks, certainly when it thinks it's going to happen.
The one thing that
the market is not pricing in, and we have to be really honest about this, is everyone was looking at what is the Fed going to do? Is there a pivot in the Fed? That's been taken off the table, at least looking through to the rest of this year. And so I think that the conversation is really going to pivot from one focused on the Fed to one focused on earnings. And in Q2 earnings, when we think about the impact of tightening on the market, we shouldn't have really seen that in Q2 earnings. The impact of financial tightening, both through rate hikes as well as quantitative tightening, is something that has some delay. It can be anywhere from 12 to 18 months. And we've done some pretty seismic shifts in terms of rate hikes already. And so
expected heading into the winter. Oh, and by the way, things are going to get so bad by next year that the Fed's going to have to reverse course and pivot and cut rates, even though they're saying we're not going to do that. So, I mean, how much is that basically what you're doing? Not fighting the Fed, but fighting the economic outlook that they're basically using to formulate their case.
Bank of America says hard landing. Tom, this is the line from them. The Fed wants to reduce inflation and will risk a recession to restore price stability. Hard landing, the call from them.
John, I don't know. It's 7:02 a.m. and, you look at Bank of America, you look at all of it out there and the level of gloom. I mean, it is 7:02 BGT. There's no question.
Well, Tom, you tell me. Give me one reason to be bullish, and it's the only reason to be bullish right now, that everyone else is bearish.
No, that is true.
A lot of speculative tech stocks.
Our next guest suggests the market is underestimating odds of a Fed pivot. Nancy Davis is the Chief Investment Officer at Quadratic Capital Management. She runs the firm's interest rate volatility and inflation hedge ETF. Nancy, welcome to the show. Welcome back to the Green Room. So it's not necessarily a Fed pivot, but sort of the notion that maybe the Fed could ease off of full hawk a little earlier than what we think.
No, exactly, Melissa. The Fed has been so hawkish with their forward guidance. It's already moved the rate hike expectations. So right now, with only 4 months left in 22, we have 131 basis points of hikes priced in.
So it is about this disinflation that should come through. The other aspect is that, yes, a lot of people put this sort of expectation of a Fed pivot as the reason for the rally over the summer. But the rally started before the CPI number was a bit better, before the July FOMC minutes. So it started really end of June. We had quite a bit of breadth to the rally. Sentiment is still extremely negative, and you've just quoted a number of reasons why, but short positions have increased. Cash levels are still elevated. People were not happy with the summer's rally. Now, is this week a return to those lows? I think the June lows will hold. Are we going to have a straight line up? Clearly not, and I don't think we should expect that into the end of the year either. But we're already pricing in quite a bit of tightening. The bond market hasn't moved that much, at least in terms of rate hike expectations. Yes, a bit
inflated yet. Is that it's not necessarily about the Fed. Look, we've seen equity markets have this major reprice as that Powell pivot gets priced out. But it's not interest rates that Graham is worried about. It is earnings. It is
given up on the Goldilocks world, decent growth, moderating inflation, and even more importantly right now, a Fed pivot. But what we have to focus on is the data. We've really noticed this week that stronger economic data is Fed narrative. They're playing away from the Fed pivot narrative, and they're
really bought the Fed pivot narrative. And if you look at the correlation between interest rates and PEs, it's quite high. In July, it was because of this Fed pivot narrative as inflation started to peak. And if you start to put doubt in central bank minds that inflation might still be a problem because of some of these supply chain issues, it's only going to embolden them to continue to raise rates, at least in my opinion. And I think also what you have is a peaking inflation narrative, maybe a little bit more in question now, but then you also have a labor market that's still overheating, for lack of a better terms. And the Fed continues to come out and tell us what they're going to do. They want the Fed funds rate above neutral, and there are plenty of ways to measure that. But at a bare minimum, you're talking about a neutral rate of somewhere around 3%. I think given what we're seeing in China, given the fact that they want to
there. And on the other side, on the valuation side, look, we have had, you go through this massive Fed pivot over the last 12 months. It's been pretty remarkable, but it's also really well priced. And PE multiples and the equity risk premium by my measures have really calibrated appropriately here. So look, if we wake up and next week the 10-year's at 4%, which it won't be, but if it were to do that, then obviously we're probably going to see some further PE contraction and so forth there. But I think right now the markets are going along, and so I think we need to get through this. September Fed meeting, we need to get through some,
led to some relief, particularly for...
At the press conference on September 21st, Jay Powell may well say, we went 75 basis points today, but there is better news on inflation, so we think that the next increase could be milder. And I think that would be seen as finally the pivot that the equity market's been waiting for.
Lindsay, against these kind of unprecedented macro backdrop signs, bonds and stocks have been declining largely in tandem recently, and there was a classic 60-40 portfolio down 19% this year. What's the best way to achieve diversification in this kind of environment?
Down, then the market will start saying, hey, we think that we're actually going to see that Fed pivot.
What are we doing? I'm sorry, finish your thought.
But if we don't, then I think that 3,600.
You're in the notes, at least, about a Fed pivot, that this could happen. And I'm wondering, we were just discussing what that means now. I feel like it's lost all meaning. What, in your view, is a Fed pivot?
It's a soft pivot. It's a maybe pivot. What kind of pivot? No, I think that you need an action. So, okay, let's put aside the Fed. I'll talk about that in a second. But I can't. One of the reasons that I didn't chase that momentum move off of the low into the August peak, even with such great momentum and tape data, was the fact that I couldn't find a major market low, Mel, that didn't have the 2-year note yield already trending lower from peak and the Fed clearly stating that they were pivoting. And I think that's really what it looks about. I don't think maybe if you do 50 versus 75, you can get a counter trend rally like we did with the August rally, the summer rally. But ultimately, you really have to have, and here's the reason. There's a fundamental reason, Mel, that's really important. The reason that when the Fed pivots, it allows investors to look through the coming economic weakness because it has a stimulative effect when you look to 6 months to 12 months down the road.
Tony, so the Fed pivoting is certainly going to be on most people's checklists for what are the things that make you turn bullish. But talk about things that are a little bit more here and now, or some things that might be a little bit more granular, whether it's market breadth, whether it's some different parts of either the inflation chain, not necessarily even headline inflation. What do you need to see? And again, for someone who's been very tactical in here, talk about that in terms of timelines.
Sure, Timmy, thanks. So what caused us to write a note about a bounce yesterday? The CPI came down, the core PCEs come down 3 or 4 months in a row. It's the unemployment rate. I think what causes the ultimate Fed pivot is when you have the inflation data coming in like it is and everybody's talking about. But what if you get a spike of 0.5% in the unemployment rate over the coming few months? And that's exactly what is happening. I think I said on the last time on the show, where the NFIB hiring plans index, which is small business hiring plans, has deteriorated to a degree that suggests a pretty meaningful up move in the unemployment rate by year end.
Tony, $220 worth of earnings is your forecast. What's the right multiple? 18 multiple, market multiple. It gets us exactly where we are today. 16 multiple, I can do that math. That's 440 points in the S&P lower. What are your thoughts on that?
I know that it's sticky, but it's beginning. We're starting to see signs that it's beginning to roll over. And I'm not calling for this big pivot by the Fed. The Fed, does need to be aggressive when we know that. Point number 3 is I just believe investors have been way too academic and trying to apply rules to investing. Just because the market drawed down 20 to 25% doesn't mean earnings are. And what I find fascinating, and we wrote about it in the report, is we've got 16 months now, Scott, of pretty lofty inflation, and earnings have held in there. And we threw out that number that earnings growth rates for 2022 are actually at 500 basis points year to date. And the trailing bottoms up number is at about 227. And it has not fallen dramatically, and it's not following the script. But more importantly, I think, is employment.
All right.
You need to see, I think, probably a double.
When the Fed pivots and signals that perhaps its rate rises are ready to ease.
Exactly. This could last for a little bit. Incredibly strong U.S. economy, an aggressive Fed. We do feel the U.S.
Off the Gulf Stream was the VIX with a 22 handle.
What were the fairy tales the equity bulls were singing through the summer? Bramo, something about a Fed pivot.
Yeah, that's right.
And then Chairman Powell came out in Jackson Hole, Wyoming, and said, what pivot?
Right. And so then you have people are pushing back and saying, you just don't know it yet, but you're going to be pivoting.
But why are we up there? Do we have a why? Do we have a consensus why we've advanced?
No, I mean, you can pretend that there's some sort of narrative. People are basically saying the dollar, the fact that the euro is actually gaining some traction, that there's a better sentiment. If I give a narrative, people will laugh at me and say, you're really going to try to give this something? Because it's very difficult to say.
On radio, John, this is really important, not to slow down the show, an eventful half hour here in a serious tone.
Not at all.
Here, John, I want to really tie this together with the question about the pivot and this idea of lower rates and this conviction that the Fed cannot do the damage that a lot of people fear. Today, we heard from Jim Bullard coming out yet again saying we don't know what the market is looking at. I'm paraphrasing, obviously, but that's not what we're seeing. And we plan on doing something that does not look anything like a pivot. How do you get conviction to simply discount that?
So, Lisa, think about this in terms of game theory. The Fed needs to get inflation down in order to stop. If they tell you that they're going to stop right now, 3, 4, 6 months from now, then the inflation expectations are going to rise because the Fed is done. So if they even want the opportunity to pivot, they have to talk really hawkishly. And so you have this very strange dynamic where in the CPI next Tuesday is expected to come in at roughly 8%, a little bit lower than where it was. But a year from now, it's expected to be back in the normal range. The Fed needs to manage what's going to happen 12 or 18 months from now. But if they talk too dovishly too early, they're going to
dead effectively. I mean, it certainly sounds like Jay Powell recently is not.
This is probably not a sustainable recovery.
Well, what about the Fed pivot? Is it dead effectively? I mean, it certainly sounds like Jay Powell recently has not been saying much that would be consistent with a pivot.
I don't think we're going to see a pivot in early 2023. What Jay Powell has been saying is that he's going to do what's necessary to fight inflation, even if that comes somewhat at the expense of the economy. And given that inflation likely has these sticky components to it, I think he continues to raise rates, likely 75 basis points at the September meeting, and then more moderate rate increases from there. If anything, you'll see a pause in 2023, but you won't see rate cuts until we hit a recession and we see that demand destruction.
Yeah, and David, we've seen in the last month a reduction in the cuts that the market has priced in. They were pricing in 50 basis points of cuts in 23. It's now come down to just 25 basis points.
Because those are what's going to matter. And that spending surge will probably show up in core. And that's really where the Fed and everybody will pivot to as far as where they're going to go next with Fed policy and what's next for inflation.
Jim, we're in London, and we've been hearing a lot about an energy situation that's quickly moving and looks marginally better. Perhaps not when you look at the pace off the base, but when you look at, for example, just the trend of natural gas prices coming down. How concerned are you about the fiscal landscape with countries looking to borrow to plug the gap, but not necessarily reduce the demand? And I'm talking about the United Kingdom.
No, I am very concerned about that. There's two things here. First of all, while the price of natural gas is coming down, the storage for natural gas is about where you would have expected it to.
It was brilliant. I will stake that. And we were making light humor about it, about her new puppy, which was an exit puppy for her from the Kansas City Fed named Pivot. But, John, I'm going to state this as clearly as I can. Jackson Hole was the greatest, most unaffected reality of diversity of guests I've ever seen in economics. She and the Kansas City Fed absolutely nailed an eclectic, informative set of guests.
It was only a number of Fridays ago. Only a number of Fridays ago, and Lisa, already some people are questioning the communication, and we got a number of Fridays ago. What did Jonathan Golliver, Credit Suisse, say to us on Friday? I reviewed that interview with John.
Me too.
He said, OK, but they're not going to tell you what they're actually going to do next year, are they? They're telling you one thing, but I'm telling you they're going to do.
We'll need to see more demand destruction. We'll need to see more signs of recession before the Fed gets anywhere nearer to a pivot. So there is an element of, long-term expectations and midterm expectations coming down because of fears of a recession. So the market is adjusting to that. But for now, the Fed is staying with the hawkish rhetoric and not pivoting.
So, Green, what kind are you expecting a shallow recession, or is there a danger that as we try and manage this recession, it becomes quite ugly, or there's a snowball effect, and actually we'll see a huge correction also in stocks?
I would say more of a shallow recession. So we do see the Fed at some point, once seeing signs of demand destruction and recession, we do see them pivoting at some point.
25 basis points, that is an overreaction because inflation will start to cool, and that means that the Fed will pivot. Yes, folks, we're talking about the Fed pivot yet again, putting in that bullish posturing from JP Morgan. But if you look across at other analysts, this certainly is not consensus. In fact, a form of a recession feels to be more consensus. You can see that in some of the oil calls we've gotten recently. Morgan Stanley and UBS just downgraded their year-end calls. Morgan Stanley downgraded $5 to $95 per barrel for Brent. UBS a downgrade of $15 to $110 a barrel for Brent. Both of them citing recession, not necessarily the U.S., but more global issues, especially when it comes to China and lockdowns there. Both of them do see higher oil above $100 for next year because of the tight market. But Kriti, it really just shows.
Let's not get too focused on one report. Nonetheless, it does look pretty unfortunate. Everyone had gone one way and expecting not a Fed pivot, but that there was enough ammunition at some point there would be a reason to have a Fed pivot. That's just been swept away.
It's a reality check.
Yeah, it's a reality check when, Powell had given that to us at Jackson Hole, but now's the data proving it. And that's awful for the UK. It's even more awful for Europe, and let alone emerging markets. It's a disaster. It's a very bad print because the US are going to overdo it and they're going to break something. And what they're going to break is the rest of the world.
Well, let's talk about it. Let's talk about the bank around the corner on Threadneedle Street, the Bank of England. Tom raised the question. Are we at that point now when we can just call it what it is? Smooth sailing? What's your message to people that still doubt the resolve of this Federal Reserve?
Well, there wasn't going to be a pivot, and there clearly isn't going to be a pivot anytime soon. I think Jackson Hole dispelled that idea completely. Anything close to a pivot would just mean we're going to stop hiking, and that happens at some point in 2023. And how many more percentage they get in before that? That number is going up, of course, with the November expectations rising as well. But the Fed isn't going to blink. Inflation is gradually coming down, slower than anyone would like, but their resolve is going to be very firm.
Mm-hmm. Esty, where do I hide? Just as simple as that. My head is spinning. This report.
Kind of, very similar to what we saw in the early summer and some of that that equity market rally and credit spread performance. And again, if financial conditions continue to remain around these levels, then it just makes a risk that the Fed needs to feel like they have to tighten by more and front load it in order to try and get that sustained tightening of conditions in order to slow the economy and to bring down inflation.
Hey, Mark, fantastic. Just a bit of a clinic there as well. We appreciate it. Mark Urbano there of Bank of America Global Research. Lisa, that's the tug of war between the equity market bulls and what this Fed wants to see.
That basically, the more that equity markets shrug off the Fed, the more the Fed's going to...
That the Fed will pivot. Yes, folks.
After that July meeting, where they pretty much indicated we just don't know what the impact of our rate hikes will be. That led to a lot of this Fed pivot dynamic that I think markets have started to press in. So absolutely fair. I mean, we went from a place where we could not raise rates even in good times, let alone difficult times, let alone a global energy geopolitical crisis and a labor market that was nowhere near as strong back 3 or 4 years ago. I go back to say I think the labor markets are the biggest problem for the Fed because, again, socially, it's a very big deal. It's very important for our country that the living minimum wage has changed in the last couple of years. That pressure is only going higher. Unionization pressure is only going higher. And again, you have a housing market that I think still looks.
Some of that volatility, deploying some of those FX reserves, and hopefully that will buy time and be enough.
Until we see a pivot from the Fed. All right.
But even then, there's no guarantee. Stable there in November.
There clearly isn't going to be a pivot anytime soon.
The market's continuing to predict that pretty quickly the Fed does a pivot and starts to cut in the second half of next year. I think that needs to come off the table.
If today's data is any indication, they would probably hurry it up.
On the table there in November.
There clearly isn't going to be a pivot anytime soon.
The market's continuing to predict that pretty quickly the Fed does a pivot and starts to cut in the second half of next year. I think that needs to come off the table.
If today's data is any indication, they would probably hurry it up.
It puts the Fed into overdrive. And if they're in overdrive, sooner or later they're going to make a policy mistake.
Now we're joined by Diana Moa as Chief Investment Officer at Kirkswald Asset Management and Marcus Ashworth from Bloomberg Opinion. So thank you both for joining us. Diana, great to have you in the studio here in London. Talk to me a little bit about what we lived through yesterday. Was the market reaction overdone?
The market reaction was not overdone. I'd say the market had been premature in pricing in peak inflation in the U.S. And so
Oh, yes, they were. I mean, the rally we've seen over the past week clearly pointed to investors expecting a Fed pivot, but it is not going to happen, as we saw from this red-hot inflation data yesterday. And the market was in for a rude awakening. We saw the biggest drop in the S&P 500 and the NASDAQ since 2020. Pretty dramatic stuff. At the same time, keep in mind that, yes, the sell-off looked big, but it basically just reversed the rally that we've seen over the past week. And U.S. futures are actually ticking up higher today. So there might be a pause after the sell-off, despite all the rising risks.
Yeah, so the NASDAQ was down more than 5%, but look, it's up 0.6%. So, you know, we'll take that perhaps. Capitulation, are we there yet, Ksenia? What do the quants have to tell us?
Well, yes, so Bernstein has a very cool note out this morning saying that this U.S.
in 35 years been through several of those types of sell-offs. I think kind of what happened is people are looking for that pivot from the Fed. They're looking for some sort of sign that this aggressive interest rate rising is going to come to an end. And I think people had positioned that maybe we would get something with the CPI data yesterday. Obviously, it's not appearing yet. Obviously, there's going to be a lag, or there is a lag in the data. So, you know, we're going to stay invested. You know, that's our job. We still see tremendous opportunities. Anytime you see this big of a sell-off, there are opportunities. And, you know, these are the markets where we make our big money. It's just you don't realize it yet. So we're, you know, like I said, we've been through.
Yet, when that starts to kick in, does the conversation start to change?
How long before we start talking about the Fed pivot again, based on a jobs market that's okay?
Being long growth, being long tech, they're saying eventually, I think, you know, economic growth is going to fall. I may still be betting on that Fed pivot. And maybe we will have a return to that environment that we saw in 2019 when the Fed did start, you know, cutting rates after increasing them for quite some time, and the tech trade surged. Of course, yesterday showed us that.
I'm sorry to interrupt you. I don't think anybody here at least is saying that we should, because you're implying an actual pivot from what the Fed is doing. We're just wondering if there should be a pause at this, not a reversal. But let's see where we are, Tim.
And Steve, there's a difference. So let's go back to Sternlicht's term. He said breaking. There's a difference between breaking with an A and breaking with an EA. And breaking with an A is slowing down. Breaking EA is falling apart. And breaking, well, that's what I do here. It's wordsmith. Yeah. But Steve, my question is, so the Fed essentially in July started telling us just this. We really don't know the impact of what our rates and what our hikes have done to the economy. And that was where the market, by the way, got a lot of ammunition to interpret this as a pivot. Fed funds are 100 basis points higher out in April. We're about 445 today. And yet the Fed 2 months ago was telling us that
another pivot point data entry that we could be watching for. For example, the CPI print was a pivot point for the market, and I don't mean it in the Fed's way. What's the next one? What's the next most important data point?
Well, it may not be a data point. I think it may be what Powell has to say in the press conference. You know, the big debate that erupted after the CPI report was it going to be 75? Is it going to be 100? We're still leaning towards 75 just because I'm not sure Powell wants to do shock and awe a week in advance of the meeting. I think it's more to John's point earlier about, you know, what's the destination? How long is it going to take to get there? But importantly, once we get to the destination, are we going to go in and stay for a while? I think the pivot idea, to go back to the Fed's meeting and what the market was pricing in June, was that when we got to the destination, we'd say hi and then we'd turn around and go the other way to rate cuts. I think the Fed is trying to just put that completely to bed. But anything that gives us a better sense of the level of aggressiveness that's likely to continue through at least the end of this year, and firming up this notion that once we get there, we're going to stay there for a while. I think that's the next important message coming for the market.
Lizanne, just about speaking terms with me at the moment, Lisa, because I hadn't heard of the song Wind and Rain before. Just never heard of it.
You mean Fire and Rain?
Fire and Rain.
Bond market kept doing what the bond market has been doing. It didn't all of a sudden say, okay, FedEx is bad, the Fed's going to pivot, the consumer isn't doing well. No, that's not what happened. We are now pricing a terminal rate of 4.5%, surging up from 4%. So the bond market understands this, that the Fed is going to walk the talk. Now it's the turn of the stock market to catch up, which is in part what we're seeing in this reaction from FedEx, that they realize that the consequences of this will be a slowing economy, slowing consumer demand. So we get things like all the companies you're talking about, Matt. We have the Port of Los Angeles, shipments there coming in, dropping the most since the start of COVID. You had retail sales yesterday that, once you strip out inflation, were flat. So it signals now that the stock market has to digest, and
This debate is, how long does it stay there? And the market still has the Fed pivoting spring of next year. The Fed saying no, maybe spring of the following year. Again, that's more what we think is going to happen. So there's still that adjustment that has to take place, and we've seen those aren't particularly pleasant.
Pretty scary world right now. Easily to scare yourself even more if you wanted to. Tom's asked the right question, I think, all week. Where do we hide? Where'd you hide?
Well, I think we need to think about time frame. So what we've seen so far this year is the dollar's been the one safe haven. And if you look at the supports that you've had for the dollar, they're probably still in place now. Does the dollar continue to appreciate? Not necessarily, but it's reasonable, I think, to see it staying there. If there is good news,
well to paying attention to not only Ethereum but other alternative asset classes within the crypto space.
I want to pivot back to the Fed and the macro environment for just a moment. And most experts expect another 75 basis point increase from the Fed on Wednesday. But I think there will also be a lot of attention as to Powell's stance on the economy and how they expect more rate hikes ahead in his speech on Wednesday. How should we expect crypto prices or investors to react if Powell continues this aggressive stance that he's been on for so long? And do you think that the pessimism around the economy is already priced in for crypto?
I think crypto is certainly one asset class among many as an alternative asset class relative to what's happening in the broader macro. And you will see, again, sophisticated investors, folks that take a multi-asset strategy.
They wouldn't raise rates at all. And so our job in that time, many of us did, was to say that this is a fake rally because it's built on the premise that Powell has given the green light to put on risk, that the Fed is pivoting, and that we've reached peak inflation. And all of that has, in fact, turned out to be wrong. And so sentiment has a tendency to be what we want and not what we see. And I think that that's our job, is to separate, as investors, be it professional or sitting home on your couch, separate what you want from what you see.
What if Powell is not going to be as hawkish as some think, that he recognizes the danger of a Gundlach word that he used with me last week of oversteering, that Powell knows as well as anybody that the cuts or the hikes that they've done already need time. They need time to work their way through the system. He also knows that a good part of inflation is, in fact, coming down. So maybe he's not going to be as hawkish as some think because of all of those.
Bond market basically told Trump his trade war wasn't working. That was an important level when the Fed pivoted in the fall of 2018. And that was where the 10-year Treasury got to this June, which is when the market hit its low. So these levels are really, like, you don't have to believe in them, but enough other people do that they're important to watch. So when the VIX failed to really get going today, and you started seeing like the large cap tech names bottoming out, et cetera, you just look at this setup. This guy's going to come in on Wednesday, tell you what you already know he's going to say. Everyone is expecting.
Fed put doesn't exist, okay, which a lot of people got kind of teased into in the last cycle, that if things got bad enough, the Fed would pivot. And for us last week, Carl, was a microcosm of the entire year, where investors were like, okay, maybe they don't have to slam on the brakes as much as they have. And then we get a really hot core number that firmly puts in place what I call a terminal rate problem. We don't know where the Fed's going to stop, and that's a problem, and that's why we're positioning defensively in portfolios.
So you agree the conversation last week changed on that terminal rate? I mean, now we're hearing from some of your competitors on the street, maybe 3.25 or 4.25, maybe 4.5.
Yeah, so we're the market. The good news is that the market is priced to get to about 4.5. That's
rapid clip throughout the economy. But then other people, particularly equity bulls, would argue this is exactly what they're counting on. Basically, the Fed pivoting, right? This goes back to that discussion that exhausted so many people, and nobody wanted to hear the P word ever again. I mean, is that basically what you're saying, that this is a bull case for markets because it is a bear case for the economy and a bear case for this Federal Reserve?
I think it's a temporary bull case. I think we're well past the stage of lower yields being good for the economy. I think we might get a bounce on the Fed if he does this little bit of a pivot. But I think the reality is just he's gone too far. We're still starting to feel the impacts of what's gone on before. And people are going to realize generally lower commodity prices, lower bond yields are the risk.
Waiting to see the Fed pivot. And then I think you're going to see a big rally in crypto.
What do you think the upside downside is right now, both in terms of equities and crypto? And do you think that there's going to be a break in the correlation anytime soon?
You know, I think crypto, Bitcoin, let's start with Bitcoin. There's a put in Bitcoin somewhere because you just see these institutions all getting engaged.
Because it would help them get in front of it. What will they do? They'll go 75. I think Powell did a really great job of ripping that pivot Band-Aid off after Jackson Hole, you know, where there was all that commentary today about how he ripped up his speech and he had to come out more forceful. The biggest risk to the Fed is when there's a dislocation between expectations and what their paths are. So I feel like he's going out of his way to convince people that they're in it to win it. They're comparisons with Voeckler, you know, he's saying he doesn't want to start and stop. He wants to hike and stay there. I think all of these clues lead you that this is a committed Fed willing to sacrifice unemployment to make sure they get inflation under control.
Is there really dislocation, though? I mean, the bond market would argue otherwise, right? That seems to be in lockstep.
Be optimistic. And I think the data they're going to give you gives you no reason to be optimistic. But, you know, people want to believe that the Fed's going to pivot. If you look at the futures markets, they actually have the Fed cutting again in June quarter of next year. And I just think there's zero chance of that happening. So we'll see how the market takes this. Some of this is going to depend on what happens between now and when the decision actually comes out.
Right. And Dan, you've been very good this year at calling bear market rallies. So to be clear, your thesis is still intact that we could hit new lows here. You point to FedEx, which took markets by surprise or a little bit off guard last week. But since then, there's been some maybe not positive, but less dire commentary from CEOs like Intuit, Home Depot, even Marriott. How do you square those?
Well, I think you actually touched
rates aggressively, if not 75, then by 50 basis points at the next meeting or two, and not try to give markets any reason to think that the Fed will pivot. The markets are already pricing in, or still pricing in, cuts to the Fed funds rate in 2023, and he probably wants to take that off the table.
Yeah, really interesting stuff. We will be looking forward to this meeting. Mike McKee reporting live from Washington. Our special coverage of the Fed decision starts at 1:30 p.m. New York time, 6:30 p.m. in London. Now let's get to a story that has rocked Wall Street. Banks are likely to lose about $600 million after unloading debt for the buyout of Citrix Systems. Investors required significantly higher yields than the banks had promised private equity firms, Vista Equity and Elliott Investment Management, back in January. Shanali Basak, our global
below those old lows, we start to price in a mistake and a harder landing, and then we have to think about how quickly the Fed pivots from that. And above 4,200, I think Jay told you at Jackson Hole, you guys are pricing in no landing, and I'm going to, smack you over the head, which he did.
Which is what they did, and they just did it again. So let's talk about the dollar, because there was a question there about international coordination, cooperation. He said we don't coordinate on policy, but we certainly talk about it, and we share a lot of information, which we know. So now that the forecast from the Fed itself is to go another 125 this year and potentially more next year, and the dollar is already sitting at more than 20-year highs, how are they going to deal with that situation? Isn't that going to be problematic?
Still pricing in cuts to the Fed funds rate.
Interesting points on this. Just the idea that the market is waiting for the Fed to pivot. As soon as they do, it's going to try and take advantage of it. I mean, Powell's in this position where he has to not just talk tough, but continue to do the tough things because some investors weren't believing what he's been saying for a while.
Yeah, I think that's right. Roger obviously is 100% correct. It's the idea to sort of put blinders on or somehow draw a ring fence around the idea that there's any a possibility of the Fed wavering in its rate hikes. And so it comes forward with this very, very hawkish outlook for policy. And then Powell puts a stamp on that by saying, yeah, we're probably going to hit that. Remember, sometimes the Fed chair says, oh, those forecasts over there, they're not what we mean. They're just
back against a couple of times yesterday. Tom, this idea that every couple of weeks we have this little romance with the idea of a Fed pivot and then seemingly you need Chairman Powell to come back out and say, no, that's not happening.
Yeah, I get the dynamics of pivot, John, but is it just a 5-letter word for the word blink? I mean, there's a point where they're just going to have to say enough, and I agree it's off the unemployment rate, but it seems to be very far away, as we heard from Vice Chairman Clarity yesterday.
Futures positive, 0.2%. A Bank of England decision coming up in about 19 minutes from New York.
To what extent can a Fed pivot then change the other bits? Because that seems to be just one part of really what is.
Finance and take out money from the bond markets going forward.
How long does this opportunity last?
Yeah, well, I mean, depends on when the Fed's going to pivot, and that's when you'll start to see things come back. It could get a little weaker, which we know. If the Fed, I think they made it pretty clear that in the summary of economic projections, they're going to move the median dot moved higher, 4.4 this year, 4.65, terminal rate. However, the economic forecast didn't really jive with that. If you looked at it, they said GDP would be 0.2 this year, and then it's going to increase to 1.2. That made no sense to me. And unemployment was only going from 3.7 to 4.4. So, we have to see if they can orchestrate a soft landing. They haven't been too successful in the past. If they're going to have to pivot and, do an about face.
And it's sort of this really perverse incentive that almost the faster that the economy deteriorates, the more quickly the Fed can pivot. And people are concerned that the economy is not deteriorating quickly enough. It is highly uncomfortable for economists to be looking at that, including Janice Eberly, who has incredible and extensive experience in administrations as a chief economist to the White House from 2011 to 2013. She is currently senior associate dean and professor of finance at the Kellogg School of Management, and she joins us now. Jen Eberly, thank you so much for being here. When you take a look at this backdrop in markets, what is your fear for how this translates to the economy?
Good morning, Lisa. It's great to be with you. You're right that there's a lot of market turmoil. The
Fed put, or for Powell to pivot like he did in 2018. So I'm still in the camp where they raise to where they've said right now, but they kind of hold for most of next year and allow time for their rate hikes to have impact on the economy.
We've heard this concept of peak Fed hawkishness over and over and over again. And for me, I just don't know what that means. I mean, does that mean a deceleration in the pace of rate hikes from, say, 75 to 50? I mean, what does that mean in your view?
I think to me, peak Fed hawkishness means the ultimate sort of final destination of this rate hike cycle. And we've kept revising that up. And I think, the uncertainty is something that just continues to weigh on markets. And, I think there's a risk they overshoot.
The Fed is forecasting the unemployment rate to be about a half point within this range for the next 3 years. We think it's very unlikely. We think that the U.S. is headed closer to 2 million job losses net over the course of next year. And that's, again, if the Federal Reserve will ultimately not continue to tighten through those job losses, maximize the impact, to sort of pull all hope away from the notion that they might pivot. But if you take a look at what the Fed is forecasting, the unemployment rate to be about a half point within this range for the next 3 years. We think it's very unlikely. We think that the U.S. is headed closer to 2 million job losses net over the course of next year. And that's, again, if the Federal Reserve will ultimately not continue to tighten through those job losses. But we wouldn't expect them this year, right? The lags between where the economy again, started to absorb these rate hikes and where it is right now, it's not going to be immediate. We would expect non-farm payrolls to grow through the rest of the year. And just one really simple example. If you think about what's happened to the monthly pace of new home sales, it's down 51%.
There since the first quarter of this year, we never kind of believed the bear market rallies. We never believed that every time the Fed met, there was a pivot moment coming. We think you still have to overweight fixed income. You stay short duration. You stay up in credit quality. It's not time to reach in high yield yet. And on the equity side, you underweight equities and you stay in defensive sectors like healthcare, staples, utilities, those places until things turn, until you see the signs turn, or until, Lisa, we reach a price where the risk-reward dynamic changes.
Darryl, just on reflection and just a final question. I think we've played the Fed pause about 5 different times through the summer and into the fall. Darryl, what did people get wrong then that's going to help them identify when we actually get a sustainable pause from the Federal Reserve?
Victoria, I want to understand your parameters. We've been talking a lot about the Fed pivot and whether that's sort of underpinning some of the bullish sentiment that we hear on the fringes of Wall Street, not necessarily mainstream. What's underpinning your conviction that we're getting close to a bottom?
Well, I think a lot of it has to do with the momentum that we've seen, the trend lines that we're watching. There's a lot of contrarian signals out there. You look at the bull-bear ratio, you look at the put-call spike ratio. I know that Tom was mentioning the VIX earlier this morning, and we're surprised the VIX isn't higher than where it is, but we want to see the VIX continue to move higher in the with a 3 handle. So I think you have to look at a lot of these trends and say we're getting close to where we think we need to be.
Victoria, Crossmark's clients
more neutral on monetary policy. I think that's when the gap, the interest gap between U.S. and China will stabilize and perhaps narrow, and that's when perhaps the inflow will resume. So for the time being, bond market inflow.
A little bit. I tweeted, you heard me, I don't know if you heard the beginning of the show, I was asking the former CEO of Wells Fargo, 2 things. Why isn't Janet Yellen getting any criticism here? I don't get that. It's like she's vanished. Should Jay Powell and or Janet Yellen be replaced?
I'm very touchy about replacing.
I mean, it can't be. I mean, it could be. Powell's got a contract. He's got a deal.
Listen, I mean, this may sound old-fashioned, but I want the Fed to be independent. And one of the great things that we did in the 1980s. One of the great things we did in the 80s, and even though when Paul Volcker was hiking and there were people furious, they knew who the Fed chairman was, and they were angry, and yet.
From more Fed hawkish speak, it seems.
Yeah, I mean, there's been a kind of reevaluation. I think people thought the mistake that the Fed was going to pivot too early is now it's going to pivot too late. So we've seen this rise in rates at the front of the curve. But I think really interestingly, what that means is that people believe that the dollar is going to be bid for much longer. And if you're an energy importer, that means that your energy bill is going to keep expensive. It's going to be harder for you to get dollars. So on net, you're seeing these countries are basically having to shed debt, shed treasuries. So that's causing the longer end yields to rise as well. So you're seeing this sort of move up in yields, like across the curve, but it's for different reasons.
So we had the Japanese finance ministry intervene in markets for the first time since 1998 to protect the yen. There was
the days when I hear the Fed pivot, the Fed pause. If these central banks are going to have to pause or pivot, it's going to be for some pretty bad reasons, Mohammed. And that's not necessarily going to be
one of 2 reasons if they pivot. One is because recession risk has become unacceptably high. 2 is because we are very close to. Again, if you are voting and expecting a pivot, you've got to be clear why it is they're going to pivot. They are not going to pivot because the indicators they're looking at are coming down really quickly.
Actually, every Fed speaker is singing from the same hymnal, the same playbook. Under Chair Powell's leadership, there's really been a hawkish pivot this year since the March meeting. I think the chair made it very clear. He thinks rates are going to that level that Bostic referred to, 425 to 450. I do think there's a sense on the committee to get the hard medicine out of the way this year. I really do think that they're trying to front load as much of this as they can, and then hopefully next year the data starts to improve and they can pause. And I think that's certainly what they're thinking right now. That's what the SEP indicated.
So 75 November?
That's what I would guess right now. 50 in December, and then one more hike either in January or March of next year. I think is what I call the plausible best case scenario.
And then they pause.
And then
because
they pause.
Why?
They'll pause because they will.
I will take slight issue with something Mohammed said. He's saying that the Fed will pivot if it becomes clear that the risk of recession is just too great. I think we're there already. I think the odds of a quote unquote soft landing have really gone to close to zero here.
That it's starting to look like a lot of the bad news has been priced in, but that's as good as you can get in terms of optimism.
The Fed pivot is the thing they're all excited about on the bullish side. The struggle I have with that, Lisa, if they're pivoting because of recession, and by pivot I mean pause, because of recession or financial stability risk, is that bullish? I don't know if that's bullish.
Forgive me for the second and third derivative here.
Sure.
But what that means is longer term inflation.
Oh, exactly.
What that means is rates higher for longer. What that means is the long end having trouble staying moored because that ends up with them not seriously fighting that issue. This is not an easy or comfortable situation for risk assets.
Futures down 8 or 0.9% on the S&P 500. On the Nasdaq 100, we're down by a little more than 1%. Yields are higher by 9 or 10 basis points.
Fixate on whether that is going to happen. Fixate on whether that is going to happen.
Yeah, no, I mean, I think it's much too early to talk about the Fed pivot. It's just much too early. There's too many stickier parts of inflation right now out there. Mentioned wages, but also rents are still quite high. And that's going, those two pieces, along with education and healthcare, those are going to keep inflation much more elevated. So even if we come down from the
cause the pivot, right? The Fed is not going to watch the U.S. stock market go down in the level that it has and say, go down in the level that it has and said, oh, my God, we need to make a pivot. It's always been about credit markets and increased global stress, self-inflicted or otherwise by other central banks that may have run-on effect that cause conditions to become, Victoria, even more tight. That's the one thing that could cause a pivot or one of the things that could cause a pivot that changes the calculus for stocks, perhaps.
Look at the UK, the poor guys. I mean, they went out with this, oh, we're going to cut taxes. We've got this plan. And then 10 days later, they're reversing course. They have to step into the bond market. They have to intervene because of liquidity. We've always said the only two things that will cause the
I agree with you. Don't liquidate now when, we're talking very volatile markets. We don't know where the Fed's going to go. Historically, when the Fed does pivot, you get a rally in equity markets. My suspicion is next year we're going to see that.
And let me ask you then, Megan, on that point about the Fed and whether they're going to ease up. I think that's the other underlying question here, and maybe why you're even seeing some green on the screen. If you add OPEC and Russia together, you throw Credit Suisse into the mix. At some point, does the Fed wake up in the morning and say, you know what, maybe we've done our work here, and in fact, we're making it worse?
At some point, I think they will, but I don't think that's anytime soon. They've made it very clear. They've been very hawkish in their rhetoric, and I think if they turned now very quickly because of what is speculative news or coming out.
The other Fed speakers that have followed made it clear they would remain in
the cool down and overheated economy, that this one cold report is not enough to cause the Fed to pivot toward a less hawkish side. So why don't we do this? Let's consider what failed previous rallies and see if anything's changed. So we're ready. Well, the first thing that happened is that we have been having a tough time ever since Russia invaded Ukraine, right? It turned Europe upside down. Western Europe, especially Germany, went all in on Russian natural gas as part of a misguided effort to defend the environment. Although shutting down nuclear plants in favor of fossil fuels sure seems like the last thing an environmentalist would want, they didn't realize or ignored that the Russian government's become increasingly hostile to the West. Now, Europe's economy is totally hostage to Russia, even as they're saying.
I do want to get your take on this notion of a so-called pivot, because we've had a lot of Fed speak. We're expecting more this week. So far, officials have come out and pretty strongly said that the need to tighten continues. However, perhaps some shift, depending on who you're listening to, will continue as we come to the end of the year. Your thoughts?
So I think, first of all, the Fed should not pivot, and I don't think they will pivot. I think they very much understand the kind of mistakes that have been made in the past when you start to raise rates and then you basically chicken out when the economy starts to take a little bit of a hit. The economy hasn't really taken a big hit yet.
Too expensive. So earnings are going to come down. We're seeing a slowdown right before our very eyes. And even if the Fed were to pivot, it's not going to cure the ills that.
Ed Yardeni of Yardeni Research. I think we can all come up with scenarios, do a various scenario analysis as to how the Federal Reserve pauses, pivots, whatever you want to say.
Exactly.
Is it bullish if they pivot or pause because of financial instability? Is it bullish if they pivot or pause because of a deep, deep recession? Now, the way I phrase this is as follows. If you ask someone if the Fed pauses because they're worried about recession, is that bullish? And someone might say yes. If you phrase it just slightly differently, if the Fed isn't cutting in the next recession, is that bullish? Now, it's basically the same thing, right? Because they could stop hiking. It doesn't mean they're going to start cutting.
Mohamed El-Erian made this point as well, and a number of people have made this point, that be careful what you wish for, because if they actually pause, the circumstances have to be so dire so as
3.73. This is after that reversal from the RBA. Many people saying that actually this is something that the Fed should also pivot to. Otherwise, we're going to see messy bond markets. All right, let's get to the European map, if we have it, just to see if we have a difference between France and Germany and the like. Our Maria today was also in Luxembourg looking at the energy plan for the
on Wall Street yesterday, with the worse than expected manufacturing data sort of reigniting that talk about a Fed pivot. So that is part of the story. But it is also pricing in, as Kayleigh says, the narrative from the RBA, one central bank down, others could follow. Could. Is this premature? We will see. But markets certainly running with this story for now. Let us have a look at a deeper dive into other European assets. And this is what we have on the UK 2-year. The 2-year yield once again coming down. We're seeing buying of debt products across the curve, but in particular at the short end in the UK. But this is actually part of a global story more than just what's going on in the UK today. The natural gas price for Europe down by 2.3%. It was actually down by quite a lot more than that earlier on. And that really because of some pretty mild, very lovely.
And we don't know what will break. If there is a credit event, there is a financial institution that goes broke, then the Fed is going to pivot abruptly and you're going to see interest rates come down. Quantitative tightening switched over to quantitative easing in a manner comparable to what the Bank of England did. So that's the key caveat. If that doesn't happen by the end of the year, 75 in November, 25 to 50 in
to happen from the Fed. It has to happen from the ECB. Take a look at European bond yields. Wow, they absolutely crashed yesterday. And people are saying, you guys are ridiculous. This is not what they're going to do.
Can we pick up on sterling just briefly?
Please.
6 days of sterling strength.
You always want to do sterling.
103.50 last Monday. 114 this morning. I think it's worth picking up given the weakness we saw last week.
You brought props yesterday. Come on.
I know. What a flat cap.
I know. So you want to talk about sterling just as much as anyone else.
Yes, that's true. But I would say John's right about the move. John, I've never seen anything like what we're seeing from the
data.
Isn't that always the case?
Yes, I mean that's
using the RBA as an example as to why the Fed's going to pivot.
Exactly.
I mean, come on, are we stretching?
I mean,
that's a question. Possibly. Futures up by 1.8% on the S&P. You going to sing us out?
June. Yes.
Okay.
We heard from John Williams yesterday, which is they are committed to continuing with these rate hikes. So don't fight the Fed. Is this belief in a pivot that the market seems to be buying perhaps premature if the Fed is saying don't do it? And yesterday, just to give you a sense, we saw the biggest one-day drop in 10-year real yields going back to March of 2020 as people start to believe in this idea of a pivot. At 10 a.m., we get the JOLTS data in order for job openings in August to give some semblance of where we are in the labor market. In the July reading, this to me shocked me. We actually saw an increase in job openings. How much are we actually seeing the labor market cooperate with what the Fed has been really saying they want to be seeing? And how much, and John, you've been really talking about this, are we looking at a lagging indicator in order to dictate future policy? You're telling which names do best in the regime that you're talking about, of a Fed potentially backing away, potentially pivoting, if you want to use that word, from some of the aggressive rate hikes. You see big tech doing really well, standing out. Amazon shares up nearly 3%. Apple shares up to nearly 2%, the same as Facebook's parent company, Meta. This comes even though Meta is saying that they're going to be a smaller company next year than this year. It comes even though Apple is facing a number of headwinds with the semiconductor space, indicating a much slower pace of demand. And this comes even though Amazon.com is going to be at the crosshairs of less consumer activity if you do get some sort of pullback in consumer spending. This raises a lot of questions. Are we just seeing the high flyers fly once again in a knee-jerk impulse of this market to basically...
Core inflation is around 5.5% to 6.5%. That's where wages are. That's got to come down for the Fed to eventually pivot. Until that comes down, I don't see a Fed pivot.
Tom, you know the conversation this morning. It's frustrating for many. Equities up, yields down. It's the overall enthusiasm in equities. I'd go back to something Mohamed El-Erian said, though. If you're pivoting, pausing at the Fed for reasons like financial instability or recession risk, or the fact that we're in a recession right now, is that bullish? And I think that's a question we've got to discuss.
Lisa, quickly here, Tom Satoris of Strategas, I thought, was brilliant on high yield. What's high yield dynamic signaling? He's pretty grim on the spread market of troubled debt.
There is this question about whether we see a default cycle like what we have before. And we were talking earlier, John, you brought this up. Have we readjusted to the idea of, let's say, 10-year yields remain around this 4% level?
We'll take 10
for a longer percent. Well, you get 10% when you look at high yield bonds. I mean, that's where you end up.
Sure.
And how much have we really priced in?
Is going to have to pivot at some point because of financial stability concerns, and when that may be and what that means for the market. What's your take?
Well, the take at Goldman Sachs would be that the Fed is in the process of tightening financial conditions, and there are a number of components to that. You've been emphasizing the Fed funds rate, which is certainly a decision, but there's also the level of the 10-year bond yield. There is credit spreads. There's the dollar. There are equity prices. All of these are contributors to a measure of financial conditions, and the idea of tightening financial conditions would incline ourselves from a strategy point of view to focus on higher quality stocks, and we can define
environment where the Fed is pivoting.
Well, God, it's a question, sort of hypothetical, which is if they were to do so, what are the impetuses? What would prompt the Fed to do such a thing? Well, it might be that the economy has slowed to a certain degree, such that there's concern about.
Sure. I mean, I think it's a great reason short term, and I think ultimately the Fed pivot and the path of interest rates will determine where the equity market goes over the next year or so. But this was the same reason the market rallied, mid-summer, right? We had a bit of relief on rates. We had talk of the Fed pivot and some of the inflation indicators, things like gas prices coming down. And then August CPI comes in high.
It was actually back in mid-May. Innovation tends to be the new leadership as we move out of a bear market. And if we're right and the Fed's close to pivoting, whether in rhetoric or otherwise, and they have a lot of reasons to pivot, even more now after the LDI crisis in Europe, we may have something similar going on here in the United States. And we also have big deflation in the pipeline. Just one commodity price after another has been capitulating. And so that's at the beginning of the pipeline. And then at the end of the pipeline, we have inventories overwhelming companies. And we have a consumer that is not playing ball as much as he or she was before. So we think this holiday season is going to be quite tough and is going to include a lot of discounting. We believe that the Fed is going to be quite surprised at the deflationary pressures that start hitting the headline inflation numbers during the
certainly slowed down. As you point out, the Reserve Bank of Australia did that. It feels to me as though it is premature at this stage. We have not seen the kind of easing in the labor markets yet that the Fed wants to see. We have seen some weakening in the most recent manufacturing numbers. That's not surprising. We'll see what the data tell us. But at this stage, I think the market is sort of projecting its hopes.
Talk about the Fed pivoting to be a bit cooler in how they deal with inflation has not happened. We're also getting some data points out of Europe. Euro area September services PMI 48.8. The preliminary was 48.9. Now the picture overall across the board, and you can see pause from a rally that was driven by bets by these less hawkish central banks. We're seeking more evidence that inflation is moderating. For the moment, we're not getting that. There's also a growing cohort of money managers cautioning against that expectations for a so-called Fed pivot that they say is being overdone, and they risk ignoring the economic pain that would underpin such a dovish tilt should pause. Christiane, you look at some of the market movements. How does the Fed handle it? We talked about this Fed pivot, but actually they just want to break inflation.
Absolutely, Francine. And I think I would expect to see more pushback from the Fed to the idea that a pivot is coming and a peak in rates is coming imminently.
If non-farm payrolls cracks, if we were to see a negative number, I think sentiment would continue to move towards focusing on a Fed pivot.
Daniel, I feel like there's so much belief or so much longing in the market for the Fed to be a bit cooler that they're not understanding the underlying message of what we're told, frankly, by Federal Reserve presidents day in, day out.
Yeah, I mean, the Fed is very sensitive to incoming economic data. It always has been. So while I recognise that markets have probably been a little bit too early on the pivot idea for a while now, you know, it wouldn't surprise me, particularly if the data start to turn, that the Fed does start to talk about rates peaking out. I don't think they're going to be cutting, right? So it depends what we mean by pivot. I don't think cuts are coming, but a pause could well be coming.
This is one of the charts of the week, if not.
And Kaylee Lines in New York. Well, we got excited and more excited about the potential of a Fed pivot, and then we kind of came back down to earth, Kaylee, it seems.
Yeah, you're definitely seeing a bit of coming down to earth in Western markets, but all that excitement was still seeing follow through in the Asian session overnight, specifically in Hong Kong as it reopened from a holiday break yesterday. The Hang Seng Index as a whole up about 5.9%, nearly 6 full percentage points as we play a little bit of catch up to what we've seen in the U.S. over the last 2 days, and that was really a move led by technology. The tech index up 7.5%. Of course, those tech stocks have been benefiting from lower yields. That may be changing in the U.S., but it definitely was still the story in Asia overnight, where we saw the 2-year yield in New Zealand moving down 18
yesterday, but the gains of yesterday were quite stunning, really, all on expectations, premature as that might be, around a Fed pivot. That got the market really excited yesterday. Today, we dial back a little bit.
Yeah, I don't know where the market was getting that, since we were just recently reassured by like every single Fed governor that that wasn't coming anytime soon. But maybe it was something else that sparked a rally. You know, Julian Emanuel, I keep reminding everyone, in the weekend had a note out saying that a bear market rally was coming, and a number of other people were on board with that, so the market made it happen. We were up almost 200 points on the S&P over the last 2 sessions. We got to 3790. Right now, futures are down about 0.75%. I warned of some volatility before the market opened, but we haven't seen any.
Maybe that's just an indication that investors are looking to, and you were talking about it in the last hour, not necessarily a Fed pivot, but at least a pause.
Right. I mentioned semis earlier as well. Going to change its rate path because the markets are nervous.
We are resolute at raising the.
This has largely been a self-fulfilling prophecy to some extent. Follow on from the crowd saying the Fed has done too much to now the Fed needs to pivot, that we've reached peak inflation, which we very well may have. But the point is that unless the levels of inflation are going to come meaningfully down, unless we have that in print, then this is all sentiment driven, just as it was in July. The only thing it's lacking is Jerome Powell tripping over his words and inadvertently giving the market the green light to put risk back on, as he did back in July. He's become much more careful in how he articulates it. And I thought they were very clear in their message, not only out of Jackson Hole, but out of last FOMC, that we should expect another 2 to 3 rate hikes, likely 2 this year, and that their ideal rate is 4.5% on Fed funds. And we're not there yet.
Add to that some pretty hawkish Fed speak.
And that unemployment is going to tick up from here. I think you need to see 3 things for the Fed to start talking about a pivot. Obviously, our colleagues are all too happy to do it. Again, sentiment driven. But for the Fed to start talking or at least hinting at it, you need to see unemployment
to pivot, and inflation doesn't change. We still have core PCE near 5%. We have jobless claims, under.
I wonder if we're focusing on a Fed pivot in too much of a binary fashion, though, because what we've seen from the Bank of England has been interesting, and perhaps this has read across the fact that the Bank of England is still hiking interest rates. That's what they tell us. But at the same time, they're doing very targeted operations to ensure functioning of financial markets, which could be described as QE. So is this going to be the future?
Yeah.
The only parts that worked for portfolios this year.
Can the dollar peak before this Fed pivot we're going to see?
I think when the market has visibility that we're getting near terminal rate, then the dollar could potentially reverse. But we're not there yet. And we think the market still underestimates how far our terminal rate is. So the dollar could strengthen for some time to.
So, look, I think that hope is still alive. As I've talked to investors, I don't think anybody's pounding the table saying the Fed is definitely going to pivot. I know some of the headlines suggest that. That's not really what I'm hearing. But I do get a lot of questions about, what are the components of inflation doing? There are still people poking around, looking at things, saying the case for moderation is here. And, I think that the Fed is talking a very tough game and investors are listening. But I think a lot of investors I speak with say, well, look, if inflation is moderating and employment's deteriorating, sort of what's the point of keeping this aggressive stance? So I had one client put it to me and say, maybe the Fed is bluffing in here. And, I think there's a lot of uncertainty around that.
Be about 50 to maybe 70. Wow.
So I think that it's 275, 300,000 a month. Those are still robust numbers. That tells the Fed to keep going. So pivot to a slower pace, probably below 200. But to get the unemployment rate to rise gently over a 2-year period like they're forecasting, certainly sub 100.
And that's something that is going to be hard to see. That's at least based on a lot of the projections that we've been seeing. Liz Ann Saunders actually put out some interesting charts of Charles Schwab talking about how the data is showing peripheral weakness, that you're seeing more part-time jobs appear in some of the anecdotal data. Is the headline non-farm payrolls number really the one that we should be watching for real-time changes in just how quickly this labor market is softening?
No, certainly there are other data points that are complementary to the overall picture, and I would never.
Not going to be the same as they had been back in 2008. How much does that take the sort of pivot off the table, that Fed officials aren't going to necessarily back off what they're doing because they're not going to break the financial system in the way that some people are suggesting they could?
Lisa, you've been talking about this for several months now, and we've been watching it very, very closely, and I think it's something you want to be concerned about. We saw it last Wednesday, right, when the Bank of England had to step in to try and stabilize the gilt market. And I think that there's a concern in the broader financial markets that something might happen within the U.S. markets, given limited liquidity, given some of the non-bank financial system growth that we've seen, that something like this will happen, and the Fed will immediately have to pivot from QT and go back to QE again. It's always a possibility. I think that they really don't want to do that. And I think they'll be far more resistant to enter into the marketplace to try and stabilize than they would have been in previous periods.
We were just speaking with the general director of WTO, and she was talking about how the uncertainty has shifted to this sort of downward feeling in the range of outcomes. How are you positioned? Because it seems like you kind of are in that camp. How have you changed your positioning over the past few weeks?
We have been in that camp for quite some time. We've been cautious very much on credit risk. We've been cautious on interest rate risk. But before this rally of the past couple of
0.5%. That's where wages are. That's got to come down for the Fed to eventually pivot. Until that comes down, I don't see a Fed pivot.
Really what the Fed is looking for is signs of a loosening labor market, and I don't think we get that quite yet.
This all feeds into the Fed not being happy where things are, and this softness in U.S. yields, I don't think it will last.
The market is sniffing out the sort of top of the Fed cycle. I think bond yields have overshot and are now coming down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene. An eventful, 50 minutes away, eventful Wednesday, ADP Wednesday, coming up here. The first look at the American labor economy. John, on to that report on Friday.
The Romanian central bank just blinked. Only went 25 basis points. It's a joke. They actually went, for anyone following this, they actually went 75 basis points instead of 50. So Romania didn't blink.
They didn't blink.
Is that the end of the Fed pivot now?
Yeah, that's it. We can basically say
Romania went 75.
Fed pivot, that they're going to be a little more dovish in the coming months, quarters, and years, that interest rates may not rise so quickly, that the terminal rate may not be as high as we thought it was going to be. Where exactly did that narrative even come from, given the fact that we don't have that much data supporting a big drop in inflationary pressure? Or maybe it was the JOLTS data from yesterday that showed job openings had been fallen by the biggest pace since the beginning of the pandemic.
Yeah, and some of the early PMI readings, the prices paid was a little bit lower. There was some dovish surprise from global central banks. So I think that sort of sparked it. But my guess is, in talking about the tighter
in gas markets, regional leaders meet in Prague to seek common ground. Plus, pivot? What pivot? Fed officials pour more cold water on equity bulls. Mary Daly tells Bloomberg an early end to tightening is wishful thinking. So first thing is first, let's check in on the markets. We've been bouncing up and down a little bit. I mean, not down, but certainly we opened about 1% higher, and you can see now European stocks gaining some 0.4%. This is all about perception. Do you think that if OPEC cuts a lot and inflation goes up, does it make the central banks more aggressive in heights?
Down about 0.4%. Now, as I raised the central bank question, of course, you've had Fed speakers pushing back on the idea of a pivot, pushing back on the idea of rate cuts coming in 2023. And that has put some more upward pressure on bond yields. In Australia, for example, overnight, the 10-year yield rising 14 basis points to the 377 level. One interesting thing I wanted to point out in foreign exchange as well, the South Korean won stronger against the dollar for a fifth day in a row. That is its best 5 days against the dollar going back to the spring of 2020, strengthening by about 0.6% this morning, trading right around the 1,400 level, Matt.
All right, we are looking at S&P futures that are down this morning after a down day yesterday. Although it should be mentioned, we were off a lot more, and Wells Fargo has come out and expectations of, reportedly, a Fed pivot driving markets up, as we did on Monday and Tuesday. Is it that the market expects a recession and the Fed to turn around in the face of that? Or is it that the market expects inflation to come down, which doesn't look like the case from this chart? Let's bring in, is Simon White with us? Simon White is with us right now. Simon, you wrote a fascinating piece for the Daybreak newsletter, which is why I wanted to have you on this morning. I thought that the market maybe expected inflation to come down, which is why they think the Fed will cut, because the Fed has been really vehement that it is going to only lower rates when inflation gets back to 2%, not because the economy falls into a recession. A little bit more bullish than raise, right? And in terms of the pivot, the Fed has been very clear they're only going to cut rates once inflation gets back down to close to 2%. Now, what do you think they mean by that? Is 4% close to 2%? Does it have to be 3 or less? Do you think they have a set number in their head? Because inflation, especially after the comps of this year, next year is going to be much weaker.
Well, the biggest concern I have is that even if it's, people say, well, geez, maybe they'll raise it to 4%. That's going to be good. How good is that? I mean, really, and again, in a stock market, because if we're at 4%, suddenly those, 17, 18 times earnings valuations that we've been used to for a while no longer are valid.
Be a full sort of pivot. How are you thinking about, are we thinking about it in too binary a fashion, what a pivot from the Fed might mean?
Yeah, I'd say should it be pivot or just a pause enough? I mean, again, that it'll be better for risk assets if the Fed doesn't keep tightening, but it's not going to be better for inflation. Inflation will create a problem. It creates stagflation, et cetera. I mean, it's going to have a negative impact on earnings, I guess is my point. And so that you do need, again, if you want to go back.
Keep going. They don't plan to cut in 2023.
Yeah, this Fed is not for pivoting, seems to be one way to summarize it. Now, let's think about how high the Fed goes with its rate hikes, shall we? Because we've heard over and over again about the concept of neutral rate R star, where the Fed needs to hike in order to balance supply and demand to rein in inflation. But Bloomberg's Valerie Teitel has been talking this week about another concept that's doing the rounds. I think a paper from the New York Fed put it out there that might complicate the Fed's inflation fight, and Valerie is here to talk us through it. So, Valerie, we've heard a lot, R star, the neutral rate, where the Fed sort of weighs down on demand so that demand comes down to match supply, and lo and behold, inflation comes down. But R star is a little bit more complicated.
Now, I'm not sure whether or not that story will play out, but if it does, then the
market wave on tech. In terms of the market, it felt good on Monday and Tuesday, and even yesterday's rally, because people thought that the Fed was going to pivot. This is exactly what happened in June. The Fed is not going to pivot. And if you listen to Neil Kashkari today, quite hawkish, and he's a voting member starting next year, so it matters. So I think the Fed is going to stay very hawkish. They're going to continue to raise unless something breaks, like Maynard said. But I think it's going to take a while to see something break, if it does at all. Mm-hmm. But core PCE is much too high. Wages and salaries much too high. Rents and as I mentioned, commodities have actually stabilized as well. So I think you just want to be prudent, diversified, own high-quality companies, free cash flow, but more leaning on value versus growth.
Yeah, and to your point on AMD, the stock has actually kind of firmed up just a bit, down about 2.5%.
Certain that this trend is going to continue. That's one reason why, when we talk about the Fed pivot, what does that mean? All right, does it mean they go from hiking to cutting, hiking to stopping? To me, the first pivot is hiking to slowing those hikes. And I think that's when markets and risk assets really grab onto that message, because that's the beginning of the end of the hiking cycle. As soon as you indicate you're comfortable to even slow the pace, and that's what we're waiting for.
Is it appropriate, though, at that point to really feel bullish on risk assets based on the fact that then you have seen the weakness that will necessarily lead to weaker profits, perhaps a persistently higher unemployment rate if you believe the stickiness that a lot of people speak about once people lose their jobs?
Yeah, so I think this is the biggest debate that economists are having with
Welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. No pivot, no doubt, no dilemma. Fed officials hammer home the message that tightening will continue. Today's jobs report may prove key. Oval Office angst. The White House scrambles to respond to OPEC's dramatic output cut. President Biden warns Russia's threat to use nuclear weapons is real. Plus, chipping away, Samsung profit sinks by a third as semiconductor firms warn of a breathtaking drop in demand. Now, first thing is first, let's check in on the markets. This is a picture overall. U.S. equity futures actually pointing to a lower start. I'm also looking at European stocks down some 0.2%. Of course, the picture and the only game in town is what we see with that U.S. jobs report, although
it really does feel like a holding pattern, and a lot really rides on the fact that this jobs report could be kind of what spells the difference between that pivot narrative staying alive or being just completely dead at this point.
Yeah, and this, Richard, kind of goes to the conundrum. But also, so before we talk about U.S. jobs, is there a concern that it's so difficult to read what these big moves, even from OPEC or
we'll see a pivot in it? Mike McKee, Bloomberg International Economics Policy Correspondent, joins us now for more on what to expect. Mike?
It's nice to be wanted, for a change, for at least a few hours. We're likely to see some numbers that, as one of the people said at the top of the show, has something for everyone. The forecast is for 255,000 jobs. That's the consensus of economists polled by Bloomberg, which would be a sequential drop, but not a drop off a cliff. 3.7% is your unemployment rate, no change. Average hourly earnings drop a little bit, which would make the Fed happy. The participation rate's interesting because the Fed's kind of given up on that getting a whole lot bigger with so many people having retired and/or
the U.S. labor market slowing. Bloomberg's Valerie Teitel is here to take us through the chart showing the glimpses of hope and hurt for a Fed pivot as the arguments against it sort of rise and fall. Valerie, what do you got?
Thanks, Matt. Yes, we heard time and time again from FOMC members and especially Powell at the last meeting that a tight labor market is the key fundamental driver for this late cycle inflation we're seeing, and we need to see cracks before the inflation narrative will turn. The market was so keen to jump on two themes this week that jumped out that showed there might be some cracks. The first was the JOLTS data we got out Tuesday that drove a huge bounce in risk assets. The ratio of job openings per unemployed individual dropped from 2 to 1.7. This 2 number was specifically mentioned by Powell in his testimony and in his questioning. So there was a bit of relief in risk assets when we saw to get inflation down to 2%. We still have a long way to go in terms of seeing cracks in this labor market to give any reason for the Fed to pivot.
All right, Bloomberg's Valerie Teitel. Great work. Thank you so much. Joining us now for more on today's jobs report is Ryan Wang, U.S. economist at HSBC, who is up early for us in New York this morning. Ryan, we appreciate it. Thank you so much. Consensus has 255,000 on payrolls. You're up at 275,000 for today's report. Why are you there? And what do you think the Fed's going to make of a number like that?
Thanks. Pleasure to be here. Well, 275,000, that would be a little bit of a slowdown in employment growth compared with what we've been averaging so far this year. But it's really not slow enough to achieve what the Fed is forecasting over the year ahead. The Fed, we learned, is
looking, Jonathan, around Fed pivot. Bank of England does something because the pension system is having a challenge, that maybe this is a sign of a pivot. The Fed has got to keep going. And, today for markets, listen, softening of the data is something that we're going to want to see.
You sound exhausted after this week. What a month the last week has been again. What are your thoughts on that?
So I would say there are two parts of it. One, it is the most exhausting. I mean, trying to parse all this data. And by the way, spend a lot of time looking at corporate earnings and what's happening to margin pressure. Is business spend going to slow? Because I think that's going to trigger. Is this business spend going to start to come off? So, gosh, there's a lot you got to go through. I mean, I seem to get up a few minutes earlier and go to sleep.
Jerome Powell says we've reconsidered and we think we've done enough to tackle inflation in the short term. The market will rip upwards. So I don't think it's a time to take extreme moves. I think it's a time to stick with your plan. Make sure that you have a risk profile that fits with your longer term goals and go through this volatility in a way that doesn't take too much risk against trying to time it day to day because it's just too volatile.
And I didn't hear you mention bonds. I mean, you're getting some nice yields on the short term, longer term dated bonds.
It just depends on the timing, as always.
Altaf, I know you have thoughts on this. You stay there. We're going to go to break, but we got to talk Fed pivot next. I'm sure we will get very thoroughly into it. Altaf Kassam, head of EMEA strategy and research at State Street Global Advisors, is going to stick with us. And thanks, as always, to our very own Christina Kino. Now, coming up, the latest jobs data out of the U.S. reaffirmed traders' bets on another big rate hike next month. Now the focus turns to inflation data due this week. It's CPI week, folks. That U.S. outlook is up next. This is Bloomberg.
Pivot narrative for the Federal Reserve, the jobs report really solidifying the idea that they are going to stay hawkish. And that was definitely evident in the Asian session overnight, where stocks broadly were lower, including China, which opened back up after a week-long holiday, and it was a negative reopening. The CSI 300 down about 2.2%. Now, in part, that had to do with the Caixin Services PMI number that is back in contraction territory. But the other big drag is technology stocks, specifically chip makers, after, as Anna mentioned, the U.S. announcing new tech curbs from U.S. technology, export controls tightening, and that weighed on chip stocks really across the board in Asia. One of the big examples being Shanghai Fudan Microelectronics, down 20% just in scale here. Obviously, early last week, we were talking about the possibility of a Fed pivot. The jobs report on Friday seemed to throw a huge bucket of cold water on that. We await inflation later this week. Where are we on that pivot narrative now?
Yeah, absolutely. You know what? I wanted to buy into that pivot narrative. I wanted to be the bull in, I don't know, the China shop. But it's disappointing that particularly the participation rate ticked lower, because, a lot of that narrative is built on the idea, the bullish narrative is built on the idea that workers are going to come back to the economy and, push down the inflation story. And now we saw a little bit of a wage inflation coming down as expected, but the participation rate falling, and I think that's worrying. But really,
where you look at the markets and just the massive moves in the markets overall as well. So even if the Fed were to say pause or pivot, we'll say pause or stop raising rates, the QT piece of the puzzle.
So 35% of the S&P 500. So I kind of thought last Monday and Tuesday was silly that people thought that the Fed was going to pivot. They can't pivot. The inflation is way too high. Core PCE at 4.9%. The CPIs and the PPIs this week are going to be north of 8%. Even if they come down and they're a little bit better than expected, it's way too high. So the question you guys were just, or the biggest question that you guys were just talking about is, when will the Fed hikes actually be felt? And it is going to be something like 2023. I think it's sometime in the first half. The irony of all of this is the Atlanta Fed GDP now, they actually revised GDP for the third quarter to 2.89% from 2.7. So the growth is still here. Momentum is still here in the economy, but it's slowly going south.
I actually think the biggest question now is, what are they going to...
With the Fed pivot breaks investors' hearts. It's going to break a lot of hearts again, isn't it?
That was last week. Let's hope something else sort of reestablishes another romance.
Mohammed sticking with us through the next 60 minutes or so. We'll catch up with Michael O'Rourke, Chief Market Strategist at Jones Trading. Looking forward to catching up with him in the next hour as well. We'll touch base with AMH down in D.C. Next. From New York, this is Bloomberg.
So I think until we see a Fed pivot, the markets are, especially in the crypto markets, are likely going to remain choppy.
Well, if they remain choppy, I'm just wondering if that actually means a breakout of the range we have seen for about 4 months now. Matt was just talking about how all of a sudden this seems like a boring asset class almost, and that volatility has disappeared and we just remain in this range around the 20K level. Is it more likely we get a breakout materially to the upside or to the downside?
That's a good question. So we are seeing that Bitcoin's finding resistance at its 200-week moving average, and so
give different language to try to assuage some concerns. Whether we're in a recession or not doesn't matter. And I will tell you, I'm sure it's infuriating to a lot of the audience out there that we talk about whether we're in one, not in one, because for a lot of people, we've been in it for the better part of a couple of years. With that said, we're absolutely in an earnings recession. And at a certain point, you're not paying as much for earnings as you were a couple of years ago. So what's the right multiple? We've played the game. Dan mentioned it. I think Savita put a $200 price target in terms of EPS for the S&P. 15 multiple, and that's 3,000. It gets you right to Mr. Diamond's level. So you look at the HYG, I think it was a 15-year low today within a couple points. LQD levels we haven't.
The whites of the eyes in terms of, say, economic growth, which will actually cause the Fed to pivot. They're not there yet. Okay, so those are three things that we're very focused on, and it's just the cake is.
For now, and in general, with the labor market remaining very robust, as we saw from data on Friday, the Fed is unlikely to pivot. And I think Powell has been very clear in his message that they're going to stay on their hawkish path.
Okay, Ksenia, thank you very much. Bloomberg's Ksenia Galuchko with the latest on markets. And for more market analysis, check out MLIV Go, the function to use on your Bloomberg terminal to find the Markets Live blog. This is Bloomberg.
By this notion of a Fed pivot, but you've been busy trying to look through it and argue that even if one comes, sure, it could lead to rallies, but it's going to lead the market to think about longer-term issues that the Fed really can't do anything about.
Well, that's right. I mean, we're very focused now on the path of earnings, right? This is the second part of the fire and ice narrative. And, while the Fed is still critically important to asset markets, we don't think there's an imminent pivot coming anytime soon in terms of like a true pivot where they not only pause, but really start cutting rates. We think that will come when it becomes apparent that we're either in a recession or there's some sort of, stress.
But they will go 50 in December, probably go 25 at the start of February. But then I think they'll stop. And I do think that within the next year, we will see a Fed pivot of sorts, because at some stage they've got to find themselves an off-ramp from this. They want to sound hawkish, but they know. I mean, a lot of economists are saying what I'm saying. I'm startled by how many economists are seeing this, exactly the same thing. With inflation is coming down, they don't need to put the economy in recession to kill it.
So this sounds like you are getting long, or you already are long, some of the longer-dated bonds, particularly in the U.S. Is it positive for risk assets if they start to decelerate the pace of rate hikes into year-end and into the early 2023?
Yeah, I think so. But I think the setup is positive for risk assets because, frankly, everything's on
in the same place.
Stephen Stanley joins us now, Chief Economist at Amherst Pierpont. Stephen, you're expecting a U-turn, a pause, a pivot from this Fed anytime soon after that data yesterday?
Good morning, Jonathan. I'm sure they would love to, but no, it's not in the cards. I mean, clearly inflation is becoming more entrenched. The breadth of underlying inflation right now is just very troubling. And I think it's going to be a while until the Fed gets inflation under control, unfortunately.
Stephen, as the data that we got yesterday made you rethink the terminal rate that the Fed would ultimately get to in this cycle?
So my estimate was already above 5%. I think, I'm sticking with that for the moment, but I think there's certainly, some upside risk to that. I definitely think we'll see another
the impact of sterling and the like, but most importantly, the market has been burnt so much by these Fed pivot trades. They were all taken off, totally flipped, and maybe they flipped a bit too much.
Okay, fair enough. So you think there may actually have been something substantial behind the rebound, Jeff? If we could focus on the dollar as well, not just the equity market, because you also saw a reversal to dollar weakness. Citi publishing a note this morning saying that it's actually going to be a dollar strength story until we actually get a turnaround in the global economy and growth starts to pick back up. How much further does that dollar rally run in that scenario?
Broadly speaking, the dollar will rally, but I think it's time to start to think about differentiation. So if we look at LATAM, for example, there are quite a few candidates for relatively
that just goes to show you how much the market in general is kind of really looking for that turning point and potential, Fed pivot down the road. And I think Bitcoin in particular, as I mentioned, we've seen a lot of capitulation already happen. This has been a year in which Bitcoin has had its so-called Lehman moments with all these big blow-ups, which again has kind of flushed leverage out of the system. In the same way that ultimately, Bear and Lehman blowing up in 2008 was good for, flushing excess leverage out of the system. Bitcoin's seen something similar. So now the question is, when does the risk bid come back into the markets? And that's where all eyes are kind of, again, really looking at the Fed and a peak in CPI and a peak in the Fed funds rate.
I don't want to oversimplify.
Could see by the end of the year the 10-year under 3.5%. That's very counterintuitive to what the Fed wants to do. But once that Fed, we don't need the Fed pivot. I know that word has been used ad nauseum, Melissa, but just a Fed exhale or a Fed pause, that will move rates lower and that will let equities come back. And that is maybe, Mel, the midterm, late in the year election rally that a lot of people have been talking about historically for the last 85 years.
Shepard Smith here. Thanks for watching.
Multiples could be flat for the next year or so with earnings going down, but multiples a little bit higher as the Fed later on next year actually begins to pivot and lowers interest rates. But in between there, we're going to see continued pressure with respect to 10-year yields and in respect to
has, and it's going to right now. It might happen a little bit faster. And when I said, by the way, that, when the Fed pivots, when ultimately they react to job losses, that doesn't mean that the economy has stopped falling, and then some reaction to that is still there from many sensitive asset prices. Many, again, industrial and materials, these types of companies and these types of sectors, again, just the fact that the Fed will not tighten further at some point is not going to mean that they won't react to that further deterioration in the economy for a time.
So if that's the case, Stephen, the way that investors or traders, I mean, there's a distinction between the two for sure, based upon tactical and strategic moves with money. How exactly then are you advising clients to position given that economic outlook that could be the better part of next year in that negative zone?
How does policy change?
The risks are we have a more hawkish Bank of Japan. But I think that they're waiting for the Fed to do their pivot. I like the puppy pivot analogy there. Hopefully we get that pivot by February, March. And then the Bank of Japan will sort of be rescued in a way. They won't need to hike interest rates or change yield curve control or be aggressive on monetary policy because the underlying fundamentals of Japan, core CPI in Japan is nearly 9 times slower than America. So there is no need to be looking the same as the Fed. But in April, we get the sort of wage negotiation data. And if it's strong, if we have second round effects from Japan, then maybe we do get more hawkish Bank of Japan going forward.
Meanwhile, over in the United Kingdom, I do want to get your thoughts on what's going on over there because you had a 5 of 5.
The Fed pivots. What's happening now? The cost of capital is going higher. So there's a duration trade. That's pushing prices down. That's pushing stock prices down. More importantly, we haven't gotten to the fundamentals rolling over. Now the fundamentals have to roll over. I think we are going into recession. I think numbers do have to come down. Until that occurs, we're not going to wash things out. Can you make money? Yes, you can make money renting things, not owning things. Can you make money in certain sectors?
What are we renting then?
So one of the things we've been talking about to our clients is momentum. Now, it's nothing exciting. It's nothing really sophisticated, but it's things that are working. Stocks that are working, sectors that are working will continue to work. What you want to
commodities, Marco, on the opposite view. Was oil included?
You know, so oil, I think, is really going to have to wait for the Fed pivot. But at the same time, what's coming out of China is encouraging, both on zero COVID. There's a lot of things that are not being reported. Also on real estate, they seem to be putting in a bottom. So I've been bearish for most of this year on oil. I think that's helped stocks in some way, shape, or form. It's helped CPI get to where it is. I think going forward, it's a much tougher call, and it's going to depend on what happens in demand, and that's a China call. I do think policymakers in China are going to have to step back because they're facing a lot of political risks going forward if they don't put in a floor in the bottom.
We'll have both of you on very soon. Thank you both.
Of the weaker data come in. So can we infer that weaker data is really going to be in the driver's seat and not necessarily a Fed pivot or pause? I hate using this word, but some kind of retracement by how quickly the Fed's going to be going.
Yeah, I think we're going to be looking, say, let's call it data dependent. And as the data weakens, at first people are going to, oh, this is okay. It allows the Fed to pause. There's going to be some concern. This is actually going to be good. We get rates stabilized. My real concern is that then the pendulum swings way further and the data is so bad that people have to really pull back from risk. So that to me is the final stage, is a real risk off type rally where you see much lower yields, much lower stocks. But I think we still have a small chance of a soft landing. I don't think we get it, but that's what the market's going to start pricing in first, is a softish landing. And that's,
I guess before we get into that, Everett, talk to me a little bit about, for you, what does a Fed pivot mean, and what does gold need to see ultimately in terms of the Fed? As when you talk about a Fed pivot, it varies depending on who you're talking to. Some at this point are at the very least neutral kind of stance.
Would be expecting the Fed to completely reverse direction. The completely reverse direction. The exact definition of a pivot that we know. And we finally, I believe, have reached that point, given the downtrend in prices. And that's what I think we should expect going forward. I've somewhat changed my tune on the Fed pivot. I mean, I'm not going to waffle here and say that if the Fed simply slows down in its rate hike.
Narrative that builds a Fed pivot and a sustainable move. The positioning that you're saying that looks a little bit more comfortable and prepared for downside, does that lend itself to anything more than a couple days?
Yeah, so for active managers, again, if they're just light on risk, and when there's a move that goes against them, and either they're CRO or just they themselves say, oh shoot, like I need to protect myself in case a 10% rally happens, and they use options to go ahead and protect themselves, that can stymie the rally out of the gate. But if it becomes sustained, that actually forces folks to actually change their core positioning, meaning no longer just, buying, some calls to protect themselves for a continued rally. They'll actually go out and
5%, that's already a decent level of tightening being priced in. I'd say the main question is, when will the Fed pivot? When they, if they eventually pivot, and this would be at some point, in our opinion at Carmignac, around mid-2023. And this puts, again, some pressure on longer-term interest rates, because it would mean that the Fed will be shifting a bit late, and hence it will be weighing on growth and hence weighing on longer-term rates.
So, Kevin, when you look at all of the concerning bad news across the world in terms of valuations, in terms of inflation, a possible recession, where are you putting your money right now?
Well, again, on equity markets, where we prefer to allocate assets is in those parts, I'd say.
We don't want to say the word pivot, but a pause coming. The Fed is starting to communicate that's likely to be in Q1, likely coming at the end of the year. The market is going to start front running that, given these other flows more and more. I ironically think that on the back end of that, so this positive window, we start to see a real tail. So I think be careful getting caught into this next rally, thinking that it's going to be a secular move into, after and that next year. That's the sentiment that.
Taking a look around. And that's a huge change, because if the Fed is potentially going to pause, it's not a pivot. It really changes how risk is positioned, because investors wouldn't necessarily be short bonds, right? So interest rates don't necessarily have to keep going up. In fact, I think a lot of bond managers are making that observation now. And if interest rates plateau or start to come down at a time when there's almost record short positioning in equities, there's record put buying, record gamma on equity, put buying for gamma on equities, investor sentiment is record negative, that's a huge positioning off sides if the Fed is pausing. So, Sarah, you're right. I mean, it's like a Chicken Little question, but I think that this past
Fed pivot anytime soon. How crowded is this long dollar positioning, and will
the markets continuously trying to predict the Fed pivot and call for a risk rally, a selling of the dollar for so many times this year, and
we can't see a Fed pivot until we see inflation come down in a meaningful way. We heard that from Evans yesterday. They're going to continue to keep their pedal to the metal. The foot's going to stay down. Global banks around the world are going to continue to raise rates, probably to the point where they can get a hold of this inflation. The problem is it takes time, and generally speaking, it causes a recession. Now, a recession can have a further effect on helping inflation, but it's a self-fulfilling prophecy that's no fun.
Yeah, I think a recession would definitely have a impact on inflation, probably driving it downward. So I also want to touch on some of the news that we have this morning. The 2-year at a 15-year high, the 10-year at its highest.
A Fed pivot, but there is no signal yet, either in the data or in the Fed communication, that they're indeed going to pivot. So I think they continue to deliver here. I think the Treasury market is fairly priced today. I think it offers value for a lot of things that you own in your other parts of your portfolio. If we do have an over-engineered Fed, we have recession risk, it allows you to really offset some of that with Treasuries. But don't forget, the other darling of the cousin of the stock market are the credit markets. And what we're seeing in credit today, I mean, you can buy investment-grade bonds that yield 8, 9+% today. So it really makes sense for a lot of investors out there to really think about balancing a lot of these risks in their portfolio.
Fed pivot is an inevitability because the economy will force them to make a hard decision. What about the possibility? And the context here, as we just discussed, a straight week of gains in airlines that we haven't seen since 2019. We've got copper miners back on the move. We've been actually beating data even beyond just the employment numbers. The Citi Economic Surprise Index is positive. Should we be pricing in a lower probability of recession at this point? Is it possible we could do like the total contrarian thing
Sort of what was behind some of the move up that we saw on Friday to close the week out after some comments related to the potential that we could see the Fed pivot towards the end of the year, potentially 75 basis point rate hike in November and a 50 in December. I've also got my eye on some interesting divergences, Caroline, to keep an eye on. So it's not only rates and the Fed talk as far as what's impacting price here, but you can notice how the ES, much like the NASDAQ and the Dow, recently trading into new lows for the year, the ES down to 35.02. Take a look at how this took out the lows from June. Now, the Russell still has yet to take out those June lows, so small caps have yet to post new lows.
2% using the CPI. Unemployment's 3.5%. I can assure you the Fed's not pivoting anytime soon. With those kind of numbers, there's no way that they're going to take their foot off the brake. That's really it. Their goal is not to worry about speculation.
The 1987 crash. In other words, what it says is the stock market can't handle rates keep going higher.
Right.
They either need the Fed to pivot and tell Dan that the proper term is step down from 75 to 50. Now he could be an official Fed watcher now that he knows that term. And that they either need that or something else like bad economic data or the stock market to stop this yield rise. Otherwise, it's just not going to stop.
Right. Jim, thank you. Good to see you. Jim Bianco. Jeff Mills, what are your thoughts about that neat little stat? I know you like numbers, you like data, but there's a difference in terms of the rise where we were and where we are now versus those other periods where we started from a much higher base and went to, in some cases, double digits in terms of interest rates.
That's true, but I think it's so easy to just...
...are coming down around the globe. What's the message? That sounds like it's bigger than just a thought that maybe the U.S. Federal Reserve is pivoting.
So we shouldn't take much comfort from the yields coming down around the world because they're coming down on growth concerns. The European PMI numbers were horrible. Germany is at 44. And in China, while the GDP numbers beat, there's a lot of question marks about it, especially given what's happening in retail sales. I think what's happening to our market, and it's wonderful to have the best week since June, it's wonderful to see the rally continue, is that we've redefined what a pivot is. We've redefined it from meaning lower rates to pausing to slowing. And if you redefine that, then you will have a liquidity effect. And that's what we're getting. We're getting a liquidity effect rather than a fundamental effect.
In other words, we've lowered our standards and we'll take anything.
I mean, you saw what happened on Friday, and we've really been discussing whether you think the Fed is about to make a pivot and what's really happening to this economy. What do you think?
Well, we obviously saw the market rally really hard on Friday in response to this hope that the Fed would be slowing down the pace of rate hikes after the November rate hike and this interpretation that maybe this is a pivot. Now, if you look closely at that Wall Street Journal article that talked about this slowing, it didn't really talk about inflation slowing faster than expected. That would be the most bull case here. It was more concerned that underlying growth and financial stability could be at risk if the Fed continues to raise rates at such an aggressive pace. So we always knew that eventually they'd have to slow down from those 75 basis points. We think the
Kevin, where are you on this?
I definitely don't think that the Fed is going to pivot, and I don't think that this is a pivot. I think that the Fed is determined that they're going to make sure that they stamp out inflation, and we're a long way from there. You have headline inflation still at 8.2%, and core CPI has been growing as well over 6%. So I definitely don't think that the Fed is at the point that they're going to pivot.
Kevin, do you then look at what happened in the equity market on Friday and just say this is just a head fake? This is just some folks who are a little too optimistic. How do you rationalize what's happening then?
Andrew, the way that I look at it is that you have a period, you're in a bear market, and so we're
translate a pivot, but they don't want the market to run up because then that would defeat the purpose. What did you think of all that language and what people have to digest and try and sift through?
Well, it reminds me of the summer. I mean, the summertime, people, the same type of language was coming out that, maybe they won't have to raise rates as much, or they're going to be cutting in early 23. The market rallied, 10, 15% on that news. I just thought that was crazy. It just didn't really, nothing has been addressed still in terms of the structural issue, which is inflation. We've got to get that under control. They've said we're going to go into a recession, excuse me.
Their thought process on what they're doing. By that, I mean, if the market gets excited and thinks, OK, this is a Fed pivot coming, does that in itself play into the experiment? Does it mess things up for Jay Powell, have him thinking we can't have them believing this good hope, so we're going to have to stay and continue to raise rates for a bit longer, or be more aggressive in the December meeting to send a message?
I think there's some focus on the market, not so much in the psychology sense, the way you're talking about it, Becky, but in the fact that, as Chair Powell and others have said, monetary policy works through what's called, financial conditions and tightening of financial conditions. And one of those tools for so-called tightening the financial conditions is, in the fact, the equity markets. And so, equity market rallies mean a loosening of financial.
We're going from pivot to step down.
What do you think, Jim? Is it potential?
Fast, that slack in the housing market perhaps helping the case for a little bit of a Fed pivot. Once again, yesterday it fed into the bond market, which then in turn fed into the stock market. I want to bring in Ksenia Galushko, the Bloomberg Equities team leader, to hop in on this conversation, because Ksenia, to me, this feels like an early sign that perhaps equities do have a reason to rally if they see perhaps a less hawkish stance from the Federal Reserve. Do you agree?
That's right, yes. So housing prices are starting to finally calm down, and also consumer confidence is plunging in the U.S. And this is good news for inflation and the Fed's fight to lower it, obviously. So yes, perhaps the stock market can start pricing in a potential pivot, but I think the Fed's comments so far have been very hawkish. We are reiterating that they're going to keep raising rates. They're going to stay hawkish for a while until they really see inflation peaking and starting to fall. And it might still take a couple of months or even a couple of quarters.
And Ksenia, that's really interesting then, isn't it? Because this potentially opens up a really big question and a really big opportunity, and the market's been wrong-footed by the thought of pivoting before and is very mindful of that. Where do we see the bottom as now for stocks? Because I know Goldman Sachs thinks we're not there yet.
Well, yes, so it depends on who you listen to. So Goldman Sachs indeed says that the U.S. stock market, despite the plan...
The back end's going to come down too as the market starts to think about the Fed pivoting. And then the last thing is the earnings story. As you guys know, I mean, that's where we've been focused. We're probably more bearish than most on the outlook for next year. But, we got earnings this quarter. And what we just don't think we're going to get, John, is we're not going to get the full capitulation from companies on 2023. We think it's just going to take longer. We've written about that quite a bit. You read our research, so how we're thinking. We're still bearish in the intermediate term. We don't think the bear market's over, but we do think this tactical rally is going to be big enough to try and pivot and trade it. For those clients who can do that.
How far along, Mike, are we in this?
There's talk that the Fed might start to pause or at least come off a bit. Do you think we might hear that?
No, I think that's still wishful thinking. No, I don't.
About a pivot. And I do think once the central banks start to pull back that bond correlation with stocks may act a little differently. And yeah, I mean, personally, I mean, so there is finally an alternative in fixed income. And for us, that's, refreshing, because there hasn't been. Investing in a zero rate environment was not fun for a bond investor and a credit investor. And now there is alternatives. And to us, that's great.
We're looking at a chart down together. Not a lot of instances where we see them both to this extreme. How do we make sure that we're not falling into another trap, though, George? I've heard the Fed pause and pivot thing a few times this year, and it always comes back to bite us.
Fed will ease, but it seems like the market is hopeful for a pause at some point. Is that even worth thinking about at this point? Not even a pivot where the Fed changes course, but just a pause in the hikes.
Rakes, and I think the market's waiting for a pivot. And then the other thing is just going to be, at the end of the day, the Fed, I don't think they care about investment portfolios. I think they really care about the person living paycheck to paycheck. They want to
of a Fed pivot, we're finding ourselves in that same place. We have better earnings than anticipated, still pressure on profit margins, but it's the story of a resilient consumer. And I think that's something to be cognizant of and really understand. But we have the Fed coming out on Wednesday, and he's really reliant on data. And so even though there's cracks, there's still unbalance in the labor market. So it's going to be interesting to see if exactly what happened last time, if Fed Powell is going to come out and tell us that he is indeed not anticipating a pivot anytime soon.
Okay. Any final thoughts on Starbucks, which is around $86 right now?
Well, I like what Jessica's talking. Oh, I'm sorry. Go ahead, Jessica.
Okay. No, Ben, go ahead. Ben, no, tell me, Ben.
I was going to say I like
pretty large global economic headwinds. We do think earnings are going to continue to be challenged, and the Fed is not going to pivot anytime in the next few months. So, that sort of trifecta of headwinds is going to be, we think, pretty tough to overcome on the macro level. And so, if this is a case where you need the money in the next couple months, probably go ahead and take it out. I think you'll probably be pretty happy. But if you can stomach it for the next 12 months, this is not a bad place to be able to hold in there.
I see. Okay, I'm glad I asked that question. Scott, it's nice to see you. Thank you for all of that. Appreciate it. Scott Landler, Horizon Investments.
Into stock market reaction, because to Kriti's point, we've seen one of the big drivers being Fed expectations, of course. And if we start to see some kind of pivot or step down in the Fed policy at a time when the earnings story gets worse, does stocks go up or down from there?
Well, it's tricky, right? So I think we're at peak Fed hawkishness, or very close to, or a peak, by the way. I think there'll be another peak later on, right? But I think we're at current peak inflation. So we're at a peak in Fed hawkishness, a peak in global central bank hawkishness. But guess what? If you look back historically, when the Fed stops hiking, so the end of a Fed hiking cycle, the stock market essentially goes nowhere for 6 months before the rally comes. So even if we do hit peak Fed hawkishness, this is not a sign you're going to get this immediate kind of upturn and rally in stocks that people might be expecting.
Simon, obviously the Fed is aggressively. And I think that's where the nuance in this conversation around whether the Fed is pivoting or just going back to 50 basis points, maybe possibly 25 basis points down the road becomes important. We've seen this narrative play out in other economies, particularly in emerging markets, which the U.S. inflation right now is behaving like an emerging market economy from an inflation perspective. You pivot too soon, or if you step down too soon and second round effects are starting to de-anchor, then you run the risk of actually losing your credibility as a central bank.
Yeah, interesting comparison. Kriti.
Yeah, Diana, I wanted to ask you specifically about the Fed's thinking here, because what seems to be baked into market consensus, and arguably perhaps Fed thinking as well, is that
at the top of the show. So I guess when you look at the impressive gains that we've seen in October, is it just a head fake, just a bear market rally in your mind?
I'm concerned that it may be, and I think of it as the Powell pivot pain. And so again, I think that if I look at this rally, it's being set up on optimism
of the Fed, that we're getting the sort of stage one of the pivot.
And second round effects are starting to de-anchor, then you run the risk of actually losing your credibility as a central bank.
This is Bloomberg Surveillance, early edition with Anna Edwards.
To see in the data then as we go through the months ahead, because if the Fed wants to step down, if the Fed wants to pivot in some way and stop these jumbo hikes, they'll need some data to sort of pin that on, one assumes.
Right.
Is that most likely to be a drop in core inflation, some quote-unquote success in increasing the unemployment rate? I mean, what are they going to be able to point to as having changed?
Well, I think the main thing they're going to focus on is less the inflation numbers. And they always look at everything through a 3-month moving average, right? But they want to see at least the employment numbers dropping into the 100s as opposed to being over 200. 100,000 is considered neutral. So if they start seeing a 125, 150 kind of number, and they see inflation starting to ebb off, then I think they'll feel a little bit better about where they are. But is
it changed dramatically? Well, it seems to be that a lot of what happens now is
do any pivoting. I think that next week I agree with mostly the general idea that we'll.
Or is bad news good news, right? So bad news, good news would be, well, we get a liquidity scare, the Fed intervenes and actually pivots, and we're off to the races, because you really need the Fed to pivot historically for markets to perform. So that's kind of short-term thinking. Bad news is good news.
Real quick to that point, because it's very important. which is that is there a possible type of liquidity event at which the Fed intervenes that does not cause long-term structural damage that will eventually come back? Or is there just a moment where there's a rate of change, perhaps, argument where the Fed says, okay, we went too fast. That rate of change is intolerable, because that wouldn't be a structural problem.
To the latter part of your question, the Fed will only know if they went too fast in a few months, because there is a lag between monetary policy and the impact on employment and the economy. But
on the signs of any Fed pivot.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City for our audience.
Positioning point of view, it will last longer than markets hope. Right. So there will still be repeated efforts to price in a Fed pivot trade through equities, through bonds, through FX, through the dollar and the like. But I think there's still a few more rounds of disappointments to come. We look at where Fed terminal pricing is, right now it's going up, whereas everywhere else now it's probably going to start coming off.
Jeff, we've been discussing whether you should be trading growth expectations or rates when it comes to the euro, when it comes to sterling. And Lisa's been building on that in this conversation too. Based on what the Bank of England's just said, is that positive news for sterling that they're pushing back against a higher terminal rate that would have actually hammered growth over the next couple of years?
Compared to the US, there are different worlds, and we have to try and diverge ahead of when the Fed finally itself will pivot, which I think will be early next year, if not possibly even before then.
Marcus, what kind of a problem does a potential reopening, a slow reopening of China cause for the Fed, the ECB, the BOE, in that maybe that does provide a growth boost, but it's also demand that can boost inflation?
I don't think it's really on their radar yet. We just don't know enough about when it's going to happen, if it's going to happen, the strength it's going to happen. That's going to be one of those problems we're going to have to take as it comes along, adding yet more complexity. I think front and center what goes on in Ukraine and with energy is more important. And clearly we're seeing feed-through effects now into housing in lots of markets around the world, including the US.
That everybody's focused on right now, which is the prospect of a pivot, the pace of rate hikes, and that peak in the policy terminal rate. We think with the Fed, there is increased prospect of a downshift to 50 basis points, and we're going to move towards a slower
high yield today. We think that there's been a little bit too much of this belief in the Fed pivot, the risk rally we saw in equities. And so it's looking a little rich again. But there are things in like the securitized markets, a little more esoteric, things like commercial real estate where people are extremely nervous that, for
the market is quite rightly preoccupied with any potential for a Fed pivot. But arguably a pivot out of Beijing with regards to zero COVID could be just as important. If China reopens, given the size of its economy, it could be hugely positive for growth. First up, we'd like to think it would probably be okay for inflation in the sense it would free up supply chains. So it shouldn't actually add to any inflationary pressures, at least in the immediate term. So generally, it would probably be interpreted by markets as a big risk-on sign. So that would be equity market positive and dollar negative. So those would be the big, I think, immediate implications as the market would understand it. On our modeling, actually, Chinese equities continue
some kind of rollover there. I want to focus again on that CPI report that's due out Thursday. Given the constant hope for some kind of Fed pivot, what exactly is priced into equities? What isn't?
Well, it's interesting. The consensus says we'll have a 0.48% month-on-month increase in prices. And many of the forecasts I'm reading lately from the bulge bracket banks are saying maybe it's 0.4%. I think the market is leaning towards a positive surprise on CPI this week. I would just caution against extrapolating too much from one reading. Focus on the shelter component. Last month's shelter was about 31 basis points of the total core CPI for the month. Effectively, to get down to a 3.5% annual core inflation rate, you would need everything else in that index to be at zero and have shelter where it is now. So I think we want to watch the trajectory of shelter.
Are constructive on it and thinking about timing.
Hunter, I don't think it's coincidental that Bitcoin topped out just as our Federal Reserve pivoted back in November. And the fact that Bitcoin has not been able to get off the mat since that time effectively says that this becomes just a central bank play. So is it as simple as that? If global central banks flinch or blink or whatever dumb word people want to use, that's when Bitcoin takes the next leg higher?
I think it's definitely part of the story. Crypto is not bigger or separate from those considerations. But I think you saw an interesting thing last week, for example, with the hawkish comments coming out of the FOMC meeting, and crypto was higher last week. So there are different drivers in this space, and there's a lot of positive development underneath the hood. And so
central banks are really still in the driver's seat here. We're very focused on the Fed here, everyone waiting for that Fed pivot. The problem for me, and thinking about the dollar outlook into next year, markets have not adjusted to this new Fed. They're still thinking about the Fed in the 2018, 2019 context. When will they pivot? And the Fed is out there telling you time and time again, we do not want financial conditions to ease. And there's many axioms out there I've found. You never want to fight the Fed. And the Fed wants tighter financial conditions. They want a stronger dollar. They want lower asset values. And that's going to continue to be the trend, in our view, heading into next year.
I don't want you to be an equity strategist, but why not? Will the Fed pivot tomorrow, and should I get out of cash?
Well, you and John and Lisa were having a great discussion earlier about the risk-free rate, in particular the real risk-free rate. We're looking at 1.5%, maybe even 2%, depending on where you look on the curve at real rates. It's a very enticing opportunity there relative to where we've been the past few years. And certainly we're seeing that reflected in relative performance and absolute performance of assets. I'd say I'm very concerned about year end, particularly from a funding perspective, thinking about the moves we've seen in the market this year. And that could be what really drives
three longs he used way away from reaching their goals. So that's why any talk of a pivot is entirely premature. Mimi, I do wonder if what we hear from Fed officials will continue to be hawkish, because to some degree, it's about credibility, right? Does just backing off of these rate hikes seem to diminish, the guidance more or less they've been giving markets?
It's really interesting because on the one hand, we're sort of waiting for the Fed to pivot and to give us this signal. On the other hand, inflation and certainly employment data has given them absolutely no reason to back away up until this point. So, we're hypercritical of a Fed that actually has started to regain some credibility, to your point, by keeping a pretty firm line and relying on the data. So my point is more, if you do see the turn in the data, you are likely that has the potential to have a big bang effect, far more than potentially the pivot from the Fed. So I think you make an excellent point.
How willing, in speaking to clients, are they to take this bet? Because, as you say, China officials do come out, say we're committed to COVID zero, but then, you have Olaf Scholz in China talking about an mRNA vaccine.
We're going to do what we need to do to bring inflation back down.
Neel Kashkari there, the Minneapolis Fed president. His words, any talk of a pivot is entirely premature. Price action looks like this on the S&P 500. Equity futures, positive 0.4%. Positive on CPI data that is about, an hour and a bit away? An hour and 42 minutes away, Tom. Yields unchanged on a 10-year, 4.0885% on a 10-year. Euro dollar, negative 0.6%, just in and around parity over the last couple of days. 99.48, and crude from the 90s back to the 80s again. 85.37, down 0.5%. The rumour mill in China still in overdrive. And Chinese officials, Tom, seemingly pushing back against this idea they're going to reopen and drop COVID zero anytime soon.
That's sort of where we are right now. It could change tomorrow. It could change today. I mean, I really don't know where we are.
When it comes to the tightening, the Fed is obviously the most important factor globally.
Everyone waiting for that Fed pivot.
The Fed wants to be more dovish, but will inflation let the Fed, make that shift?
Inflation may have peaked, but boy, the descent is going to be gradual.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene, 30 minutes away from an important inflation report that could move markets. John, it's important, and you mentioned on to December, another inflation study before the Fed meeting.
Yeah, whatever we talk about in about 30 minutes' time, I imagine the story could well change going into the Fed meeting. So we have two more prints, one today, one December 13th, and the Fed meeting on December 14th, which comes with a set of projections, and we've got to work out what they think 2020.
It's tough. They want to front load things and basically fight inflation now while they can, while the job market's still strong. So even if the Fed is going to pivot, they're not going to talk about a pivot right now.
Patrick, just a final question from me. It's something we've been thinking about more and more over the last couple of weeks. Can you really deliver 400 basis points of hikes in 8 months and then say that the price was just a 25% move in the S&P 500. Patrick, I just take a step back from it all sometimes and look at the screens. I'm just wondering where the pain really is. Is this it, or is this the calm before the storm?
I'm cautiously optimistic on equities right now. The multiples, the Fed's destroyed the multiples on equity markets. The earnings outlook is the risk. If you can find companies that have resilient profit.
Any excuse to grab onto the narrative of, first it was the Fed is going to pivot, and then Jerome Powell had to throw cold water on that one a couple of times, and now it's this idea that okay, we finally have turned the corner on inflation. Well, on a
rally really on some good inflation numbers. It got ahead of itself. The market got ahead of itself this summer. Everyone was talking about Fed pivot, because the gasoline.
Coming up, cooler than expected U.S. inflation, investors rushing back to junk bonds, all with eyes on a potential Fed pivot. We begin with the big issue, a 7 handle on U.S. CPI.
Inflation starts to come down.
Supporting the case of inflation rolling over.
I'm not touching high yield today. We think that there's been a little bit too much of this belief in the Fed pivot, the risk rally we saw in equities. And so it's looking a little rich again. But there are things in like the securitized markets, a little more esoteric, things like commercial real estate where people are extremely nervous that, for a double B portfolio, yield almost 10%. If you want to, sorry, I meant to say triple B. You want to go to double Bs? I mean, you're talking 12 and 13% yields. So, you can make some price mistakes is what we talk about in the bond market, right? When you have yield.
Lindsay Rosner, Winnie Cesar, and Luke Hickmore back with us. Winnie, let's start with you. Are you touching high yield here?
Well, I can't say that we're not touching high yield. We have a
very elevated inflation environment.
Even if the Fed is going to pivot, they're not going to talk about a pivot right now.
There is no Fed member that wants to go down in history as losing the fight on inflation.
The problem is you have a little bit more tightening from the Fed reducing the balance sheet. So I think we still have a way to go. I don't think the Fed's in pivot mode or anything like that. Like I said, the market's tried to game this a couple of times.
To, pivot and slow down rate hikes. But realistically, the FOMC members were pretty adamant yesterday, the ones that spoke, that really isn't on the table as of yet. Now, the CPI data coming in softer than expected was a pleasant surprise, but let's not forget, during the month of October, crude was on a rally versus on a sell-off. So we may not have seen the actual pricing of that energy. We haven't seen the effects of that pricing of energy. And more importantly, we still have to keep an eye on PCE data, which is coming out sooner than later. Now, if we see that, these inflationary data points temper and then jobs numbers, kind of cool off as well, that could be a very big boost.
About to see unfold is the Fed dialing back from 75 to 50 basis point rate hikes. That should happen in December. Yesterday's data suggests, and if we had another good month of, or at least,
inflation dropping like a stone. And also, let's talk about the Fed pivot for a second, Jared, because the Fed will pivot. By definition, things don't last to eternity. So at some point, the Fed will stop raising rates. At some point, the Fed will even cut rates. That's undeniable. It will happen. Now, why will that happen? That's the question that I don't hear many people answering. And in 2001, the Federal Reserve 50 basis points. So yes, the Fed pivoted. They cut rates by 150 basis points in 3 months. If I ask you, what was the equity performance and the dollar performance in those 3 months when the Fed literally pivoted by cutting rates? Most people would say equities rallied, the dollar weakened. No, sir. The dollar rallied another 6% and equities dropped another 12% in those 3 months. And why? Because the Fed pivoted, because the economy was coming down very hard, because the labor market was weakening aggressively, because earnings were revised down. A Fed pivot is not necessarily bullish if it comes when the economy is already rolling down very hard. A Fed pivot might be good for bonds at that point. It might be good for defensive equity sectors, but it doesn't mean you can go back to the 2021 playbook and lift all unprofitable companies out there because the Fed is cutting rates. It's not that simple.
I want to get to something you pointed out, and I think is extremely relevant, which is Paul Volcker was the last Fed chair
to preside over an era of high inflation, roughly 72 to the low 80s. So this was a long time.
You want to buy stocks when earnings are dropping and people are getting unemployed because the Fed has pivoted? You want to buy stocks when the Fed has pivoted and earnings are still growing, which was what happened in 2018, in 2019, and in any episode where there was a drawdown in the last decade. But this time there will be a lot of damage before the Fed pivots. That's a different a different background.
Alf, I'm really glad you're here to explain this to everybody, and I think people should just really let that sink in. While I have you here, I want to ask you about the Bank of Japan and the head of Bank of Japan, the head of Bank of Japan, Haruhiko Kuroda, whose term is up in April. Now, this isn't as relevant to U.S. investors perhaps immediately, but Japan is a really interesting circumstance here with the amount of QE that they've been able to.
On some of this Fed pivot, I mean, are these the type of jobs that they've been looking to maybe, kind of crack open a little bit? Or are they going to have to keep mining deeper? I mean, does any of this stuff really matter if they don't get the employment change that they're looking for?
Yeah, obviously, the Fed and other central banks are looking to cool the very tight global labor market. And it's not just tech jobs, it's broadly speaking. I think next we could start to see jobs weaken. Jobs cost money, and corporate cash flow is starting to slow down here, which points to job losses, at least in Europe. I put together a chart here. The orange line is the growth in cash flow dropping below 5%. Whenever it does that, you can see here it tends to lead job losses by about.
Consider that to be a mirage that would rather fade, and we don't own any businesses like that, but we would, if you did own any of those, we would advise taking.
What's driven the market in the past?
You kind of spelled it out, and it sounds to me like you're saying it doesn't mean necessarily that rates are going to fall.
It's just not yet backed by the Fed.
Elizabeth Saunders, thank you so much. Greatly appreciated today with Charles Schwab on the equity market and the linkage there into Bitcoin as well. I'm absolutely fascinated where we are in the equity market and the shock and the silence of the cash crew and the bears. I mean, it's a really intriguing moment, and I see it day to day as we put the show together. There's just a thundering silence of the gloom crew over the move that we've seen.
Are you saying that they are humbled by the fact that we've seen a rally?
Is
that the way that you're
I haven't looked at it. You can do this easily on the Bloomberg, folks, and this is a one-year change. The Dow is out of correction stage, negative 7% for 1 year, and SPX.
Pause, if not a pivot. The Bloomberg Dollar Index also a headwind, rising up again today to 1278. The U.S. 10-year yield also a headwind, rising up today to 372, although it should be said that we've been seeing 380s over the last few sessions, and it's much better than the 4 and change that we had seen before last week. So even though yields are rising on the 10-year, they're still really low compared to what we've seen over the past weeks and months. Bitcoin right now is down about 0.1%, still hovering around the same level that it was yesterday and the day before. What's today, Wednesday? No, today's Thursday. And the day before, Bitcoin has just been hanging around 16,000 and change ever since the dramatic collapse of FTX. And it doesn't seem to be...
People now starting to reassess that Fed pivot that the Fed never said they were going to pivot, but 7 basis points here on the day and 19 basis points on a weekly basis. What I think is interesting, though, Scarlett, is that big move in the 2-year, nothing in the 10-year, 3.8195. That's basically where we were last Friday. Similar story on the 20, similar story on the 30. So most of that move now coming at the short end of the curve, and that means deeper inversion that we're seeing on that 2s, 10s, and some of the other key metrics here. Something to keep an eye on. Right. The big question is, what is the bond market pricing in? Is it just the Fed rates, or is it something more when it comes to recession in the economy? Why are we so obsessed with pivot? Why not just pause? Why don't we take it one step at a time? I don't
pause sometime in the next couple of quarters. So from the standpoint of obviously the markets rallying and pricing in a pivot or a Fed, in fact, cutting rates at some point late next year, I think it's
And number two, it's going to show that inflation is going to be very, very sticky and over the next 4 months.
All right, Ethan, want to get your reaction to all that. The NASDAQ got another 15-20% left to fall, that the Fed will not pivot and inflation will prove stickier than once thought. Your thoughts?
Well, I agree with a lot of that, but also disagree with the fundamental premise that we are looking at inflation now being stickier. I actually was very much other holiday seasons. So I think that's going to also trickle through. So I do think that the Fed will not pivot, though. And there's a difference between pivoting and decelerating. Even decelerating might be interpreted as a pivot, and that may mean that markets do get a little carried away, as they did perhaps earlier. But I see actually more strength going into the end of the year, because a lot of this negative news.
Talking about a pivot, meaning the Fed stopping. Other people saying no. A pivot is when they actually move from a restrictive to a less restrictive stance, which isn't going to come for a very long time. We also get auctions today.
I've said, we'll get to the auctions in a moment. I want to do shout out Mary Daly. I think she is the most interesting Fed official with first order economic skill. And she came from a really tough background. This is not some person that grew up in the suburbs with a silver spoon in their mouth. I think she's got a very unique perspective for Fed officials.
Becoming hawkish as you see people in the lowest incomes seeing the most pain. She really brings unique perspective to this. We're also going to be getting earnings today, including.
And look at that. Don't buy the pivot.
Yeah, if a recession is coming, don't buy the pivot. Basically, this is something that John's talked about, which is if the Fed does not cut rates into a recession, if they hold rates where they are and the economic trajectory is slowing, that is restrictive, even if they're not hiking further. And Bank of America put this out well. They said, to us, a pivot isn't stopping with rate hikes. It is cutting. And that is not going to be necessarily on the table for a while.
Well, it's going to be interesting to see. But certainly for Mr. Dwyer, who's made a career of linking equity drops to recession, this is a unique note. He says, here's the recession, and he has trouble going long.
So Morgan Stanley's Mike Wilson over the weekend coming out today, he basically was defending some of the hate mail that he was getting on his projection that the S&P could fall to 3.
More dovish. Margins are being squeezed in tech. So even with a Fed change, your
And the Fed is likely to pivot.
Are we there yet? Are we there yet? Are we there yet?
We think they're about 70 to 80% done with the tightening cycle.
They're pushing back against the easing in financial conditions.
Keenly focused on the labor markets.
Now more than ever.
What does that mean in terms of the broader inflation story?
I think we're going to have to, we'll see the Fed pivot, but it won't be the pivot that we're wanting. It will be a pivot to maybe away from the average. Will be a pivot to maybe away from the average unemployment numbers to something that's more sustainable through a correction period. And I'm not talking about just, a 1 quarter or 2 quarter. I'm saying that we might have to get used to the fact that we might have some changes for a short period of time as we go through all of these corrective actions, including the raises that we've seen already in interest rates and those more to come. But what we really are looking at, too, is the fact that we have a lot of people that are just leaving the labor participation numbers. They're just saying, hey, I'm tired. I'm not gonna keep looking. So that's really, might be.
Fed pivot to easing. It's only a bullish trigger if the underlying economy is not falling apart underneath it, right? I mean, because the Fed's usually cutting in the early part of the downturn, right? And so that's the tricky part right now, is figuring out what lagged effects are yet to come, and what it means for earnings in 2023.
Michael, to me.
There's the Fed pivot, the China COVID zero pivot. You're still staying pretty cautious.
It's Chair Powell holding on to his hawkish rhetoric and the fact that we have PCE next week, we have payrolls next week, we get a lot of data coming through. We're going to see if the Fed can hold the line.
In the meantime, a lot of people were hoping that this optimism would be fueled by the sense that China would be reopening. Yeah. And overnight, I think this is actually incredibly important. I was reading about the shutdowns in Beijing, the sort of reinstated cases, and that case number. I think that the story of the week, Damien, has really been how much yields have come in, this feeling of a Fed pivot, the idea that the end terminal rate will be lower than what people thought just a week ago, somehow a rebuttal of everything that the Fed Chair Jay Powell said in the last meeting.
Yeah, and you're finally seeing it. You're seeing people push out on the curve. They're taking more duration risk into their portfolios. The asymmetry in fixed income has improved materially just in the last week alone. So, look, we were long calling here at BI for a rally in fixed income. I think we're going to see it here in 2023.
Well, you don't think you're going to see it?
I think we're going to see it.
Yeah, a lot of people think so. And this is really the issue, is that the people think we're heading into weakness. And yet today's Black Friday. A lot of people are going to be shopping. A lot of people already shopped. A lot of people.
The economy is resilient. People just have to keep pushing back the timing of whatever recession or actual Fed pivot you get, that the real pivot is happening underneath in the real economy with some relief in gas prices, some kind of
pressures continue to ease. And so I think it's sort of let's say, we'll call pivot Goldilocks kind of a scenario. Eventually the Fed will pivot in maybe later next year, and the Goldilocks developing around the inflation picture finally start to moderate.
The midterms, when these SPR releases would stop and the Fed spoke again about a pivot, we hear it all the time, and traders ran in and bought oil up.
They may be toning things down, turning down the heat a little to wait and see what happens with the inflationary number. But they're not pivoting. They're not turning and doing an about face and walking the other direction. They have been pretty clear that they are going to keep rates higher for longer than the market's been.
Stage of the future. So quite far from a direction of rates and direction of inflation. So that's where markets seem to be anchoring right now, slowing down.
It's been a tough trade, though, right? A couple of times the market wanted to trade the pivot, and then it got whacked for.
It's about the recession and how deep it's going to be. I think we also need at least a peak in the Fed. And there's been much talk about the pivot. I think the definition has changed a little bit. We see a pivot really as a start of rate cuts, and that's I think too far away for equities to anticipate. And I think also that earnings expectations have to come down. Earnings expectations are positive for the year 23 in the US and in Europe, and I don't think that matches a recession.
Joost, you say that the Fed beginning to cut is too far away for equity investors to anticipate. Does that mean not in 2023? You don't see that?
It may be 2023, but we think it would be quite late in 2023. And then first you'll have the economy slowing. Yes, you'll have.
Is resilient. People just have to keep pushing back the timing of whatever recession or actual Fed pivot you get.
And if the Fed does too much, they're going to undo that relief and over
of the year. And everybody expects that what's going to drive that is going to be falling inflation. We all love to whisper to each other, the inflation rate is going to come in much lower in the second half of next year. We all say that. And really what's happened is transitory never went away. So we're going to have a recession. Inflation's going to fall. The Fed's going to pivot. And that's what.
We appear to be having some technical difficulties with Jim. We'll try him again and see if we can reestablish that. But what he was saying there was fascinating, that basically there is this stealth transitory that has been taking hold of markets. And perhaps that's part of what's underpinning the belief in rate cuts next year, which is what the market is indicating despite the Fed's protestations, where they're basically saying, no way, they're not going to cut rates next year because they need to combat inflation where it is right now and bring it back down to 2%. The stealth inflation has been a concern, and we've been talking about it all morning, that the short and shallow
got their pivot. Well, I've got my pivot too, Oliver, and it's pivoting higher up on the quality curve. Okay. So I have sold some of the little tiny names that probably you and no one else has ever heard of, but that in a low rate environment can be very exciting to own because they're levered to the upside. But in an environment where rates are going up and they're going up fast, nobody wants to own those names. And in the case of the smaller ones, they may not even have earnings yet. So I have done some house cleaning over the past, call it 5 to 6 months. I've sold out names that I love, but I just don't think are loved on the street. And I have rotated into some of these higher, larger, chunkier.
But I think the bigger picture as we move into 2023 is that the market's now.
And because of that, everybody expects the Fed to pivot.
There's this expectation, optimism, if you will, of a potential pivot. And perhaps the Fed may stop hiking rates sooner than we expect.
I think there is going to be a recession. I think it's going to last quite a while. But it's not going to be a dangerous recession in the sense that the Fed can relent at any time and end that recession, which is very unusual compared to past cycles.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Investors waiting for a signal from Jerome Powell. The Fed chair may cement expectations for a slower pace of interest rate hikes in a speech later today. China sends a warning to protesters angry about COVID restrictions. Beijing is vowing to crack down on what it calls hostile.
As the pivot from the Fed. So how far in advance would the markets really kind of latch onto that and price that in as well?
Well, you could argue. Be cautious because that might be a short-lived rally in the markets. One of the things about historical norms is when the Fed actually pivots, you have to be careful of what you wish for, because typically speaking, when they pivot or start lowering rates, there's a lot of damage done to the economy, but also the continuation of the bear market. So in the short run, this actually might be very bullish. but you have to be concerned about the economy now versus interest rates.
The Wall Street Journal's Nick Timiraos sort of alluding to this over the last month and a half or so. Just another example of how plugged in that particular reporter is to the Federal Reserve's thinking. So really, really interesting, the commentary that we've gotten from Jerome Powell so far. Market, of course, jumping on this on session highs. George Tillis, always a pleasure. Senior markets correspondent.
To pivot. We've all been trained in V's. I mean, the last 15 years, there's been nothing but V's in the economy, in
I guess thinking about for ages, for at least 12 months, as I've mentioned, we are not a believer in a Fed pivot. A China COVID adjustment, let's call it, seems to be something like happening. And clearly that's a huge deal. HSCI up 30% in round numbers in November. Something's clearly going on that I think we as investors need to be very cognizant of. So that has implications not just for China assets, but for the region and maybe even for the global economy more broadly. So I think, I personally find it extremely confusing. I want to be upfront about that. But it does seem like China has moved to a more opening stance. I think it's going to be bumpy for sure, steps forward and back and so forth. But I think if it is the case, and it seems like the case, that China's moving to a slightly quicker pace of opening.
What are companies waiting for? Is it a Fed pivot? Is it stock market just not having these volatile spikes? Is there one thing you hear when you talk to folks?
Volatility. Volatility to come down. The benchmark that I always look at, the VIX. The VIX is above 20.
Is likely to be treacherous, but that is likely to be the entry point into risky assets, because once the Fed has the gap, that's when they'll be ready to pivot, and that's when risk assets can finally.
We do get a mild, mellow recession. I would not expect the Fed to pivot anytime soon, especially taking rates down to zero. That is, I think, not happening anytime in the near or even medium term. So we do have to get used to this environment of higher rates. It is very.
The esteemed professor of the Wharton School told me a little while ago in this program today that Powell did a quasi-pivot. Did you see that? Was it a quasi-pivot? How would you characterize what he said?
Right now, because the market keeps just desperately sort of clinging to that notion that the Fed can pivot, and none of the data would suggest the Fed is likely to pivot anytime soon. So we're going to be in this sort of volatile climate for a while.
Gina, just quickly here, on the flip side, could people say perhaps earnings are going to be better than people are currently saying in the first quarter, because we are seeing those hirings, because we are seeing those wages being paid, and that earnings are not going to come down as much as some people are suggesting?
Yeah. Doubtful, Lisa, because employment is not really one of the best drivers of earnings growth over time. I think employment certainly is a key factor for the Fed to watch, certainly is a key factor defining economic conditions broadly. But when we look at the factors that really drive earnings growth for the S&P 500, single most important.
Rather than a first half. And I think equity markets are hoping that between now and then, you will get a real Fed pivot, i.e. not slowing down hikes from 75 to 50, but actually the Fed saying we've stopped hiking now. We're mindful that the economy is slowing down perhaps faster than we'd anticipated. And if indeed that plays out, we will actually start to ease. I think that's unlikely, but it feels the equity markets are really much more poised for a pivot than the bond markets.
Diana, if we get inflation sustaining at a certain given level, which gives us some form of decent nominal GDP, can that save equities? Can that save revenue growth, revenue persistency, and cash flow persistency?
I think it could help. But ultimately, if you have high inflation that's supporting nominal growth, but the labor market is starting to show signs of weakness, I think.
First pivot engaged with already at the Fed.
So we've been very resolute that they would get to January and that they would get to a 4.75 peak rate. That's the top end of the range. We've seen the market make these wild swings around that number, coming down to, if you round it, 4.8% up to 5.25%, bouncing around because the Fed is data dependent, and as each data point came in, that was occurring, and it got up to 5.25%. And then what did we get? We got the first downward surprise on inflation in October, and since then, there's been a real consolidation in the view of what the Fed will do. And the Fed has been much more clear on what they think that they will do. So I think, at least for the near term, that volatility around where could the peak be has probably.
Fed pivots and starts cutting, because that's kind of now the debate. The rate hike debate, as you know, is going to be, okay, when do they pivot, or do they just stay put?
couple of months, we are still at very high inflation. We're still not seeing signs of that momentum that the Federal Reserve really needs for a proper pivot or even to utter the word of a Fed policy cut, for example, something that the markets are already pricing in. I think the game changer for the dollar, though, is that you're already seeing this kind of idea priced in by currency strategists that this is done. The peak policy rate is in. We're already pricing it in. And the big run that the greenback has had, that's priced all of it in into 2023. What happens when that turns around and you now look at a peak policy rate that potentially
world is looking at potentially a more severe recession than the U.S. economy, and yet there is this narrative in markets that the Fed is going to be forced to pivot back toward easing at some point, that economic forces are going to mean that they turn the other way. When do you anticipate that will happen, Felix?
I think only once we see the U.S. economy clearly weakening, and I do not expect that before the second quarter. So I think the first quarter will be a big disappointment because you won't see the pivot people are expecting, and that's why I think the markets will have another sell-off in the first quarter and then probably complete the cyclical correction that we announced about a year ago or so.
Okay, so you think that we have further to fall. So where will you be looking for the entry point, Felix? What signal are you looking for?
Well, the ideal thing would be a credit event sometimes somewhere in the world.
Context. What's important about Mike Wilson's call is that he said actually there would be some sort of pivot just a few weeks ago between this kind of macro Fed-driven story to the earnings picture. But as he saw that weaker corporate earnings story, he really changed his tune.
Well, what's interesting, Creedy, is he was lonely for a decent part of this year in being such a bear. And now it seems like everyone has come on over to his camp. It's not just him that is predicting more declines in the first quarter of next year.
Well, he's been lonely for a couple of years, Kaylee. Remember, he was the most bearish of them all on Wall Street. But to your point, yeah, he's now really out in front, and he is coming and leading the consensus story. Binky Chadha over at Deutsche Bank is just one example of that kind of story where they're saying their
markets actually might be the biggest outperformer in terms of returns. So
not expected by Fed watchers to be weaker, going back from rate hikes.
Story is going to be concluded one way or another in terms of market sentiment.
Again, what the equity market, what broad markets have heard and really wanted to hear from the Fed is that, okay, they're done, the pivot's here. Powell last week didn't sound as hawkish as he had previously sounded. Therefore, it's okay to take risk. And again, if you're the Fed, this is not the outcome that you need in order to really credibly bring inflation lower. So again, we do think that the Fed is likely to deliver another dose of hawkishness at the December meeting, and we do think that that's going to create headwinds for risk assets, and maybe not ensure that this particular equity rally has legs.
And so, Mark, put it all together for us from a strategy perspective. If risk assets maybe are going to get walloped a little bit, where should people go? And particularly, if you can, through the lens of a retail investor and how they
to 2%. We could see the Fed change their policy stance as inflation is falling, but the Fed might end up accepting a slightly higher overall level of inflation than they have in prior economic cycles. And as a result of that, we do think that break-evens or inflation, you want to try and get some protection from. And so we do think that being long real rates is a very attractive way to do that. So the TIPS market, and in particular at the back end of the rates curve, we do think is an attractive own for a whole host of investors, in particular retail investors.
Mark Cabana, Bank of America, Global Research, head of U.S. rate strategy. Good to see you. Good to see that trading room shot back as well.
It's not going to pivot anytime soon, but I think maybe higher for longer, but not.
If there's a recession, but I mean, even with a mild recession, it just sort of seems like the Fed's been signaling.
Recession occurs, but I think the Fed would very, very quickly pivot, and I expect
Fed pivots and cuts rates, and then the markets respond positively. So this is, and then Jay Powell's got to pivot, and then the markets will rally. The bear story is kind of what Megan said. Nothing bad happens, and then the Fed raises rates, and they raise rates a little bit.
Equity investors to appreciate.
All right, it's going to stop or pivot anytime in the first half of the year. They're going to continue to monitor, because we're getting economic data that's still suggesting, like yesterday we saw the services report and the labor report on Friday that suggests that, the economy is still,
Michigan inflation expectations, and they pivoted to 75 basis points. So Greg is absolutely right. The data is going to drive this, and that really renders power.
From Wall Street executives, how significant a move that is and how that translates into job cuts.
Well, it's a real pivot, not to use a Fed term here, but it's a real pivot from what these Wall Street CEOs have been saying for a while. Think Jamie Dimon, think Brian Moynihan of JP Morgan and Bank of America, respectively. They've both been massive advocates, very vocal advocates for the American consumer. They're saying, look, the data is not that great, but the consumer is going to keep spending, and they have been right until now. The game changer here is what David Solomon said. Remember, he's been a skeptic on the U.S. economy for some time now. So to actually see him be out in front of this and start to say, okay, well, not only are we going to have a recession that's starting to seep into the base case, now we can actually zero in on timing and really say it's going to happen in 2023.
All right. So a lot of bad.
Can't trust what they're saying. You got to watch what they're going to do in the coming 6 months. And
for the Fed to pivot or pause, that might be the case, but I think the duration with which they leave rates at these levels might.
What I find interesting is that Chair Powell has talked about getting rates higher and keeping them there longer, and yet the market still seems to be holding out hope for a pivot. And so I think there is a disconnect. It's been or how long it's going to keep rates higher. So I think I'm fully aligned with you. The market, I think, is maybe a little too optimistic about a rapid pivot here because inflation really does seem
needs to stop.
It's interesting because there are some people who are so excited for the Fed to pivot, but to your point, you'd like to see a Fed pivot. You think the markets will take off when it's that time, but you don't want them to do it too soon, right? That's basically the takeaway. Tell me about some of the ways to make money. I mean, if there's, as you said, you're cautious, but you're looking at bonds, you're looking at some ETFs that are defensive.
Yeah, so what I think will be the big difference in the bond market in 2023 versus 2022 is duration will work. You're already starting to see that. The 10-year and the 30-year are starting to catch a bid. Mm-hmm. I think they'll work really well in the first half of next year. Okay. So you can protect yourself. I mean, I always own TLT as a portion of my equity holdings. That is my equity hedge because historically, in times of calamity, you get a perfect negative one.
Been talking about, it's a Fed pivot.
Because the Fed pivots because these things happen earlier. I wonder if even that in itself is folly, because presumably if the Fed is pivoting this time around, it's not for a good reason. It's a deteriorating fundamental picture. I mean, it's
hold, not a pivot. And I do think that that's
some sort of economic weakness between now and whenever they pivot. That's really a careful what you wish for kind of thing for equity investors, because do you really want to be wishing for the type of economic slowdown that gets you the Fed relief that you're hoping for? We're in a very tricky situation.
Probably not going to pivot right away. I'm wondering how you square that with your notes to us and what you're saying.
Pause and then pivot. And so because of that, we are more cautious overall on more risk on assets like U.S. equities. So we are really advising our clients to
and invert more. I think the initial reaction, the short end seems a little rich to me. I think we've priced in, a Fed pivot, lower rates down the road, and I don't think that's the Fed signal. So I think the short end is vulnerable to repricing along a different path of Fed funds. The long end, we've been in the camp that saw long-term rates coming down. Now at 3.5, we're kind of at a place where we think it's a pretty reasonable value. We do think there's a risk of going down to 3% next year, but it probably is going to be a bumpy ride. So I'm a little concerned about how the short end is priced going into this announcement.
Questions for Chairman Powell in the presser. Kathy, have you got one?
Yeah, I would love to understand more about how the Fed views quantitative tightening and its impact.
From now, we're going to feel better. At some point, the Fed is going to pivot. We're not even close to the Fed pivoting.
You also say that commodities, too, seem.
And maybe second half of the year, if the Fed pivots, you go back into stocks.
Interesting. Okay. Thanks, Matt. Appreciate the framework here.
Thanks for having me.
Absolutely. Okay, so.
Now moving towards the second half of next year, because clearly originally the markets did expect a Fed pivot to come at the end of this year or early next year. But now more and more strategists are saying that we're in for a very rough first quarter, at least for equities. And only after June might the Fed finally pivot and stop hiking rates. Because inflation, yes, it started to ease, but it's still very high. And the Fed doesn't want to make the mistake that was done in the 1970s when they cut rates too early before inflation actually came down.
All right, thank you both for joining us. Ksenia Galuchko there from Bloomberg and Hugh Gimberg, global market strategist at JP Morgan.
Dollar yen to move lower, especially once the Fed begins to pivot their message at some point next year. That's when you should see that bigger move kind of down.
Overly optimistic that the Fed pivot will come before the pain. Brian, is that optimism misplaced?
Yes, I think it's misplaced. I don't think it's wildly misplaced. I think people always get images of 08 in their heads, but the market always wants the easier path, and it's not that clear to me it's coming. That Fed statement, now maybe overshadowed by the BOJ, was very hawkish, and I think the pivot will come next year, but not until risk assets have given up a little bit of the gains we've seen them make. It's already started in equities.
Brian, what's 60-40 do this year? One of the great hallmarks of the last 24 hours is awareness equities and bonds tanked. Bonds have to come back. Is it a year of clipping coupons, or can you find total return?
Issuance slows down a little bit. I mean, again, I think it depends how quickly the Fed pivots. One thing risk assets may be telling us is that they can hold out a bit, right? No one has to refinance at 10%.
Rate hikes, they're going to assess the total amount of damage they've done.
It's coming, let's say, a month, 6 weeks forward, perhaps sometime in the spring. That's when we want to start looking to put money back to work, potentially in developed markets like Japan and Europe.
And so that's why we've seen the Bank of England and the ECB pivot and dash to catch up with the Fed. Our view is that we're going to be looking at something like 5% for the Fed, 4%-ish for the UK, and about 3% for the ECB. But if I have to pick one where the uncertainty is greatest, I think it is the European Central Bank, because we just do not have the clarity on what's going on in the labour market, how much wage pressure is being generated there, and so there's risk that there could be a pivot in either direction.
Are there any tailwinds for 2023, Jamie? We've got these dour and depressing Merry Christmas, Happy New Year commercials, and then your forecast I heard on the radio this morning, and I thought, God, is anything going to go right next year?
We're seeing a much faster rollback of restrictions in China.
More people are now focusing away from the Federal Reserve and the earnings story, which, by the way, is a pivot that the kind of uber bear, perma bear Mike Wilson made a couple months ago. He said ultimately there is going to be that shift. We haven't yet seen it fully take hold right now, Sonali, but it is something that may be coming in January.
And you have to wonder how long it is, frankly, before everyone starts tearing out the initial playbooks that they wrote for this year. Doesn't take long normally, especially because, as we've been talking about it, the tail has been wagging the dog. You want to make this an equity story, but really it's been yields and other asset classes that have been driving that equity story.
Pretty good to see Paul's.
As much as David believes the Fed and others believe the Fed, they will at some juncture be forced to pivot. There's almost no reason for us to have a recession.
What's going to force them, Ron? What would force that?
Well, I think if the recession gets too deep. I mean, a couple of the areas where their policy is absolutely irrelevant is in the labor market, because or secular bull market starting until the Fed pivots, or until you and Kelly Hartung show up at a Jets game on TV again. I think that would be another.
But unfortunately, the market was looking for the Fed to come out with a dovish pivot, and at the recent release, the Chairman Powell.
Stock market started to crumble so bad that the Fed was forced to pivot. Well, it wasn't the stock market. They actually, in the middle of December that year, right in the middle, they said, "Hey, the market's down a lot. We don't care. We're going to keep tightening." Then 2 to 3 weeks later, the fixed income market, the junk bond market, just imploded, and that's when they pivoted. So they're much more concerned about what's going on in the fixed income market. And right now, even though it's down quite a bit, it's still running fine. So we may get a pivot later on this year from the Federal Reserve, where they actually start cutting rates. But that's going to be happen when the situation is going to become much more dire than it is now. If we just have this slow grind lower, the Fed's going to keep interest rates at high levels. Even
on a Federal Reserve that is going to pause and maybe pivot. And there's a question of, if we do have persistent inflationary pressures, could the market be wrong on that?
Well, and I also think it's interesting that the strategists we survey, at least, aren't expecting things to get much better by the end of next year, right? I look
just kind of where we are.
Lou Wang from Bloomberg News compiles expectations for us right now out of 22 strategists that she has surveyed. The average.
The Fed already pivoted this year.
at least in the first part of the year, it then becomes a question of if the Fed is going to pivot and if a recovery will quickly follow that bottom.
Well, and to your point earlier, it's interesting to see that top-down strategists are really negative on earnings, but bottoms-up analysts are saying we should see more, like $220, $230 at the end of the year, whereas top-down strategists are saying more like $200 or $210. So there's a huge delta there. I think Tom would say that, delta.
Any Greek letter works for Tom.
It's difficult to do this. I never know which camera. Tom, John, and Lisa have at least 6 different cameras plus a handheld in.
Be hearing is that we aren't going back down to the zero bound, that we just do not live in that world anymore. So how do expectations for what kind of returns you can generate in equities need to change to reflect that?
I think if you set the table for the S&P 500, which may not be the best barometer next year, up maybe 5 or 6%. But then if you still lean value, if you still dig down into more of the mid cap and a small cap range, then I think you can see a high single digit rate of return. That's going to outperform bonds. It's going to outperform most other asset classes. And frankly, the Fed still needs to do more work.